potential hits to the NASDAQ. I like to go into those names. But overall, I do think it's time to start diversifying portfolios and looking at the XMAG. So that's, the S&P 500 minus the top 7 names. And the names you're looking at there are names, you talked about Eli Lilly versus Pfizer and putting up a chart in the last segment. Eli Lilly is a great stock. Exxon is a great stock, right? They pay a great dividend, diversified into alternative energy. With the Middle East crisis, you have, the price of oil spiking and things like this. But in general, if rates are coming down, whether we don't, maybe we don't get that next 50, but rates came down 50, they will be coming down over time. I think you have a good case for small caps and good value mid caps to start to rally. And then, the kind of like unloved S&P 500, other the Mag 7, has actually been performing. I think it's worth investors diversifying their portfolio for the longer term here.
What about the Russell versus blue chips in the S&P versus international? What is all boats are going to rise? What about China? Did you see David Tepper?
Yeah, I don't think all boats are necessarily going to rise. When I look at small caps, I try to think about looking at the quality small cap names. But the S&P 500, X the Mag 7, you still have a lot of solid large cap blue chip quality balance sheet companies that pay great dividends. And I think that, it's certainly worth having that diversification there. China remains to be seen. We've seen this short-term rally. They're essentially supporting their economy there. We'll have to see what happens. Second largest economy there. That also helps us too, right? If you think about names like Exxon and Chevron, which are XMAG, if the second largest economy starts to grow, they're providers there. You get some growth there too. But I do think it's worth it to start diversifying out too. Like Japan was a good diversifier. Now perhaps it's China as they have some of this stimulus coming in. And maybe the Mag 5 of Europe is interesting to look at, some of the top names in their broad-based indices that have been sleepers for a few years.
Great. Okay, Sylvia Jablonski, right out of the gate here on Monday. Thank you. Appreciate it.
Have a great day.
Hey, you too.
Okay. Coming up in just a minute, a disappointing box office debut for Joker, the sequel. We'll bring you details about that after the break.
Boom.
Welcome back to Squawk Box, the sequel to Joker, bringing in $40 million in domestic ticket sales over the weekend debut of it. Expectations of last month closer to $70 million. But as reviews came in, that estimated figure slumped to around $50 million. The film's production budget was reportedly, you ready for this? $200 million. That doesn't include marketing costs, which oftentimes can, in some cases, hopefully not double that figure, but oftentimes you look at the budget and they might even add another $100 million. It could be a $300 million project. The first Joker bringing in more than $96 million at its debut in 2019, tallied more than $1 billion during its box office run. So maybe they feel like there was some wiggle room in all of this.
I've heard it's like not a musical, but there's some musical numbers in it that are really bad. And Lady Gaga is
It's not Moulin Rouge, that I know.
And it gets a D with audiences, and then
It was not doing.
it's the worst movie ever.
I read some very tough.
Watching
Friends who went to see it was insane.
watching the trailer, I've just seen Joaquin Phoenix in that role again. It was like, wow, I want to see this, and I thought, but you know, a 3-minute trailer is different than a 2.5-hour movie if you have no plot for it. I'm not sure it needed to be. Like the original Joker, the way it ended was sort of, you still haven't seen it.
I haven't seen it, and I don't want to.
You
based
don't,
on
you
what
shouldn't
you've
see
told
it.
me.
No, I know, based on what I've
It's
told you.
not
It's it conjures up some very.
But I knew people who loved the first one,
dystopian,
who bought tickets
Oh, I loved-
3-4
I did love
weeks
it,
ago
yeah.
for this one, and it was not necessarily the
It's a
same
horror
genre
movie.
they were expecting.
It is definitely a psychological, terrible horror movie, and you just feel for what resulted in this kid becoming who he is.
Yeah.
You know.
All right, when we come back, Hurricane Milton strengthening to a Category 2 storm overnight. It is set to hit the west coast of Florida later this week, and we have the details on this next. And later, we're going to talk about the recovery from Hurricane Helene with Republican Congressman Chuck Edwards from North Carolina. Squawk Box will be right back.
Really pissed me off.
Good morning. Welcome back to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. Take a look at the futures on this Monday morning. We got some red arrows after a lot of green recently. Right now you're looking at the Dow off about 195 points and NASDAQ looking to open down about 135 points. So you're looking at the S&P 500 looking like it would open off about 35 points as well. Meantime, some preparations are underway, this time as another hurricane pushes towards the Florida coastline. Hurricane Milton forecast to hit the western coast by Wednesday. It's currently a Category 2 storm. Forecasters saying it's likely to strengthen to a Category 4, but weaken back to a Category 3 at landfall. The storm expected to bring a potential life-threatening storm surge, damaging winds, and torrential rain, and we're going to have to keep our eyes on that, of course, after Hurricane Helene and all of the damage that has caused.
New analysis this morning about the economic plans from former President Trump and Vice President Harris, and Megan Casella joins us now with that story. Good morning.
Hey, good morning, Joe. So we're talking specifically today about the fiscal impact of these plans. And the headline here is that the debt goes up under either candidate, but Trump's plans would add roughly twice the amount of debt as Harris's would. Now that's according to the Committee for a Responsible Federal Budget. And their baseline estimate says that Harris's plans would add a net $3.5 trillion to the debt, and Trump's would add about $7.5 trillion. Now the difference here is on both the top and the bottom line. Harris's plans both cost less and they raise more. Her biggest line item is her plan to extend the 2017 tax cuts only for anyone making less than $400,000 a year. That'll cost $3 trillion. Expanding the child tax credit would cost $1.4 trillion, but then that's offset by raising the corporate tax rate, which brings in $900 billion, and all those plans to tax capital income, those would raise about $850 billion. Now for Trump, extending the 2017 tax cuts in full, that alone costs about $5.4 trillion. Eliminating tax on overtime and Social Security, those would together cost another $3.3 trillion. Now the tariffs would be his main source of revenue. They'd bring in about $2.7 trillion, and his plans to expand energy production and drill for more oil, those would raise about $700 billion. And now one last point here, because I think someone might like to ask about this. This analysis mostly does not take into account changes to GDP, except for in a few key areas. And for the tax cut extension on the Trump side, when faster growth is taken into account, the cost does fall, but only by about $800 billion, leaving the overall cost of those tax cuts alone at about $4.6 trillion on the Trump side. Joe?
Did the any unrealized capital gains assumed would pass? They didn't even put that in there, did they? That's not part of this?
They did. They talked about that in sort of the taxing capital income section. What
So
they
it
said
is
in
there.
their methodology
Yeah.
was that it is there. Yeah, they said that sort of billionaire minimum tax that Biden has talked about of 25% and unrealized cap gains on over 100 million. They did put that in there. Obviously, there's a lot of caveats in here. They're saying they have to
Yeah.
make a lot of assumptions on both sides, but that's in
Right.
there.
Well, Megan, did you see at the end it says, I love this, campaign plans are often vaguer, more vague than what we know, and estimating policies isn't an exact science. Under the analysis, did you see this? Trump's deficits could be as low as $1.45 trillion or as high as $15 trillion. So it's somewhere between when you really look at what they're able to say. But for Harris,
Right.
it's still from break even to 8, so it's still double. It could be as low as break even to as high as 8.1 trillion. But I like that
Exactly.
that Trump's deficits could be around 1.45 trillion or maybe 15.15 trillion. So I don't know.
Right.
It doesn't give me a lot of faith that we. But I'll tell you what really would blow out Trump's thing, Megan. That is, you extend the tax cuts and you take away the SALT cap. I mean, that's the only way that
Right.
you were able to pay for the tax cuts in the first place was the SALT cap.
Right. No, I think that's right. Obviously, huge ranges here, Joe, that they have to deal with. What they do get into in their conclusion that I think is interesting is that neither candidate is doing anything, even in terms of lip service at this point, in terms of addressing the debt. Even though Harris, as you said, her low-cost estimate is at just about break even, they still say that's not good enough, that they want both of these candidates, both major parties, to be looking at the debt because of the trajectory that it's on. Debt to GDP ratio, I don't know if you saw those numbers in here. The baseline estimate within 10 years, we're already getting to 125%.
Yeah.
The Harris estimate gets us to 133%, and Trump to 142. That's, as you know, Joe, that's when economists start to get worried when the debt grows faster than the economy. That's kind of the path that we're on right now.
Yeah, an inexorable path. I don't know, Megan, whether I believe that a lot of those Harris, to assume that Trump, that the tariffs go in, and to assume that she gets all of her tax cuts through, neither one of those things is very likely to happen. So, but either
Right.
way, this, which is it's a nonpartisan organization, either way, they're very concerned about both the trajectory that the country is on, regardless of which way we go. All right, thank you.
That's right. Sure, thanks.
Yeah, thanks, man.
When we come back, we're going to talk about fears of escalating violence in the Middle East. A year after the Hamas terrorist attacks of October 7th, Admiral James Stavridis will join us next. And a reminder for you, you can get the best of Squawk Box in our daily podcast. Just follow Squawk Pod on your favorite podcast app, and you can listen anytime. We'll be right back. Today marks 1 year since the Hamas terrorist attacks against Israel. In Jerusalem, a siren rang out at 6:29 a.m. to mark the hour when Hamas-led militants launched rockets into Israel at the start of the October 7th attack last year. Joining us right now is Admiral James Stavridis. He is retired U.S. Navy admiral and a former NATO Supreme Allied Commander. He's now Carlyle Group Global Affairs Vice Chair and an NBC News Chief International Analyst. His new book is called The Restless Wave. It is out tomorrow. And Admiral, thank you for joining us on this day. It's kind of amazing to think it's been a year.
Yeah.
What would you say has changed over the course of that year? Where do we stand now?
Yeah, let's start with the human cost, Becky. 1,200 Israelis killed, 40,000 Palestinians. Those are big numbers in and of themselves, of course, but when you put it on a population adjusted basis, Israel's a country of only 10 million, maybe 5 million Palestinians in and around the region. Those numbers are kind of astronomical in terms of human cost. Secondly, the events have really put the Palestinian statehood issue back on the table, and it's also raised very serious questions about anti-Semitism, both in the United States and abroad. And then third and finally, and I think of interest particularly to investors, the chances for a wider war in the region, that being defined as full-on combat between Israel and Iran, is now hovering somewhere around 1 in 4, uncomfortably high, Becky.
Yeah, we are waiting for a response to what happened last week when Iran launched 200 missiles into Israel, ballistic missiles. This is a step up from anything that had been done in recent memory. So what is the Israeli response to this? What are the negotiations with the Americans for what they may or may not do?
Yeah, let me put myself in the Israeli Pentagon, if you will. The options that the military will be developing will kind of range from cyber, in other words, non-kinetic. They'll go up to targeted killing. They'll move through further attacks on proxies. All of that is kind of happening. Then you're into things like striking Iranian nautical targets, or you could go after the energy grid of extreme concern to those looking at the global economy. You could go after the military-industrial complex. I think that's probably where it lands, going after the facilities that build and store and maintain, for example, these ballistic missiles. At the far end of the escalatory spectrum, you could go after the Iranian nuclear program. I think all of that is on the table, and as a four-star working both in the Pentagon and in command of NATO, that would have been the type of menu I would have presented to the political leadership.
So after you presented that menu, when invariably some politician or somebody else said, okay, then walk us through the permutations of what would happen next if we go do those things, you would tell them what?
I would say the lower you are on the spectrum, and I just gave it to you in ascending order of violence, the lower you are, the better the chances that we avoid that 1 in 4 chance that this goes high order. Therefore, going after the nuclear weapons sites or going after the energy grid, that invites a much larger response. If you go after the military-industrial complex, for example, you might be able to see this thing de-escalate a little bit.
But do you see two things? One is that there are some who say, look, this is a once-in-a-generation opportunity to go after certain parts of their apparatus, including their nuclear facilities, perhaps, at a time when they are in disarray, and that this opportunity may not exist again. So how do you weigh that against whatever you believe the retribution may or may not be? And do you think to yourself, okay, their retribution would be large, but potentially Israel, along with its allies, including the U.S., would be able to take much of that out, if you will?
I think that's a defendable proposition. What you're implying is go big and go after the nuclear sites. Here's the problem. Iran is 3 times the size of Texas. They have 25 of these sites all around the country. Many of them are buried 300 feet, 3 stories underground. Intelligence is imperfect. It's the most highly defended sector. So if you choose to go after those sites, it is a defendable proposition. You must be prepared for perhaps not being as smashingly successful as you've been over the last couple of months, and you must be prepared for a pretty significant response. And I'll close with that. The Iranians still have 2,000 more ballistic missiles. They launched 200. So it is a risk calculus. And finally, the United States, at least with the current administration, is not going to be participating in strikes on the nuclear sites. You might roll the dice for a new administration.
Admiral, is it fair to say that while I know you've written that the United States would step in and defend Israel at all costs, is it fair to say that there is likely some disagreement about what is best because they have these two nations not 100% alignment in terms of what they think might be best for the immediate future? Israel is right there. Israel is going to be the one that deals with any strike that comes first. We're a little further afoot. And while we want to make sure we defend our ally, an incredibly important ally who has been so much over the last year, there's going to be some disagreement in the room.
That's absolutely correct. And, you know, newsflash, there'll be an election in just over 30 days, which will probably also engender different approaches depending on whether we have Team Trump or Team Harris coming in. Certainly, from my perspective as a military analyst and someone who was in charge at one point of U.S.-Israeli military-to-military activity when I was NATO commander, I would say we need to stand very strongly with Israel. That's in our best long-term interest.
29 days, Admiral.
Who's counting?
Days. But who's counting? 29 days of the election. Your guess as to the outcome, I wouldn't even venture. But yeah, it's not 30 anymore. It's 29. It's incredible. I have a little counter here. 18 hours, 12 minutes, and 58 seconds.
Keep me posted, Joe.
Okay, tomorrow it's going to be 28 days, I think. I think I got that right.
A movie called that. Admiral, thank you very much for your time this morning. We do appreciate it.
You bet.
Thank
Thank
you.
you. Thanks.
Is that the zombie? Yeah, it's a zombie movie, and then there's another one after. I think there's a second.
Yeah.
As we head to break, here's a look at the shares of Boeing. The company and its largest union are set to return to the negotiating table today to try to work out a deal to end the strike that's halted production of the 777, the 767, and the 737 MAX jets. Squawk Box is coming right back.
A story in niche auto publication Torque News raising some questions about insurance policies on Tesla Cybertrucks. An owner named Robert Stevenson posted a letter on X saying that Geico will no longer insure his Cybertruck. The letter from Geico reads in part, "This type of vehicle doesn't meet our underwriting guidelines." Stevenson has 8 vehicles. Geico is only said to be terminating coverage on the Cybertruck. Stevenson said in his post that he was going to switch insurers as a result. But the bigger question is whether this was a broader policy shift by Geico. So I did some reporting last night on this, and here's what I've heard back. Back in May, Geico added the Cybertruck to the exotic car list after complaints from customers who couldn't get parts from body shops or repair. Geico says customers tend to blame Geico for these delays, not the body shops or Tesla. And Geico also gets the blame from frustrated customers when their rental replacement vehicle isn't covered for as long as it takes to get the cars repaired. But when notified about this issue, Todd Combs, who is the CEO of Geico, said it wasn't a holistic view of the issue and he's taking another look at this. He also instituted a change in policy. He said Geico is going to be reaching out to the customer this morning and that the company will also be removing the Cybertruck from its exotic car list internally and pre-ordering Cybertruck parts for their own repair shops so that if a customer runs into a delay, they can then direct them to that avenue. But it does get into this interesting story. Insurance rates have gone up pretty significantly. Right. There have been delays for parts in all kinds of cars because of what happened with the supply chain during the pandemic. Maybe a little harder to get parts for vehicles that are niche vehicles too.
No, when you first said it, I thought it was a safety concern. It's not.
No, it's just
I've been in one of those.
Geico customers get mad.
The only thing unsafe about it is how fast the thing is. It's unbelievable.
No, but how much of this sort of maneuvering back and forth is that that Geico is worried about Tesla customers being loud?
I don't know. I reached out to Todd, and Todd said this happened without his knowledge of any of this. These decisions get made at lower levels all the time. He said going forward, he wants to know about any issues, any car getting put on these exotic lists.
But I'm just assuming that if it was a GM car or a Ford car or something,
I don't know how much of it's
the passion online and what it can do to your brand and the kind of sort of riot that can emerge in social media is just a completely different level. And so if you are Geico or any company that's in this business, you're having to be more sensitive, let's just to say.
I mean, I will also say it gets a lot more attention when a CNBC anchor reaches out to a CEO.
That's true too.
So it's going to be promoted in other ways. So, but this is a situation where they said they're changing it. They're reaching out to the customer today.
Coming up on the other side of this, a closer look at the wage gap and leadership gap when it comes to women and men in the workforce. We'll talk about it. And later, we're going to talk more about Starboard's investment in Pfizer and the changes it could push for if it were to succeed. Squawk Box coming right back. course is. Welcome back to Squawk Box. The September jobs report showing women and men are nearly on par in terms of unemployment rate, but that does not show the full picture in terms of leadership and maybe more importantly, the wage gap. Our next guest is the author of Likeable Badass. I like to sing that on the air. How women get the success they deserve. She's also the co-author of a recent New York Times opinion piece with Adam Grant titled Kamala Harris is Doing Something Brilliant Up There on the Tightrope. Joining us right now is Allison Frugel, research psychologist and professor at the Keenan Flaggrove Business School at UNC. Why don't you actually, let's go straight to that op-ed and explain it. What do you mean by that tightrope and being brilliant up there?
Yeah, it's the balance between showing strength and showing warmth, assertiveness and warmth. And that's something that we all need to do to manage our status, to be well respected. But it's well known that it's been harder for women to be able to find that space, to be able to do both over time. And so that tightrope is being able to convey that balance simultaneously of, I know what I'm doing, I'm strong, and I also care about you.
When you look at, we were just talking about the unemployment rate earlier, and obviously Friday, the big jobs report came out. We were saying unemployment, men and women, very similar. Wages still quite different. Why do you think that is? And what do you think needs to happen or not about it?
Yeah, I mean, the Census Bureau just showed that for the first time in over 20 years, the wage gap got a little bit wider rather than narrowed. And I think it's a combination of a couple of things. One is women entering the workforce in entry-level positions, so they're not compensated as highly as more senior positions. And then our challenge is getting women to advance and be able to move up on par and parity with men. The Women in the Workforce report that just came out showed a somewhat promising increase in women in C-suite positions, which was 29%, up from probably 17% a decade ago, except that a lot of that growth has actually come from adding positions to the C-suite, like human resources, legal, data, chief data officer, and it's probably not a sustainable path to growth to continue to add positions. And so when we look at those challenges of why aren't we closing the wage gap and why aren't we having parity and representation, one of the variables that I try to shine a spotlight on is this notion of status, of being respected. And that's critically important to our ability to advance, because if we're not well respected, generally people don't want to promote us. And one of the challenges that women have is that on average, they are granted less respect than men. And so what I help people do is to bring status into the narrative and say, we need to be, as women, making sure that we can walk the unfair tightrope in ways that get us the respect we deserve, and we need to be sure.
Well, what does that mean? How do you do that then?
Yeah, so I mean, obviously a lot of things that we don't control affect our status, but what we also see from the science is that status is affected even more by how you show up. So we can control it, even though we don't all start at equal playing fields. So every time we can take an action that can convince our audience, because status is purely judged by the opinions of our audience, that we are very capable and we care about people other than ourselves, we have done the most controllable thing we can do to convince our audience that we are deserving of respect. And that can be small things. So with our analysis of Kamala Harris, we were looking at communication style, like what emotions do you express? What words do you use? Those things can convey, I know what I'm doing and I care about you. But also other more substantive things that we can do, like giving advice.
Allison, can I ask you this? We were talking about also talking about DEI, and interestingly, obviously today's October 7th, a year after the Hamas attacks, which led to all sorts of debate inside educational institutions and large corporations about DEI, free speech, and all sorts of other things. I wonder whether you think that DEI ultimately helps or undermines the arguments around respect.
That's a really good question.
Sort of a complicated one, right?
Yeah, it is a complicated question. I think that generally I would say I think it's helpful in that respect is everything that people know about us that contributes to how much we're respected comes from one of two places. The things that we say about ourselves and put out into the world, and the things that other people say about us, often when we're not around. And I think that what DEI efforts do in their best version is try to convince and try to help other people understand the role that they can play
in building other people's stats. And I think to the extent that it raises awareness of the fact that I have some influence over your status and everybody else's by how I present them to the world, and I have a lot of control over that, that's a very positive thing. But I agree with you, it is a very complicated question.
Allison, it's a longer conversation with many more questions. We hope to have them again with you in the future. Thank you.
Of course, thanks for having me.
Great to see you. Programming note, the search has begun for 2025 CNBC Changemakers. That list recognizes women transforming business and philanthropy. And if you want to apply or nominate somebody, you can go to cnbc.com/changemakers now through November 11th. Meantime, it is now just past 7 a.m. on the East Coast, 7:03 to be exact. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin along with Joe Curtin and Becky Quick. Got a lot of big stories on this Monday morning to talk about. The biggest, perhaps, is this. Activist Starboard investor, Starboard Value, now taking a roughly $1 billion stake in Pfizer and apparently seeking to mount a turnaround at the struggling company, according to sources familiar with the matter that say the activist has approached former Pfizer CEO Ian Reid and the company's ex-CFO Frank D'Amelio. Both have expressed interest in supporting Starboard's turnaround effort, what that looks like, and what can be done in the very immediate term. I think lots of question marks this morning, but we're looking at them. Meantime, Warner Brothers sequel Joker earning just $40 million at the box office, less than half of the first film. The movie had a budget of $200 million. It was expected to haul in more than $50 million in its domestic debut. You add up how much they spent on the budget plus the marketing, and it's going to be hard to get to even. And preparations underway as another hurricane pushing now towards the Florida coast. Hurricane Milton is its name. It's now Category 2. It's forecast to make landfall by Wednesday. Forecasters saying it will likely be a Category 3 when it hits Florida's Gulf Coast.
All right, let's get a check on the futures right now. You'll see that there is some pressure this morning. Dow futures down more than 200 points. NASDAQ down by close to 140, and the S&P down by about 35. Let's get over to Dom Chu. He's taking a look at this morning's pre-market movers. Dom, what's really putting the pressure on the averages?
Well, we got some mega cap tech names that are kind of at least scheduled for some downgrades this morning, so that's where we're going to start, and that's maybe what the bigger drag is here. Some of those key analyst calls out this morning include shares of Apple right now lower by the tune of 1.25%. After analysts at Jefferies downgraded the tech stock to a hold from a prior buy. The firm also said that near-term expectations for the iPhone 16 and even 17 are higher and pointed towards weaker than expected initial demand for that 16 product. Jefferies also said it believes that Apple's artificial intelligence capabilities for smartphone tech won't reach actual commercialization for another 2 to 3 years, so that's behind the Apple downgrade there. Amazon also sliding this morning. Shares are down just around 2% right now. You can see $182.87 a share. Wells Fargo downgraded the e-commerce giant and web services giant to an equal weight and lowered the target price to $183 from $225. They are pointing to slowing growth expectations and competition in North America from the likes of Walmart, perhaps others, so Amazon shares down 2%. And we'll end with a check on Netflix. Those shares are slightly lower by about 0.75%. Despite receiving an overweight rating over at Piper Sandler, the firm upgraded that stock, saying that Netflix is a clear leader in streaming. But Piper also noted that consensus margins could prove to be conservative in 2025 and 2026 based upon those incremental margins over the last few quarters. So Netflix is also a bit of a drag here, down 0.75%. Now, for more on those and other top analyst calls of the day, CNBC Pro subscribers can head over to cnbc.com/pro. They get the full story there, Becky. I'll send things back over to you guys, but really, it really is a big drag on some of those mega cap tech names this morning.
Okay, Dom, thank you very much.
Sure.
Coming up, what's ahead for interest rates after Friday's big jobs number. And then later, Congressman Chuck Edwards joins us on the latest out of North Carolina and Hurricane Helene and the cleanup efforts. Stay tuned. You're watching Squawk Box. This is CNBC.
Journey today.
The blowout jobs report causing doubt that the Fed may continue aggressively cutting interest rates. In fact, if you look at this morning, the 10-year is sitting above 4%, and actually the 2-year just pushed above 4% as well. Joining us right now is Purnima Puri, who is governing partner and portfolio manager of public credit strategies at HPS Investment Partners. And thank you for coming in today. Purnima, let's play this out. Do you think it's less likely that the Fed will cut rates as many times as the market had been anticipating?
Thanks for having me. We think it's likely, the risk is more that they will cut less than people expect. I think that a stable labor market and inflation under control is the mandate, and that report suggested that they probably softened the concerns around the vulnerabilities for the U.S. economy.
So, in other words, they don't need to cut as much based on their perspective of trying to maintain full employment.
I think it's so data dependent, and we had a number in August that was totally different than we had a number in September. Chairman Powell has said that in the next couple periods, November and December, we're likely to see the baseline cuts of 25 basis points, and I think that there's a long way between here and the end of 25.
Yeah, and I think it wasn't just the stronger numbers for September, it was the revised upward numbers for the month of August, too.
Correct.
So continuing to watch all those things. It did sound like Chairman Powell last week was, or maybe it was the week before, was it Friday the week before when he was talking, was basically saying, we're going to measure the data and see what happens from here.
Yeah, I mean, what we heard was we're not in a rush to cut. We are focusing on all the data. And so our view is that, it's likely to be baseline for the next 2 quarters. I will say that the number that the market had estimated went from 8 cuts to 6 cuts based on that information that came out last week.
Is that a problem for the markets? Or is it good news because it means there's not as much of a drop-off in the economy as had been maybe predicted?
Yeah, I mean, people are saying it's Goldilocks economy because it's tempered inflation, it's moderate growth, and it's rate stability. It feels like the economy is chugging along. So I think people are focused on what's the right terminal rate. Everyone's been focused on that being 3%, and we have the view that it's likely to be in that low 3% number, and the 10-year Treasury is likely to stay around 4.5%.
So what do you tell investors to do when it comes to the bond market, when it comes to any of these credit facilities?
Yeah. So you can either take spread risk or you can take rate risk when you have rates going down. Spread risk is hard to find in the high yield markets right now. Spreads are super, super tight. So spread risk there's different credit products that allow for spread risk. And it's likely that duration risk is probably going to be interesting at some point soon, because at a 4 to 4.5% 10-year, that's not too bad either.
You seem pretty laid back about this. You don't seem too concerned, right? No, seriously, there's some people who are riding on every single movement that's made. You're basically saying we're in a situation where they're going to lower rates, we're just not sure by how much.
Yeah, I think that we are of the view that, you're probably going to have somewhere between 5 and 6 cuts by the end of 25. We don't trade portfolios based on 1 month's information. Right. We don't invest based on that. So we tend to have a little bit of a longer outlook. But I think that, when we price risk, we're looking over the course of a year, not over the course of a month.
And what do you do over the course of a year? If it's not about the spread risk that's worth taking, what do you do?
Yeah, I think that we're, triple C risk, again, we operate in the land of credit, so I'll sort of start with that. Yeah. So that's the lens that I come at it with. We haven't found that triple C risk versus higher quality risk makes a lot of sense. There is a lot of dispersion in the market, but we haven't found that makes sense. I think when we look forward, 25 might be a year where we have more clarity than we've had since 2021. You might have more
clarity in terms of what?
Clarity in terms of direction of rates,
yeah.
Direction of monetary policy, and election, and therefore sort of what the world looks like in terms of spend. Mm-hmm. So I think that's the first time we're going to see that in the last 4 years.
I mean, once we find out the election, then you will have all of the questions answered, at least for the
many of them answered. Yeah.
Does geopolitical chaos play into anything that you look at on this front?
A lot.
That seems like the biggest issue that we're not going to know no matter what.
Yeah, I mean, I think it circles back to 2 things. One is yes, is the answer, but inflation. So what drives inflation? Inflation's driven by one, conflict. That's one. Two, what people have been really worried about is reacceleration of growth. So too many cuts too fast, lots to spend, and therefore you get that kind of reacceleration of inflation. So we're definitely worried about Middle East conflict. We're definitely worried about inflation as a whole and what drives it. And we're definitely worried about federal deficit.
I mean, I was going to say the other two issues that cause inflation are government spending, whether it's needed or not, or in terms of how much stimulus they put in, and the other would be supply chain issues, and that plays back into global conflict too.
Correct.
And
the ports and all that, yeah.
Yeah, and your analysis on that is to do what? I mean, thankfully the ports have been put off, at least for now.
For now.
We'll see in January what happens.
Yeah, our analysis is, the economy is growing, and growing economies tend to be pretty good for credit products. So we're trying to just stay in sort of safer credit boxes and not go way far out on the risk curve.
All right, that makes sense. Purnima, thank you for coming in today. Appreciate it.
Coming up, Anti-Defamation League CEO Jonathan Greenblatt is going to join us to discuss the attacks in Israel that occurred 1 year ago today and what has happened since. Stay tuned. Squawk Box returns after this.
Make money.
It is 1 year now since the tragic events on October 7th in Israel, and since then the Anti-Defamation League reports that there have been over 10,000 anti-Semitic incidents in the United States, a 200% increase since the year before. Joining us now is Jonathan Greenblatt, CEO and National Director of the ADL. Jonathan, good to have you on this morning. Tough to think back, and it doesn't seem very long ago, and I guess one of the reasons is we still have hostages, that the nightmare continues, but it continues for a lot of people. You said something off camera about a day of, what is it? It's
week of rage.
A week of rage on college campuses, and then initially I was going to say, okay, 1,200 people slaughtered, 100 hostages. It's not rage about that incident. But then I do see in the aftermath, tens of thousands of people have lost their lives too. So it's just, it's not clear to me exactly how we can look at this. Although without the initial incident, would there be 41,000 Gazans dead without the original incident?
Of course not. Look, this is a solemn day, and we need to ensure that we remember those people who were killed. The 1,200 murdered, slaughtered, like you said, the 5,000 plus wounded, and the 101 hostages still there.
They didn't do anything other than go to a music festival or wake up
in the morning or feed breakfast to their children, or elderly people at a bus stop, right, waiting to take a trip, gunned down in cold blood. But here's the thing. Think about 9/11, right? Nearly 3,000 Americans were killed in the single worst act of terror ever perpetrated on our shores. And on that day, on 9/11, we remember them. Now, it's true that 1 million plus people were killed in the ensuing years in Afghanistan and Iraq. It's true that thousands and thousands of U.S. servicemen were killed, men and women. By the way, coalition forces too. But on 9/11, we honor the memory of those who were killed. And that's it, Joe. No rationalization, no equivocation. So what I would say to leaders today, corporate leaders, elected officials, college presidents, on this day, you remember those innocent 1,200 people. No equivocation, no rationalization. There will be time to talk about the innocents, and every innocent life lost is a world destroyed. But there will be time to talk about them. Today, you remember the Jews who were killed. That's why we're here.
What we saw over the last year, and there were times that it was tough to watch college campuses.
Yeah.
We're not seeing that now, but is the undercurrents, has there been any change in the underlying amount of anti-Semitism? Are kids still scared to go to classes? Are they still threatening?
Look,
are these things happening still?
Last year was like an avalanche of anti-Semitism on these campuses, nearly a 500% increase year over year. In the ensuing months that happened over the summer, college administrators got smart, and many of them adapted their codes of conduct. They instituted new rules where they needed to. So we haven't yet seen the encampments again, that's true. So that's the good news. The bad news is we also haven't yet seen enforcement. So it'll be interesting to see how things play out this week. Joe, you mentioned it. These pro-Hamas groups on campus are literally the same groups that honored, Ismail Haniyeh, the head of Hamas who was killed, or Hassan Nasrallah from Hezbollah. The same groups bring out Hamas and Hezbollah flags, Joe. We will see what they do this week. And if they violate the rules, I hope the college presidents will enforce consequences.
Can I ask you about DEI? Because I look at October 7th, and we were just having a conversation about DEI in the last segment, as a tipping point. I mean, there had been a raging debate about DEI prior to October 7th.
Right.
But in the aftermath of October 7th, things, I think, shifted, and there was even a greater backlash. So there was, Ron DeSantis and Disney prior, and you look at Target and Bud Light and the like. But after October 7th, I think there was a view, and I'm curious what you think about this, among business leaders, many of whom were Jewish, who had been big supporters of DEI programs and supporting minorities. And there was a view, and Brett Stevens, I think, reflected this over the weekend in the New York Times, that there wasn't reciprocity in the same way.
Right.
And that led to a rethinking of some of these programs in a way that I don't think we talk about on TV or is actually talked about in public very often.
Look, I think it's a very good point, and Brett did have a brilliant column on Saturday morning. You can't really say that you're pushing inclusion if you don't, Andrew, actually include everybody. And what these corporate CEOs found out is something that actually we knew at ADL, that many of these DEI programs just didn't address anti-Semitism. They, put people oftentimes, in these sort of oppression Olympics.
Right.
And you're either team oppressor or team oppressed. Mm-hmm. And for reasons that are a bit inexplicable to me, the Jews were always on team oppressor. And that meant that anti-Semitism, despite the fact that it's the largest percentage of faith-motivated hate crimes in this country, wasn't included. The fact that Jews have this history of trauma that lasts thousands of years, not included. That's a problem. And so I think many companies are reconsidering it. Many of them are now also adopting these positions of institutional neutrality because they feel like they've gone too far out over their skis.
Does institutional neutrality work? Because that is the same thing that college, university,
Look, number one,
administrations.
It's a good question. Okay, I will say diversity matters. I believe in diversity education, but it's got to be done right. But to your point, institutional neutrality is good. Moral clarity is better. And moral clarity means, again, when we see over 1,200 people slaughtered, by the way, not just Israeli Jews, Muslims, Christians, Buddhists, right? People of different ethnicities, including Arabs, then you simply say this is wrong. No equivocation, no rationalization. So I like institutional neutrality.
Institutional neutrality is what they've been using. You don't think that's
I don't think it's enough. It's an insufficient condition. I think moral clarity is better. And look, if our college presidents had demonstrated that before Congress, before their own students, I don't think we'd be in this mess to a certain degree.
The college presidents are presiding over an entire infrastructure that seems to breed this for some reason. We didn't really see the protests. We saw some, but it was mostly on college campuses. It's in that environment. Are we ever going to be able to fix our college campuses?
We have to.
How? It's not just the college presidents, it's every tenured left-wing academic that's been hired over the past 30 years.
Look, we need systems change.
Exclusively left-wing academic, almost.
Look, we need systems change on these campuses. We need culture change on these campuses. And it didn't happen overnight on the front end, and we're not going to fix it overnight on the back end. But like, as I think about this myself, again, it's administrators, it's faculty members, it's the student bodies. But then I also think, Joe, what can we do? Like at ADL, we have undertaken more lawsuits in the past year than in the prior 100+ years, many of them against universities and K-12 school districts. Right? We used to play only an inside game, talking quietly. Now we're driving an outside game with like our campus report card. Like what I would say for us at ADL and for all these groups, in the wake of 10/7, it's a wake-up call, and you've got to innovate. You've got to take risks if we're going to try to fix this thing once and for all.
You could fire every current college president, and not one thing would change based on what's underneath, what's again festering on college campuses.
This is a culture issue, so there's not one tactical thing you can do. Firing, Liz McGill at Penn, or I think technically she resigned, that didn't change the issues. It requires a top-to-bottom, holistic approach, and we're still waiting to see that fully rolled out at campuses across the country.
I would ask you about, we're talking about the Middle East every day. I don't know whether you have opinions about what Israel does from here on out, about the response that we're seeing from
well, I will say this. I will say this, and I've seen this on some other shows this morning. Israel, I'm not a military strategist, but Israel needed to respond like America did after Pearl Harbor. And after America attacked Japan after Pearl Harbor, nobody said to President Roosevelt, what's your day after plan for Japan? That was not the question at hand. After the Germans were incinerating Jews in the ovens, bombing London to smithereens, nobody said, Churchill, what's your plan the day after? Look, this is a moment where the Israelis are facing sheer evil. It may be perpetrated by Iran, but it's coming from Gaza, from Lebanon. The Israelis had to respond. I just think I've seen a lot of hand-wringing this morning. Well, what's Bibi's plan? Look, whether or not you like Bibi Netanyahu, Israel needs to deal with existential threats, organizations and governments that want to annihilate them. Let them do what they need to do. I just think everybody being an armchair quarterback doesn't help the cause.
And you've got a country like Iran that the stated objective is to obliterate the state of Israel and kill all of it, and they're this close to a nuclear
and they
weapon.
They put militias surrounding the country. What would we do if Ottawa said our stated policy is to destroy the United States of America?
Get a nuclear bomb.
I think that's we would do a lot of things, and no one would say, what's the day after plan? Who's the next prime minister after Trudeau? We would simply say we need to respond to this threat. Right. We need to see more of that.
Thank you, Donovan.
Appreciate you guys.
Good to see you this morning.
When we come back, Boeing restarting talks with its union to reach a deal. We will talk about what to expect and what's next for the strike. That's straight ahead. Right now, though, as we head to a break, take a look at this morning's pre-market winners and losers in the S&P 500. Squawk Box will be right back.
Download the app.
Welcome back to Squawk Box. An interesting story over the weekend to talk about. Venture capitalist Ben Horowitz and his wife Felicia planning to make now a significant personal donation to Vice President Harris's campaign. You may remember that back in July, Horowitz, along with Mark Andreessen, they stunned Silicon Valley by very publicly endorsing and donating to former President Trump. They created a whole podcast, a video podcast about it, saying that the best candidate for technology startups was Trump. But now Axios reported, along with others, that Horowitz announced his change of heart to employees of his firm via email on Friday. He said that he was encouraged by conversations with Harris about tech policies, although he notes that she has not publicly stated what her tech policies would be. As a result, Horowitz said he will make donations to support Harris, but the firm's position, at least thus far, has not changed. But a lot of folks raising their eyebrows on that shift.
Yeah, like they did on the initial shift, which was probably surprising. Goldman Sachs out with bullish calls this morning. The firm raising its year-end price target for the S&P 500 from 5,600 to 6,000. That move implies a 4.3% upside from Friday's close. Goldman also upgrading China equities to overweight, saying it sees another potential upside of 15 to 20% following the aggressive stimulus package from that country. Markets in mainland China still closed for the Golden Week holiday. They reopen tomorrow. The Hang Seng, for its own account, was up 1.6% overnight. It's up more than 26% since China began announcing those stimulus measures late last month. Coming up, what is ahead for Boeing as the company resumes talks with its union workers today to reach a deal? Plus, TikTok's latest ad strategy could be a blow to Google. More on that later. Spark Hawks will be right back.
All right, welcome back, everybody. Check out the futures this morning. We've been under pressure all morning long. Dow futures down by about 200 points. S&P futures down by about 35. The NASDAQ indicated off by close to 140. There have been some weakness in some of the mega cap tech names, and that's why you see weakness across all of the major averages. But this does come after 4 weeks in a row of gains for the averages.
I want to talk about today's big corporate stories, including this one. Activist Starboard Value. It's now taken a roughly $1 billion stake in Pfizer. It's seeking to mount a turnaround at the struggling company. Joining us right now is Paul Argenti. He's a professor at Dartmouth College's Tuck School of Business. I want to get your reaction to news that Starboard is involved in this and maybe pushing for change. This is a very different kind of activist attempt, if you will, because oftentimes activists are looking for some kind of financial engineering approach. You can spin something off, you can sell something, you can have a buyback, you can have a dividend. In this case, especially in the drug space, it seems like you need to actually invest money.
Yeah, I think that's true. I think the problem here is that Pfizer really hasn't come around since making so much money on COVID, and they're banking on the fact that the drug industry is the most profitable industry in the world and has been for the entire 43 years I've been at the Tuck School. And if someone were to try to put some time into it, they could figure out a way to make the company more profitable than it is. And that's not a bad bet. And I think they're actually working with former CEOs and have some inside track on this, which might make it better for them.
Sure, and I think one of the pieces of the reports that we heard was Ian Reed, of course, former CEO of the company, also their former CFO, could be involved as well. But the question that I would ask is, what kind of turnaround and what kind of timeline could investors expect in regard to a real shift in profits, given that this is a company that, as we said, has struggled on finding the right weight loss drug that works. They've made big investments in the cancer space, but some of those bets are not going to pay off if they do at all for many, many years.
Yeah, it's going to be a long play for sure, Andrew. And I think that's the problem, that if you decide to get into this, you're looking at a very long haul before anything is going to happen. And that seems to present major problems for those trying to invest in Pfizer at this point, for sure.
And so does this make sense as a activist target, if you will?
Doesn't make any sense to me at all. I was surprised to see the news this morning. And I think what we need to look for is maybe they know something we don't know. I mean, I'm not sure what that would be. And this isn't a company that hasn't made a lot of money in the past. So making a bet on the long term could be what they're looking for, and that's not a bad bet.
How do you feel about bringing back, for example, a former CEO? And I don't know if that's the plan, or if they're going to push for something like that, or if that's just about having somebody like Ian Reed advising them on the side as a consultant, whether it's about trying to push for board seats and putting somebody like an Ian Reed back into that room and what that would do. We have had this sort of springboard-like effect where we've had CEOs come back and back and back and back. Is that the right answer?
I don't think so. I mean, I don't think that's going to make a difference here. And it isn't like Borla has done such a bad job, right? He's not a terrible CEO. The company isn't in ridiculously bad shape. I'm just stunned by what's going on here and not completely sure what their plan is. Probably same as the truth for you.
Well, and to the point I think that Becky made in the 6 o'clock hour about Albert Bourla, I mean, he was heralded during the COVID crisis for moving mountains that seemed unmovable at the time to get those vaccines created and made and distributed. The question is, can he do the same for the rest of the business, if you will?
Yeah, I don't think there's much difference between him and the previous CEO in trying to make this happen. And I guess I would give him a little bit more rope before you hang him. And I don't think we're there yet. I'm kind of surprised this happened so quickly. And again, is there something we don't know that's going on behind the scenes that these guys have more information about? Not sure.
Paul, it's always great to get your perspective, especially when news is breaking like this. Thanks for joining us this morning.
Thank you.
Thank you.
All right, coming up, a look at the response to Hurricane Helene's destruction. We've got Congressman Chuck Edwards will join us straight ahead. We'll be right back.
The Wall Street Journal reporting that Shein's founder and CEO is heading to the United States this week, meeting with potential investors ahead of its IPO in London. The Journal says Sky Shu is meeting with investors in the UK today before heading across the Atlantic. It will be the first chance for large institutional investors to meet with Shu, who rarely makes public appearances. Andrew?
When we come back, North Carolina Congressman Chuck Edwards is going to join us for an update on the relief efforts after Hurricane Helene's devastation. We've got a lot more on Squawk Box coming up. Do not go anywhere. You're watching Squawk, and this is CNBC.
Welcome back, everybody. Hurricane Helene has left a path of destruction across the South. Over 200 people are dead from the storm, and efforts are underway to repair roads, bridges, and restore power for tens of thousands of people. North Carolina was particularly hard hit, experienced the worst flooding in a century there. Our next guest is in on the front lines of the storm damage and the relief efforts. We want to welcome Congressman Chuck Edwards of North Carolina's 11th District. That's in the western part of the state, including parts of Asheville that were hit so hard. And Congressman, first of all, thank you for joining us this morning. We know you're on the front lines. We know this is a horrible tragedy, but tell us where things stand right now.
Well, we got off to a slow start with getting assistance in here from our national and state agencies. They are here now in full force. We've seen widespread damage beyond anything these mountains have ever seen. Not only flooding, but trees down, homes destroyed, roads, bridges washed out, major arteries in and out of North Carolina cut off. Folks in neighborhoods that we still can't reach, widespread power outages. I believe we still have well north of 100,000 energy customers that do not have power, sporadic communication. It's really a desperate situation here in the mountains right now.
we mentioned that this is the worst flooding in over a century in that area. Why do you think it's taking so long, and why it's been so hard to get the rescue efforts under control there?
I can't explain why it's taken so long. Those are definitely questions that I'll be asking once we're far enough into this that I feel comfortable in pulling resources aside to begin to ask those questions. It was more than 3 days before we ever saw the first folks in here from FEMA, before we saw the first sign of any significant resources. But we're well underway now. I'll tell you what really encourages me is the way that the mountain people here are pulling together. We see churches, civic organizations, neighbors, so many people pulling together, helping one another in a way that we've never had to do before.
Congressman, you're there on the ground. I'm watching from afar, and I look for images anywhere I can, look for stories anywhere I can. A lot of that has been coming on social media. And some of it is incredibly concerning, saying that volunteers are being turned away, that FEMA is taking, and still this morning I was looking at these, that FEMA is taking and confiscating things that have been brought in. But then I looked to the News and Observer in Raleigh, the local paper there, and they put out something saying that emergency officials responding to the Hurricane Helene disaster in western North Carolina say false rumors on social media are impeding their efforts to help tens of thousands of people in need. The quote is, false information is being shared on social media channels, including AI-generated content and images. Nefarious actors and those with ill intent may be taking advantage of the situation by spreading false information. So again, you're on the ground. Can you help us understand what's really happening?
Yeah, those rumors are totally unsubstantiated, and it's so unfortunate that at a time like this, where we need to be pulling together and being truthful and working on real solutions, we've got some nefarious folks out there that are trying to make a name for themselves or see what they can stir up on social media. I'm not going to come to FEMA's defense. They've done some things that they should have done differently. No question about that. We'll deal with those issues. But the response that I have gotten has been very positive. And where there have been kinks, where I've stepped in and applied a little pressure, I've seen response.
Yeah, I know that you asked for cell towers to be brought in instantly, and once you asked for them, they were brought in. What else do you need right now?
Right now, we need still roads cleared and power restored. We've still got pockets that we cannot communicate with, so we need more and better cell service. Those are the real issues right now. We're beginning to see quite a bit of food and water and cleaning supplies and those types of things show up in large quantities, and we've got so many volunteers out there willing to help distribute those. We could always use volunteers. We could always use more resources if someone wants to send those. This is just going to take a little while to be able to reach the power stations that are not working and the folks that we can't get to. I'd be remiss too if I...
Oh, sorry, go ahead, sir.
Yeah, I'd be remiss too if I didn't mention that there's still a lot of missing people. We still got teams here from all over the country that are combing through rivers and cars that have been submerged and piles of debris. We're still finding hits by cadaver dogs. We're still in a recovery mode in regards to those that are missing.
Very much so. There are people who would like to help. I know it's a concern about having too many people coming in when the roads that are open, those major arteries, are kind of reserved for the emergency workers and the emergency crews to get some of these things through. Is there somewhere that you would direct people? I know the governor had mentioned the North Carolina Disaster Relief Fund. Is there a place if people want to help, that something they can do rather than show up in person if you're worried about looting, if you're worried about making sure emergency workers can get through?
Yes, certainly, and I appreciate you asking that question. If anyone goes to my website, my official website, edwards.house.gov/helpwnc, that's edwards.house.gov/helpwnc. There's a comprehensive list of places there folks can contribute to. volunteer their time or send resources.
There had been questions about whether House Speaker Mike Johnson would bring Congress back to increase the amount of funding that goes through to emergency. Do you know anything about whether that's going to happen at this point?
I don't think that coming back in for a special session right now is necessary. We had the foresight before we adjourned for our October work period to make sure the government was funded, but also we added $20 billion for disaster recovery. So we've got funds to get us into the initial phases of this. There's no question once we come back into session in mid-November, we're going to have to take up the issue of a supplemental and look at what needs to be done, not only here in Western North Carolina, but around the country with some of the storms we're experiencing right now.
But no question, there is emergency funding right now. And again, people can help by going to your webpage to look for the appropriate places to funnel any help that they can give.
Yes, most certainly. Thank you.
Congressman, thank you very much for your time. We appreciate it, and good luck. We are watching.
All right. Thanks for your interest.
Thank you, sir.
All right. Good morning.
It is 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. And among our top stories this morning, activist investor Starboard Value has taken a roughly $1 billion stake in pharma giant Pfizer and is looking to mount a turnaround at the company. That's according to people familiar with the matter who spoke with CNBC. Starboard's exact plans are unclear, but sources said the investor has approached Pfizer's former CEO and CFO as part of its efforts. Chevron is selling oil assets in Canada's province of Alberta to Canadian Natural Resources for $6.5 billion in cash. Those assets contributed about 84,000 barrels of oil equivalent per day to Chevron's production last year. The sale is part of the company's move to divest up to $15 billion worth of assets by 2028. And Hurricane Milton upgraded a short time ago to a Category 3 storm as it churns towards cities in the southeastern United States, still working to clean up from Helene's damage. Hurricane watches for parts of Florida are in effect. The most likely path of the storm at this point suggests that it could make landfall on Wednesday near Tampa Bay before moving across Florida and into the Atlantic Ocean. A lot of people watching this very closely, just the geography of Tampa Bay, what a storm surge, a significant storm surge there would mean. It's never taken a direct hit from a hurricane before, but obviously coming so quickly after Helene and the damage that was left, lots and lots of concerns and people being asked to evacuate now.
Futures are down this morning, and treasuries, we have a 4% 10-year, what we did earlier. We'll take a quick look. To Mike Santoli at CNBC headquarters. Mike, what if rates, and even the 2-year is up, what if rates keep going up? I mean, what if they went up significantly? I mean, people point out the auctions are still big. You need to attract people to fund a lot of the needs of the government, and you could theoretically see rates continue to rise even if the Fed continues to cut.
You could, absolutely.
Is that bad?
Get that re-steepening move. I don't know about bad. I mean, at least from these levels, it doesn't seem like it's necessarily very threatening, although it has been a really quick round trip. Let's first take a look at the S&P 500, because in general, markets are absorbing a much better than expected jobs report on Friday and what it means for the Fed, for rates, and for earnings. And essentially, we've called off the growth scare. Like the S&P 500 is coming from a position of strength, call it the 21 by 21 market. It's up 21% year to date. It's also trading above 21 times forward earnings. It's flattened out here in the last little while. We haven't really gotten a lot of upside, about 1.5% above the mid-July highs, but that also was around 21.8 times earnings. In other words, we're holding the valuation because earnings estimates are going up. In fact, from 6 months ago, the forward 12-month estimate is up 7%. So we're able to hold it with the Fed cutting and with the economic numbers coming in better than expected, even if seasonal and valuation and geopolitical factors are keeping risk appetites at bay to some degree. How about a look at the 2-year note yield, as you were just talking about? That is a very violent U-turn that we've made in yield. This was the growth scare that started at the July jobs report in early August. We had basically 2 months of, oh no, maybe the economy's faltering, maybe the Fed's going to have to do much more. We're pricing out about a 0.5% percentage point total of potential Fed easing going through the cycle here versus what we were looking at on Thursday. So clearly it's a moving target. But this shows you what levels we're coming off of in the 2s. And you know, the 10s are about the same level. So it shows you like around 430, thereabouts 4.25 on the 10-year seems to be when it gets real in terms of figuring out if stocks have to be a little bit concerned about that. Also, this is looking pretty stretched in the short term. You wouldn't be surprised to see it settle back before too long. Take a look at the volatility index. I mentioned this just general sense of caution and reserve and unease that we have here. We're up here in the low 20s, even with the S&P basically at a record high, and with actually some calm action in the index last week. It just shows you people are getting pre-hedged. It's really a lot about October and making sure that that they kind of keep buffered against some volatility through the election. We'll see if we get a release from there, guys.
All right, Mike, thank you so much. We want to continue this markets conversation with a guest we haven't seen in a while. Abby Joseph Cohen is a former partner and chief U.S. strategist at Goldman Sachs, now a professor at Columbia Business School. And Abby, thank you for coming in today.
Good morning.
We look to you for big calls on a lot of different issues, and the way Mike just set things up, I think, is a pretty great way for starting. We are looking at new highs. You could say valuations are stretched, but then again, there's not a lot of volatility that leads into this. What do you see when you look at the landscape?
Well, you know, Becky, it's an interesting time because we've had market strategists just recently lift their targets again, not just in the United States, but also in China. And in some ways, they're kind of looking at the momentum. And I always, as you know, like to look at midterm, long-term kind of issues. And from my perspective, I think we're now in a trading range. And there are a few reasons for it. You know, I look at the fundamentals, which are not bad. I think the U.S. economy is in very good shape. Corporate profits this year are in good shape. But a lot of that good news is already baked into the market. I also take a look at the consensus forecasts that are being used for S&P earnings for next year. And many of them are expecting additional earnings growth of 10 to 12% from the strategists, even more than that from the analysts. That represents an acceleration from this year, even though the likelihood is that the US GDP will be growing more slowly next year than this year. We're seeing roughly GDP growth, real GDP growth now about 3%. It'll probably ease off a little bit to about 2.5%, certainly not a recession, but it's kind of hard to argue that profits are going to accelerate dramatically. And then, of course, there's the valuation question. Valuation is already pricing in some very good news, and that's for the overall market. And of course, there are some sectors that have some issues. My real concern, however, has to do with some of the geopolitical things that we look at. And I start with the US election. Historically, if you go back many cycles, you see that the US stock market does pretty well after a major election. There's a sigh of relief, and also most people feel that their candidate has won. This year, I'm not convinced it's going to be a sigh of relief rally. In fact, if anything, I'm quite concerned about what happens if there is agitation of any sort following the election because of uncertainty about results and so on. So that, to me, is a concern.
Because it's so close, because there have been questions raised about the potential for tampering.
Exactly.
That half the country is going to feel like they got robbed or ripped off.
And there will be candidates out there, not just at the national level, but state and local level, who are already talking about tampering, even though there's no evidence of it. And that's something that concerns me. We also, of course, need to have thoughtful conversations about policy going forward. Either way, we're going to be having a new president with different priorities. And I do very much worry about some of the policy changes that we could be looking at. Some of the ones that have been discussed by some of the candidates look fine to me. Others are quite worrisome.
Which one's concerned?
Well, you've been running a Chiron this morning talking about the forecast, the estimate that's been done by an outside group saying that the Trump plans would add $7.5 trillion to the budget deficit. That's a pretty significant number. I haven't done the numbers myself. I think it's very hard to do so until you actually see legislation and so on. But one of the things that I'm quite concerned about has to do with tariffs. Tariffs are not paid from the country of origin. They're paid ultimately by U.S. consumers. And there's one other thing that us policy wonks are focused on that to me is very, very troubling in terms of ultimate economic activity, and that has to do with so-called Schedule F plans from the Trump administration. This is something that was put in place at the end of the first Trump administration, something that's discussed in Project 2025. I know that President Trump has disavowed Project 2025, but there are so many of his people behind it, I think we have to look at it seriously. And what does it do? Schedule F basically says, okay, we have 10,000 political appointees in the federal government. What they will do is reclassify an additional 40,000 jobs to become political appointees. And who are filling those 40,000 jobs now? They're basically the subject matter experts, the people who make things run. You know, the Congress will do some legislation, but somebody in an agency has to decide how that will be implemented, number one. And number two, you want people who are scientists, you want people who are experts in whatever category it is, basically making those decisions, not an additional, in my view, 40,000 political appointees.
Valid concerns to be thinking around these things. There are people who also look at the Harris campaign and say, if you start taxing unrealized gains, what will that mean in terms of market potential sales down the road? How do you figure that out? All these things are, again, talked about on the campaign trails. It's hard to go in and dig into details on these things, but I have heard people concerned and say that the market might sell off.
Right, that would be a concern, and you said it in just the right way. How do you figure this out? I have never figured out how you can actually compute what those untaxed returns would be, those unrealized gains. And so this seems to me to be one of those proposals that just doesn't really...
You don't care about corporate rates? You think 28's okay?
The corporate tax rate, Joe, as you well know and has been discussed here many times, has been that the statutory rate is not the effective tax rate. The current effective tax rate is probably on the order of 18%.
So it's low enough in your view?
It's one of the lowest in the developed economies, and we have seen fabulous corporate profits, which have been benefiting from this low tax rate. Will the corporate tax rate go up substantially under a Harris administration? I don't know. I'm not connected
Capital
to
gains?
The capital gains tax rate is something that is also obviously being discussed, but the thing that actually collects more money has to do with growth, which historically has been the way the U.S. economy has grown and has the federal
Then we'd have to talk regulations.
That's right.
How about the filibuster?
Let me just finish the point. The federal revenues have typically grown best in the United States when the economy has grown. And having read the documents from both campaigns, what the Harris campaign includes are many different proposals to grow the economy. It's not just housing, but it's also credits for manufacturing and a variety of other things that would get the economy moving in a stronger way.
So government assistance for the private sector you think is more important than less regulation?
The regulation that we have in place is not perfect. We all understand that. However, I think that when you look at other economies where regulation has receded, there are problems. So for example, I believe that we do need regulation focusing in on making sure that the free market, I'm a capitalist, I believe in free markets, but any economic historian will tell you that an unbridled free market creates problems. And I think that some degree of regulation is appropriate. I'll give you just one example. We had some breakdowns in regulation which helped trigger the global financial crisis. And we have had some adjustments to that since then. And we have largely avoided big problems. Now, we can talk about Silicon Valley Bank and so on, and many people will point to that and say, the regulators weren't doing their job. So to have a situation where regulation just basically eases even more in some industries is problematic. And I think you need to look at it industry by industry to make a determination.
It's just not a huge leap for a lot of people that the co-author of the even bigger Green New Deal, along with one of the most liberal voting records in the Senate, isn't immediately thought to be pro-business more than what we saw in the first Trump presidency.
Yeah, well, you know,
I mean, it's just not a given that someone's going to just nod while you're saying that.
Well,
For me.
Yeah, sure. No, I hear you, and I think we also have to recognize that the last time Vice President Harris was in a national campaign by herself, she was in the primary. And what we know in any primary situation, whether it's the Democrats or the Republicans, there will be people who will lean over in one direction to appeal to their base. And I think as Vice President and looking at how the Biden administration has governed the economy, it's been pretty good. The 3 legislative accomplishments address major long-term deficits in the United States in investment. We weren't investing enough for 40 years in public infrastructure. One of the major pieces of legislation addressed that. The CHIPS Act addresses investment in semiconductors and science. And you asked about, you know, the so-called Green New Deal. The IRA legislation does address investment in green energy, but it also addresses how do you enhance all energy and how do you mitigate climate change. By the way, the other thing that the IRA does address is keeping pharmaceutical prices as low as possible.
Abby, before we let you go, with all of these questions and big issues, why is the VIX not more active? Why is there not more volatility? And what would you tell people to do ahead of the election, invest or not?
Yeah, I think the VIX has done what it's done because the underlying fundamentals of the economy have been solid. You know, this is an economy growing at 3%, creating jobs. Inflation has come down from about 9% to roughly 2%. So investors.
But if all of this is resting on this election, if you're that convinced of it, what would you tell people to do ahead? Buy or not?
I don't think there has been a change in focus yet. I think right now investors are looking very much at the economic data coming out right now, the corporate profit data likely to be reported over the next few weeks, and it looks good. This economy is actually very, very solid. We have a friendly Fed now, and I think investors are just looking at that, and when they turn their attention to some of their other issues, I do expect the volatility to increase, and I think that that's when you see that this is more of a trading range. Do I hope that equity prices ultimately move higher? Of course I do, but I think we need to be realistic about what the next several months might bring.
Abby, thank you for coming in. Abby Joseph Thorne.
Okay, coming up, author and former Bush administration foreign policy advisor Dan Senior is back to help us take stock of the evolving situation in the Middle East exactly 1 year after the Hamas attack on Israel. Stay tuned. You're watching Squawk Box, and this is CNBC.
Good morning, Jim.
Welcome back to Squawk Box. Both Hamas and Hezbollah targeting Israel on the anniversary of Hamas's October 7th massacre. Hamas said it fired missiles at Tel Aviv. Hezbollah rockets hitting Israel's third largest city in Haifa. In Gaza, Israel's military say it launched attacks overnight to stop what it called an imminent attack. Airstrikes also hitting Beirut's southern suburbs where Hezbollah has its headquarters. All of this coming on or just now ahead of the anniversary of the Hamas attack last year when militants killed 1,200 people and took about 250 people hostage. Israel has pounded Gaza in the year since, killing more than 40,000 people. Israel's also targeted Hezbollah in Lebanon recently and, of course, killed that group's leader. Commemorations by Jewish communities around the world due to take place today, as well as pro-Palestinian demonstrations, including here in New York. For more, I want to bring in Dan Senior. He's former foreign policy advisor to the Bush administration. He's the co-author of The Genius of Israel and host of the podcast Call Me Back. And before we get into any of the geopolitical questions, I just wanted to take stock of this moment since you have been literally in Israel on the phone and talking and thinking about this from the moment it happened.
So I cannot believe we're a year later. If you think about where the world was, say, on December 7th, 1942, year after Pearl Harbor, or where the world was on September 11th, 2002, a year after 9/11, it's not the conversation that we are having here in the United States. In the United States today and in many parts of the world, as you talked about Jonathan Greenblatt earlier today, Jews are scared. There's a sense of this sort of the end, what we've experienced over the last years, what I think is sort of the end of the American Jewish golden age, where it's not just that Israel was under a genocidal threat, the equivalent of 33 9/11s, the equivalent of proportionately 44,000 Americans slaughtered in one day, the worst day for Jews in a single day since the Holocaust. As though that were not as shattering as it was, the past year has just been an incredible wake-up call. I have a son who visited the Gaza envelope, the Jewish communities in southern Israel with our family last April over Passover, and he compared it to visiting Auschwitz with my mother, who's a Holocaust survivor, 86 years old, the previous summer. And he said visiting those communities in southern Israel after October 7th was harder than visiting Auschwitz, as awful as Auschwitz and the Shoah and the Holocaust were. And it's not taking anything away, obviously, from the Holocaust, but what he was saying to us is that he just didn't expect in his lifetime. You study what happened in the Holocaust, that was like another era. He just somehow thought the world had been enlightened, modernized, more civilized, and then you watch the barbarism that happened in those communities, those attempts to just wipe out the Jewish people again. I just think it's a loss of innocence for a lot of Jews, especially young Jews. And so it's not just thinking about October 7th, although we are, it's also thinking about what we've learned about Jewish life outside of Israel since October 7th.
Well, that's a question. How do you think it has changed, and do you think it's changed irrevocably?
Well, look, on October 8th, 30 student groups at Harvard University issued a statement holding Israel entirely responsible. University after university after university, we start to see this kind of action. Protests in this country, not just calling for a ceasefire, but waving flags of Hamas, now expressing solidarity with Hezbollah. And I think that many Jews here feel, and I hear this all the time, and you see it in the survey data, they look around at their community organizations, they look around at the workplace, in corporate settings, in various professional settings, and they say, it's not just what happened on October 7th was horrendous, it's that there's a tremendous lack of empathy among people I work with, among people I've been involved with causes for the last number of years. I thought we were, shared the same values, and suddenly I'm starting to question whether they have my back. And I think that is not fixable quickly.
Let me ask you a question, though. There are going to be protests today, and there are going to be protests all week. And some of those protests are going to relate not to what happened on October 7th or October 8th, but what's happened in the time period since. And we talked about 3,000 other people dying in Gaza, and how that and people's views of Bibi Netanyahu and views of how Israel has tried to defend itself.
Yeah.
And what that does to the psychological impact.
I just think it's, first of all, no country should escape fair criticism, including the Israeli government. I've been critical of things the Israeli government has done since October 7th and long before October 7th. But when you look at what Israel's going through, which is now facing a 7-front war by all these different entities and organizations, most of which have no territorial dispute with Israel. It's not like Hezbollah is saying, if we just cut a deal with Israel, we'll all be good. It's not like Iran is saying, we just need to reach a diplomatic accommodation with Israel and we can both exist in the Middle East. They're very clear that they're implementing an annihilation strategy, to borrow the Iranian regime's terms. And so it's a 7-front war. Israel's under siege from every direction. We've seen what happens if Israel doesn't have the defense capabilities in place. We saw what happened on October 7th. We now know Hezbollah want to do the same thing from the north. What Israel right now is doing is restoring its deterrence capability in the region and removing the capabilities of its enemies. No other country would be asked to do anything different, and Israel should not be held to a different standard. It doesn't mean that it doesn't make mistakes. It just means it's doing what any other country would do.
If the stated intention is to obliterate Israel with the nuclear weapon, and they're a week to 2 weeks away if they decide to go forward with it, how can Israel not do the nuclear sites now? And do you think that's what's going to happen?
I think Israel wants to deal with the nuclear threat.
Don't you have to eventually?
Yes, and I think the question is whether or not Israel has the capability to do it. I think Israel has the capability to do real damage to Iran's nuclear program, slow it down 1 to 2 weeks away. Maybe they can slow it down to 1 to 2 months or 1 to 2 years. I don't know if Israel has the capability to actually eliminate it. I do know one country that has the capability to eliminate it, working alongside Israel and Israel's Sunni Gulf allies, and that's the United States government. And I watched, for instance, Vice President Harris's interview on 60 Minutes, or clips of it, in which she's asked about Israel's behavior and whether or not the U.S. has lost its ability to influence Prime Minister Netanyahu, which I think is besides the point. I think the correct answer to any of those questions is, what's the U.S. interest in all this? The U.S. has an interest in preventing Iran from wreaking havoc in the Red Sea and sabotaging international shipping. The U.S. has an interest in preventing Iran from getting a nuclear bomb.
Dan, I mean, I hear everything you're saying. We had Admiral Stavridis on this morning, the former NATO Allied Supreme Commander. He absolutely thinks we need to defend Israel at all costs, but I'm not sure he would advise that you go after the nuclear option. His point was, Iran is 3 sides the times of Texas. There are nuclear installations all over that territory, many of them buried 3 stories below the ground, and if you can't take it out, all you're doing is setting it up so that their 2,000 plus other anti-ballistic missiles are targeted immediately at Israel. And you're right that Israel has every right to defend itself. It's a different thing to ask the United States to come along every step of the way.
I think the question is, at this point, for Israelis and for the U.S., is what is the practical reality of Iran having a nuclear weapon? That is the question. Iran is becoming the hegemonic power in the region. We've started to see what that looks like when they can light up the Houthis to attack civilian vessels, civilian ships, disrupt international shipping, kill Americans. We've seen what happens when what they can do to Israel. And you see
your
what
point
happens
is
to the
there
other
is no
countries.
going back. There is no going
so
back.
the question is, and the question is, at this point, look, at this point, Israel has made clear it is not going to sit there and be curled up in a ball on the floor waiting for Iran to continue to light up these proxies against Israel. So Israel is pushing back. If ever there was a time that Iran was going to race to a nuclear bomb, I think it would be now.
This would be it. But the question is, would Israel be prepared? I mean, the question is, if there's 2,000 missiles that rain down on Tel Aviv, whether Israel and with the U.S. can sustain that, right?
Yeah.
I mean, that's part of the calculus.
Obviously, I don't speak for the Israeli government. I don't speak for the U.S. government. I can't tell you that these are risk management decisions they have to make. My sense in talking to Israeli officials, though, is they feel that they've crossed a threshold here where they cannot. The idea that they can learn to live with a nuclear Iran is absurd, and many officials in the U.S. government feel the same way. It's just unacceptable.
And they think they can take it out. They think they can do it.
The U.S. can certainly take it out. The question is, will it work with Israel to do it?
We got to go, but before we do, there are a lot of business leaders and policy leaders who watch this broadcast, and I think on a day like today, they could use your thoughts on how to talk about this. Because I do think we were talking about DEI programs and a backlash and all the things that have happened both at educational institutions, but also inside big companies on Slack
Yeah.
Slack messaging and the like.
I would say to business leaders, anyone in a professional workplace, this is not the day to talk about politics. It's not a day to talk with your employees or colleagues about geopolitics, Jewish employees or colleagues. It's a day to check in and see how they're doing. Because I guarantee you, every single one of them knows someone who was killed on October 7th, or knows someone who's being a family member, or knows families who have loved ones who are in the dungeons of Gaza today, or know people who know people who know people. The nature of the Jewish community is everyone is just a couple steps removed, a couple clicks removed from life in Israel. Just ask them how they're doing. Show a little bit of empathy. This is not a day to finger wag or second guess.
Dan, every step along the way, I think Netanyahu has done more than people thought, and more than what the United States probably wished he had done every step of the way. I think it's going to be this way this time too, and if it is, when do you think it? Do you think he will go after the nuclear sites, and if so, when? A week? 2 weeks?
So, first question, I think Israel will either hit some of Iran's nuclear sites or its oil infrastructure. I think one of those two are going to get hit, or both. I think it's going to be soon. Yoav Gallant is headed to Washington, D.C. to meet with Defense Secretary Austin. He's the Defense Minister in Israel. I don't think it's conceivable that Israel wouldn't hit while the defense minister is here, but I don't know for certain. I think it's going to be soon. I think it's weeks. We're not talking about months away. There's some within the Israeli security establishment that are fine with letting Iran sitting there being nervous, questioning when Israel will strike. So I don't think they think that time is a disadvantage.
Dan Senor, thank you for coming to this morning on this important day.
Thank you.
Coming up much more on the U.S. economy as investors get ready for inflation data this week. And automation was a big sticking point in the East Coast port strike. That issue was punted to next year's deadline. After a break, we're going to hear how automation is already affecting operations at West Coast ports. Stay tuned. You're watching Squawk Box on CNBC.
really matters.
You know, by now union workers and East Coast port operators have an interim deal on wages for the new contract. That ended a recent 3-day strike, but both sides are now looking ahead to the January 15th deadline for a master contract, and automation will be a key challenge. Kate Rogers joins us now with more from the Port of Los Angeles, where automation already in use and workers negotiated a new contract just last year. Good morning, Kate.
Hey Joe, good morning. Automation, as you said, will really be front and center over the course of the next few months for dock workers on the East Coast as those negotiations continue. Now, last Friday, the ILA said it wants more clear language related to automation at the ports, writing in part, quote, the ILA negotiated restrictions on automation and semi-automation in the last contract. The ILA just wants to tighten the language that no automation means no automation. Now, as you said, at the Port of LA, where we are live today, automation is in use, and this port is among the most automated in the country. But only about 3 to 5% of global ports are fully automated, and foreign ports tend to automate more quickly, and that's due to higher volumes and different labor situations, including ship to ground in the US compared to ship overseas. It's a delicate balance, of course, between boosting productivity for workers and retaining jobs.
When it comes to the jobs that are here today and those that are seen into the future. There's a lot of this that has to be handled with tough conversations, but getting around this corner and over these hurdles is going to be paramount for the American economy.
Now, California port executives that we've spoken to are really quick to point out here that automation isn't just a silver bullet. It does take years to implement, massive CapEx to put out and then recoup. But one thing is for sure, these West Coast ports are extremely busy. Take a look at this. For example, in August, the Port of LA was 17% ahead of its 2023 pace, moving 1 million more containers than last year, and that was just 8 months into the year. Becky, over to you.
All right, Kate, thank you. You know, we do have some questions about this. I guess some people are wondering, how do we have a sense of the use of automation, what it's done to jobs on the West Coast? Not to mention that our ports are not nearly as set up as things have been in the past, just for automation in other areas too.
Yeah, absolutely. So as we said, the West Coast workers did negotiate a new deal last year. The terms of the automation clause in its contract not publicly available, so it's hard to say how specific they were in terms of what is in use and what isn't. Two different studies, of course, showed two different things. There was one commissioned by the parties that represent the workers that showed an annual loss of about 500 jobs in 2020 and 2021 when automation was introduced. But then a separate study that was commissioned by those who run the ports showed that between 2015 and 2021, that paid hours for unionized workers here went up by over 10%. As automation was started to be implemented here. So, of course, it's kind of hard to tell, you know, whether or not it eliminated jobs. You know, advocates for automation will say that it just changes the jobs. Jobs don't entirely go away. They're safer, they're different, and you still need people behind this technology. So we will see how that shakes out on the East Coast.
Kate, thank you. On the waterfront this morning. When we come back, TikTok and other companies are threatening Google's dominance in the lucrative search advertising business. We're going to talk about what that could mean for the tech giant. Stay tuned. You're watching Squawk Box, and this is CNBC.
Google facing more competition in its bread and butter search advertising business. Who? Well, like TikTok, Amazon, and now potentially AI companies. That's a story that was detailed in the Wall Street Journal this past weekend. Joining us to talk about it, Rich Greenfield from Lightshed Partners. Google, I don't know, the demise of Google and search and advertising has been greatly exaggerated over and over again. I'm not shedding any tears yet, Rich.
Joe, I mean, that's exactly right. I mean, at the end of the day, there has been a fundamental shift in how consumers use the internet, especially younger consumers, for years now. You know, Amazon eating into, how you search, like people going directly to Amazon to search for a product, people going, directly to Pinterest to find inspiration for something. I mean, we've seen major shifts in how people search, and Google, obviously, Joe, as you pointed out, Google's done incredibly well over the last 5+ years, even with this change in behavior. I mean, think about the rise of TikTok. So many people, you want to go out for a night in New York or a night in LA, people are searching on TikTok what to do. I mean, those behaviors are not new, and they're really separate from the AI discussion of, as we move to an AI world and, search.gpt and what OpenAI is working on, Perplexity, what Google's doing with Gemini, what search looks like, or what ultimately search looks like, whether we even type, Joe, it may all be voice driven. I mean, I think there is such an evolution of search behavior and therefore search advertising. And I think that unknown is hard for people to deal with. On the flip side, you look at how Google has fully integrated all of its products. It's hard not to believe that Google's a winner. It's just a matter of, do they lose some share as this transition occurs?
Well, I've done it a few times, and it is sometimes it takes a little bit longer just going to the building blocks you get from Google, and you can go to an AI, a Perplexity, or whatever you prefer, and it will put it together maybe a little more quickly or coherently. But doesn't Google still, isn't it search, don't they get something from Perplexity, searching Google to find what they generate to give to me?
I mean, look, those are big questions of sort of how all of these platforms work together and who turns off the ability to scrape answers and how compensation works. And even in a world where you do get those answers, I mean, you saw last week, Google's now putting ads, they're doing these AI summaries. So you ask, how to get a stain out of a carpet, and Google is giving you answers literally within that AI generated synopsis at the top of the page. They're giving you not just links out to third-party sites the way they always did, but they also are giving you actual ads for products. Now, what will the click-through rates be on that? What will, how will it change where you end up on the internet, and what does that mean for winners and losers? And I think, there's this whole category, Joe, of search engine optimization, SEO, and that whole business feels like it's going to change over the next decade, because you're going to have to tune it to what an AI world looks like. You have up on the screen, whether it's OpenAI or Anthropic, like all of these platforms, they're all vying for, where do you go when you need to, to find something, learn something, where do you go first? And I think the real challenge is, we're so conditioned to go into Google, not to mention if you have an Android phone, it's built on Google. It has, Android and Google Chrome built in. That is a huge advantage versus all of the other platforms. The question is, will searching on these other platforms be so much better to get you not to use Google? That's the real, multi-trillion-dollar question. Nobody can answer that today. Obviously, Sam Altman and others are trying.
Did you watch last week where we asked AI how it would monetize itself? And it actually was pretty smart about how to do it. And you're not, the subject is not supposed to be able to figure out the object or vice versa or whatever it is, or some principle in physics where, you can't analyze your brain. We may never understand the brain because we're using a brain to try and figure out the brain.
Joe, how long before we don't need either of us? I mean, how long until just having a computer talk to itself back and forth and you don't need Joe and Rich?
I'm back to thinking that true consciousness and sentience might be further off than we think. Unless, I mean, are all these AI programs going to be they're going to be neurotic like all of us? Are they ever going to really be like us? I can't imagine. I hope not.
No, but they're certainly getting smarter. The pace of evolution.
Getting smarter.
The pace of evolution is
so smart
really
now.
incredible.
They really are.
I know, they remember things, but do they ever really put...
Yeah, I mean, just you walk around with these. You saw Zuckerberg.
Can they be insightful?
Yeah. I mean, if you've played with the new ChatGPT,
yeah,
it can be insightful because it's thinking. You know, it thinks before it's providing the answer. It's actually like a different approach. Instead of just spitting out an answer, it sits and effectively is running through multiple answers before it's actually running the answer, because it's trying to figure out which is the best version of the answer.
If you're ever just collating,
Which is how
you wonder if you're
our brains
collating information and putting it together, does it ever take the second derivative, that next leap, Rich, that you bring to us all the time? I don't know.
AGI is what you're talking about, Joe, and Andrew's sort of alluding to it, and that's obviously when you think about why Sam Altman converted this company into a for-profit and what the long-term goal is, whether you're at Google Gemini, whether you're at OpenAI or Anthropic, everyone is striving. Who gets to AGI first? First of all, is it possible? And then who gets there first? That will be rewards. That is the huge prize. And obviously someone like Zuckerberg, and you saw what Mark showed off last week, like video AI for free built into Meta next year. Like Llama is the sleeping giant that we don't talk enough about.
Right.
Okay.
I think Llama, but can I just ask Richard?
Yeah.
You said Llama. I'm also thinking, and we were talking to Walter Isaacson last week, you are focused on XAI. It has gone so fast, so far, so quickly.
Well, and it's got one advantage that no other model has, right? It's got access to everything in the Twitter fire hose, and that training data is invaluable, and nobody else has that. And so Elon's got something that could really be meaningful, not just to make AI or make the X platform better, but from an AI platform, what can Grok do? There's a huge opportunity for the team at XAI, and again, they don't talk a lot about it, but there's no doubt things like Llama, things like XAI are huge, and that's why it's so hard to figure out winners and losers right now and how behavior changed, because we're still, I know it's been a couple of years, but it's still so early.
Right. Rich, thank you, as always. When we come back, a lot more right here on Squawk Box. We're going to talk about the state of the economy coming off of Friday's hot jobs report with less than 30 days to go before the presidential election. Don't go anywhere. We're coming right back, and you're watching Squawk Box on CNBC. Welcome back to Squawk. A few big economic stories to get into with our next guests, including Friday's much hotter than expected jobs report and some new debt projections on the presidential candidate's economic plans. Join us right now, former Council of Economic Advisors Chairman Jason Furman. He's a professor at Harvard's Kennedy School of Government, and former Congressional Budget Office Director Douglas Holtz-Aiken. He's president of the American Action Forum. I was actually going to say, did you see the Marco Rubio tweets over the weekend claiming that these, that somehow these jobs numbers were sort of artificially inflated? Jason, I was curious what you thought of those numbers themselves and maybe what some of those accusations.
It's just sad when people respond to the jobs numbers that way. It's obviously incredibly nonpartisan, upfront people doing this. And interestingly, there actually was upward revisions to the previous 2 months. My hope is that they figured out whatever was causing the negative revision after negative revision and started to fix it. I'm not sure they have or not, but that's the type of thing they try to do. In terms of the number, yeah, it really changed the narrative that had been established 2 months ago when we saw the unemployment rate spike. There always was some temporary noise, temporary layoffs, hurricane, et cetera, going on then. And with 2 more months of data, the labor market looks full speed ahead.
And is your sense that this changes the outlook for Jay Powell?
Oh, certainly. I mean, it went from is it going to be 25 or 50 at the next meeting to is he even going to cut rates at the next meeting? Inflation is still way below where it was a year or two ago, and so rates should be way below where they were a year or two ago. So I'd like to see him continue cutting depending on what the data shows, but there's no reason at all that needs to be a rapid process, another 50.
Hey, Doug, if you were teaching an economics class, how would you grade this economy?
This economy is in very good shape in the near term, Andrew. There's no question about that. I think Friday's report was really good for the Fed. They had shifted the attention to the employment growth part of the mandate. That was a very strong report. It says that you don't have to worry as much about that as you might have thought, and they can continue to be looking at both the inflation and the employment mandate. I think it takes 50 basis points off the table, but I don't see them not cutting. They don't like to start and stop policy. So, I think they've signaled pretty clearly 25 basis points going forward. I was in the camp that thought they could do 25 to begin with. This just takes all the 50s off the table for the foreseeable future. And I think it puts a lot of pressure on the CPI report this week. I mean, they have made the case that inflation will return to the 2% target and remain there. And, core CPI is still anticipated to be 3.2 year over year, and getting it to 2 remains, in my view, an unfinished task. So they still have some work to do on the inflation front.
Jason, what do you think about the arguments that have been made? And these are political arguments, but maybe you'd argue they're economic arguments just about wages. That wages ultimately have not kept up with inflation, depending on what date you start at. Steve Leisman was here on Friday and used 2020 when the pandemic began as the date. Others have used when President Biden
he did pre-pandemic.
was named the president. He was doing it pre-pandemic.
2019.
Right.
Yeah. It's up since then, but it's
and
down.
How do you think that the American public should think about that?
Yeah, so I think the 3 facts that are correct are: number 1, wages are up faster than inflation. Number 2, a lot of those gains were in the year 2020. Number 3, even those gains are less than the normal pace. And I'll give you a bonus fact. Number 4, there are larger gains for workers who have lower wages than for workers who have higher wages. So there's been some compression of the wage distribution.
You're saying if you include the 2020 period?
If you include the 2020 period, yes, that last point included the 2020 period, which is when a lot of these real wage gains were. So yeah, I think there's some reason for people to be a little bit disappointed with this economy. Growth is fantastic, inflation is in the right direction, but people got themselves into a deep hole in 2022 and 2023. They're digging out of it with real wage gains now, but I think in some sense they're not all the way out. When I say not all the way out, that's relative to trend or expectations. They still are above inflation adjusted. So, I think for the Fed, that actually gives them more room to cut rates. It means some of the wage growth we're seeing is catch up with what happened before. So this is dovish information for the Fed. I don't think it fully explains how negative people have been about the economy, but it's a totally valid reason for people to be concerned.
Doug, you want to react to that?
Yeah, I think it's not too complicated. If you do it on political grading, you start in 2021 when President Biden took office, and we had low unemployment through 21, 22, but negative real wage growth. So people went to work for 2 years and got further behind, and they didn't like it a bit. And now that reversed recently, but not everyone has climbed all the way out from that, and they're still upset about their standard of living growth during his tenure, and that's all there is to it.
Jason and Doug, thank you for joining us this morning.
Thank you.
We're going to come right back after this with a lot more on Squawk.
Smith.
JP Morgan Chase and Wells Fargo will kick off big bank earnings on Friday. Joining us now with what to watch is David George, Baird Senior Research Analyst. The most important point that's happened recently, David, I guess, is the 50 basis point cut, bigger than people thought. And that's what could make this quarter a little better for banks?
And thanks, Joe. Good morning, and appreciate you having me on. The 50 basis point cut, from our perspective, on the near term is a positive. I think it's important that bank investors have been fretting a little bit about the prospect of additional 50 basis point cuts. The industry, Joe, from my perspective at least, would really prefer a more moderate easing in Fed policy, most notably more 25 basis point cuts rather than an aggressive number of 50 basis point cuts. And that is due to deposit betas and deposit movement. A more gradual easing, we think, in policy will be more well received by the stocks and from an earnings perspective. So the initial 50 is fine, but from our standpoint, the group would more likely prefer more 25, a little bit more less aggressive Fed over the near term.
Other than just the net interest income or whatever you get from a steeper yield curve, it helps with M&A, doesn't it? I mean, lower rates, doesn't it help there? Does it help with loan growth? Does it help with anything else that makes improvement in this quarter more likely across the board?
Yeah, so from a fee perspective, that is going to help, particularly in the fourth quarter. We think fee income expectations are going to be fairly healthy in the fourth quarter, as well as into 2025. So to your point, I think loan growth should show some improvement. Loan growth actually has been fairly slow. It's only been about 1% or so. So we're of the view you should see an improvement in loan demand as we go into 2025 with lower short-term rates. We think will help, as well as the fact that the economic data suggests that we're in kind of a no landing scenario. And also to your point, we should see an improvement in M&A activity to the extent that short-term rates are lower. So that will help. But it's important to also keep in mind that net interest income is about 70% of bank revenue. So that's going to help on the fee side. It's going to help the big guys. But for the vast majority of banks, that net interest income number is still going to be the most key determinant for revenues and earnings in 2025 and beyond.
It's the most wonderful time of the year, and it happens 4 times bank earnings, I think. And I didn't realize it was coming that soon, David. So we got, as I always say, we got that going for us, which is nice. Thank you. We'll keep it somewhat short this morning, but good to have you on.
Thank
See you next time. All right. Make sure you got 3 seconds. Make sure you join us tomorrow. Squawk on the Street right now.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Coming off an all-time high weekly close for the S&P. Futures are mostly red here as we set the table for Q3 earnings beginning this week. 2s, 10s reinvert as the market rethinks Fed cuts after that jobs number. Our roadmap begins with stocks. Goldman upping its target for the 3rd time this year, and Treasury yields do top 4% for the first time since August.
Plus, oil prices are rising again as Middle East tensions continue to weigh heavily on that market. And Pfizer shares, they're rallying ahead of the open. Activist Starboard Value taking a roughly $1 billion stake in the drug maker. We'll have more on that.
Let's begin with the markets, though, as we watch yields here. Jim, a couple calls over the weekend for maybe no more Fed cuts this year.
Yeah, I mean, I was reading Ed Yardeni. I always love him, and he's talking about, look, may not need it, but what is very interesting is it may not need it because we don't have a crisis. And Ed has been true north the whole way. Carl, I've got to tell you, oil with the amazing move up, and we had some good stuff this morning on Squawk Box talking about, you know, if it gets wider. And also on Frank's show, there was just a lot of good commentary. Good comment, I mean thoughtful. And so I understand that people could be worried about interest rates, but in David, when you have a rate cut cycle, it doesn't stop after a while. It just never does. Right. It's just extended. And the more extended this is, frankly, the better for the market.
You mean the longer period of time it goes on,
I mean,
as opposed to it happening in a fairly shorter time frame?
Yeah. Well,
why is that?
Well, because it means, one, there's no crisis. And 2, anytime you have you're not fighting the Fed, is a halcyon time. So the number of downgrades today I found actually somewhat of an urgent. I saw so many. And, you know, I don't think you can get out and in of Apple, get out and in Amazon. I mean, the market doesn't want you.
You cite both of those for a reason, because there were 2 downgrades of both. One of each of those names. I think it was Jefferies and then Wells Fargo and Apple. Jefferies on, I think it was on Amazon, or maybe I have them reversed, but let me check. But yeah, they both got downgrades.
Jefferies had Apple, and it was quite a blow. But you know, here, let's use the same analysis for the Jefferies. I just think you have an extended Apple scenario here. So you do okay this quarter, the next quarter better. So how do you get out and get back in? Is anybody really that good, David? Anybody?
You've typically said don't trade it, just own it when it comes to Apple. So I guess I'll answer for you. No, few are good enough to do that.
Thank you. That's really my feeling. I'm not trying to be, Carl, I'm not trying to be vindictive. I'm just saying for most of the people at home, these calls are just too hard. Unless they're like algorithm traders or guys with huge amount of money at stake, just chill on these.
It's a great point, Jim. A lot of people making the point that given all the things we've had to worry about this year, wars, elections, inflation, the Fed. We're up 34% over 12 months.
Yeah, that's really the story. And it comes a lot from, I mean, just a rotation of good. I mean, last week Costin was talking about, I love him, he was on mid-cap today. He says, listen, large cap, and it's Dave from Goldman, and I kind of agree with that. But look at Amazon. So Amazon, I don't want to get too micro, but Amazon reports a quarter that was allegedly bad, right? And the stock goes from, just pure 186 down to 161 pirouette, and then the next thing you know, it's right back. And what are you supposed to do? Did you get out and then get back in? No one's that good.
That's interesting piece too in the Journal about Google's search dominance starting to erode in part because of Amazon and TikTok, AI firms.
We did trim some alphabet for the trust. I just feel like that the antitrust case, the second one's not that strong. The first one that they lost, not great. And then, David, I like Waymo, but on October 10th, I'm not going to be celebrating Waymo.
No, you're going to be talking about Tesla.
Right.
But back to this search thing, question
Right,
that
the
was
search
just
weakness.
raised. Because I remember, obviously when ChatGPT just was getting, well, not really just getting started, but earlier this year, late last year, there was a lot of questions about Alphabet's dominance in search.
Right.
And whether it would be really challenged. Interestingly, we were focused much more so on what Microsoft would mean, both in the enterprise and be able to do through its, its search product, so to speak. I think they sold the same name, I guess, but I don't even know what they're going with
like Gemini, I use Gemini. I mean, I use them all, but
but now we're talking about Amazon, which
Sure,
we've been talking about for
ChatGPT.
years. Right, but in the sense of that is threatening Alphabet's dominance, but it's just people going to Amazon and searching instead of going to Google.
Right, but I'm not saying I regretted selling some, and I'm thrilled. It's the smallest of the mags that we have. But I will say that to sell Amazon is quite different from to sell. But Amazon, you have to just think that their whole Prime Video strategy is not working. You have to think that the economy is not strong enough, and you have to believe that Walmart's taking them on. For Alphabet, there's genuine legal issues, and I like Waymo, but they've not been able to monetize it. The only thing they have monetized really fabulously is YouTube. So do I really want to get away from YouTube when YouTube is fast and good? And I usually look at David at this point, but I'm not going to. Because I don't want to get down. I'm down enough here.
Down enough? Well, we saw Amazon shares again down on this Wells Fargo downgrade where they're just simply talking about a positive revision story being on pause. They caution margin expansion could be capped in the first half of next year, even though they say the market already anticipates pressure on the fourth quarter. And as such, they move to an equal weight until visibility into margin expansion resumes.
All right.
So that's the thesis from Wells on their downgrade to an equal weight of Amazon.
Well, at least they didn't do it at 161. Got to hand them to it, right? They could have done it at 161 after the so-called missed quarter.
Yeah.
Look, I just think that these are stocks that you can football, so to speak, get in and get out, get in and get out. Or you can just look at what you said about the S&P and look at how well you've done if you haven't gotten in and gotten out. I mean, I was doing some work on Amazon, NVIDIA, Apple. How much it's cost you to be able to get out and then usually not get back in? And it's all, I'm not saying it's criminal, but like these downgrades are hedge fund downgrades. They're not.
Yeah, although Jefferies is just adding its name to the chorus to a certain extent of those who are saying that near-term expectations for iPhone 16 and even 17 are too high.
So lower your price target. Lower your price target. Don't say
that demand is not there. And this one, I think you had a potentially new analyst coming in and then downgrading the stock.
Well, look, maybe he's right. Maybe at 207 you get back in and it's fantastic. How many of our people at home are going to pull the trigger at 207? How many? The answer is none.
Okay, thank you, Jim.
Well, it was supposed to be rhetorical, but I didn't hear you say it.
No, I was just listening. Yeah.
Well, speaking of hedge funds, thanks to the Goldman desk, information technology, hedge fund, net buying last week, fastest pace since May.
Isn't that something? I like that. And I know that KeyBank has a very interesting piece. Jackson Ader talking about how enterprise software has finally come back down to valuations that are interesting. You know, ServiceNow's not that expensive. And you know, I think that Salesforce, the single best launch they've ever had, is Agentforce. So I kind of get that story. I don't mind that story.
One last thing, B of A desk today does point out that given the jobs number on Friday, implied volatility for CPI this week is now above the last 3 months' actual volatility. Are you worried about?
Yeah, I actually am, because the chorus of people who shout instantly on every single number is so loud that, again, I think that a bad number and people are going to panic, and a hot number. And David, I know I'm sounding pangloss. I don't mean to sound pangloss. I'm saying that, yes, this should be a week that you can sell and then maybe get back in. But that is, I regard, as malpractice for many of the people watching us. Malpractice.
Okay. I think they've gotten that message.
Castellanos sent you a real message yesterday. See the Castellanos message that was sent to David? I thought of you the moment I saw it. It's right.
Yes.
Hold on just a second. Just a second. Oh my God! It just came up as if by magic.
It's just 1-1. It's now 1-1. All right. We're heading back to Citi Field tomorrow.
Yeah.
And it's going to be a hard-fought series.
No
doubt about that. There's no doubt about that. It's going to be a hard-fought series.
Well, just funny at this.
You guys do have
just when you're really
you guys
down.
have a murderer's row there, man. I mean, getting past Schwarber and then Harper and Turner and this guy. Yeah, not easy.
No, baseball's probably enjoying a renaissance right now that is extraordinary.
I don't even know if I'm going to make it through the series, let alone if we actually do advance, which of course I expect we will. I don't know if I can take it.
Okay, well, that's too bad.
Yeah.
Okay.
No.
I'll give you some heart medicine as a break.
Yeah. I might even need some drugs from
Pfizer. Oh my God, Mr. Segway.
To help me through that.
That's what they call him.
That's what they call me, Mr. Segway. The stock is moving a bit higher. We can confirm the activist investor Starboard has taken a large position, perhaps as high as $1 billion in the drug maker. And I'll give you some sense, at least in terms of where the focus may be. Of course, those shares have slumped. You've got weaker demand for COVID vaccines, not to mention the treatments such as Paxlovid. And a lot of this does go back to that huge bump that we talked about for that period of time, where revenues went from, what, 60 billion to as much as 100 billion? You're talking about $30 billion in additional cash flow the company had, and they spent it. Did they ever, right?
Yeah.
Acquisitions galore, the main one being, of course, CGen.
Which hasn't paid off yet, but good.
And some argue, Jim, that in fact they paid too high a price for CGen, but few argue that there aren't very valuable things that have yet come to the fore in terms of the oncology franchise.
Totally right, correct analysis on the CGen.
That they acquired. That said, there seems to be frustration, certainly one would expect on the part of investors such as Starboard, with where the company is still kind of running itself right now in terms of a cost perspective. I think their sense is you should be assuming you're a $50 billion revenue company. You're certainly no longer a $100 billion revenue company.
They forecast bad.
And you need to be massively tactical. You need to, yeah, you're raising an interesting point. I want to get to that. I'm just trying to think of some of the. I'm just trying to go through some of the things that, in fact, may come up here in terms of the conversations that my understanding is have yet to take place.
Okay.
Pfizer was aware, perhaps made aware very recently, of Starboard's presence in the shares. That said, I don't believe any actual conversations between the hedge fund and management have taken place, guys. And it's trading at 11 PE. You got a dividend yield that's obviously far above that of much of the market as well. But there does seem to be frustration with both Mr. Borla and just how much they're spending. Dr. Borla, excuse me. Even though they have obviously cut that spending to a certain extent, I think they want them to refocus on a handful of initiatives and not be what they would say is kind of all over the place. You raise this point, Ian Reed, and the former CEO, and Frank D'Amelio, the former CFO, being potentially aligned in some way with Mr. Smith. Now,
can I say how extraordinary that is? You know, Frank is one of the great CFOs of all time.
That is unusual. That has got to be something that brings pain to Pfizer and its management to a certain extent. And I haven't gotten
very tough guy. You know, cost
He was
basket
tough.
costs.
He was a
out
tough
the-
guy. I do remember that.
I was scared of him.
That said, I know he was kind
I
of.
said,
yeah.
remember when I said the lyrical comment and he let me have it?
Well, you go to a meeting with him. He was humorless. He was a humorless
yeah.
dude.
He said, that's all
Yeah.
patent. What do you care?
Yeah.
I said, well, no, I'm just saying it's good drug.
Just all about showing you how tough he was. But listen, I mean, tough helps in terms of costs, and I think the sense is here you need somebody tougher than the very kind, very nice Dr. Borla. But you know what? It's not just him. I've gone 20 years on this, and I've shown you the stock's done nothing in 20 years. I mean, I can go back to the days when Joe and I were sitting there in Squawk Box, and we were talking about Warner Lambert, and we were talking about with Lipitor, and then Viagra, and this was a growth stock. But really, since that period, and Hank McKinnell, remember him?
Yes, I sure
Since that
do.
period, I mean, yeah, there have been moments, and certainly
This
Ian
is
Reed
so
had some
painful,
good
though.
years, but not
Jim
much.
could just be about to take off. Frank was helpful for me everywhere he's ever worked. He is just a titan CFO. If Starboard has Ian Reed and Frank, David, they may have the horses.
The man who's going to be dealing with this on the Pfizer side to a certain extent is lead director. You know who that is? Shantanu Narayan.
Are you serious?
Yeah, I'm dead serious. Shantanu Narayan, of course, the well-known
take him
CEO
on?
of Adobe.
My God, that's exciting.
Is the lead director here. We're going to start to hear more activist campaigns, in part because the window for nominating directors comes up usually early in the year in many cases. Certainly if you have an annual meeting, let's call it in the spring. And that is the case here. I believe it's a January window. So you kind of want to start your conversations, get moving, see if you make traction, see if
And
you
you
can
have
get
to
what
talk
you
about
want with management. If you don't, then you are in a position to obviously
You
nominate.
get that global blood therapeutic. Right?
Yes.
Yeah.
They also had that setback with the, right, wasn't it with the GPT, with the
Yes,
yeah.
with the GLP, and then they also were not able to get as much money at the return yet from the Biohaven Nurtec drug. They spent $11 billion for. So against that is you're talking about one of the great humanitarian guys of all time. I mean, it
No,
really
without
just
a doubt.
kinda
But 30 billion in cash flow. They spent 60 billion on acquisitions. You've got to get a return. It may still be on the it's all on the come, and maybe it will.
How about buy Pfizer? How about that? How about buy Pfizer?
When we come back this morning, Elon Musk's in the spotlight, from this week's Tesla robotaxi event to stumping on the campaign trail with former President Trump. Take a look at the pre-market. We'll get to Tesla. There's some news on Boeing. There's M&A in mining, aerospace, oil and gas. Milton, now a Cat 4. Stay with us. A big week is already underway for Elon Musk. A lot of buzz surrounding his Tesla robotaxi event, which takes place on Thursday. Of course, over the weekend, he joined former President Trump on the campaign trail at a rally in Butler, Pennsylvania, the site of the assassination attempt against Trump back in July. Ended up at the Steelers game. Jim talked about going dark MAGA, arguing that if Trump doesn't win, it'll be the last election.
Yeah, I mean, we're in that moment where the people who are in favor of Trump are really kind of adamant that we're into some sort of weird spiral down for the democracy, and then for whatever we have. And then the people on the other side are saying weird spiral down. I read Timothy Snyder from Yale, who's really great, just says, look, we're going to be with the dictator. And I want to step back and just say, look, I don't want people to be freaked out by any of this stuff, because we may have, if you have a split government, you're not going to have this. And that's kind of, if you're worried about democracy, David, maybe split government is the antidote. Did you watch this?
No.
Why not?
Why would I?
Because it's a business story.
Yeah, I the two sides of Musk are hard to. There's all the things he tweets or whatever he posts and reposts.
Yeah.
Many of which are politically related now. Many of which are not accurate. And then there's the other side of him.
There's October 10th.
By the way, largest government contractor as well, which is interesting. And then obviously the business genius that we all know, and that so many, frankly, even a handful of years ago, universally almost admired. And I would argue that is certainly not the case. He's made himself such a divisive figure. But as he said famously to me back in May of 2023 during our interview then, he doesn't care.
No, I didn't care. Well, look, October 10th, let's deal with the business side of it. Waymo's made incredible strides from Alphabet. That's one of the reasons why I kept some Alphabet on for the Chapel Trust. At the same time, who is going to count Musk out? He's got all this data, theoretical data, right?
Sorry, Carl, you go ahead.
No, I was going to say that was the thrust of the Barron's piece over the weekend.
Yes.
Is what kind of data will he be willing to share? Do they have data that suggests that driver assist is safer than humans? If so, would Thursday be a good time to show us?
I think that he can make that claim. I think that he's got. Remember, this guy has more. He has more.
They have more miles by far than anybody, without a doubt. And they've been using generative AI, and they have been meaningfully, from what I understand. I do not drive a Tesla, so I can't say it firsthand. But what I understand is meaningful upgrades in terms of full self-driving, and what that's mean, where they are, 12.3, whatever the number is right now. And we'll see. Obviously he's been promising the robo-taxi for years. It will be a significant shift in the business model for the company if they're successful. But he famously, of course, has told his own investor base, don't buy us if you just are interested in my car numbers.
Right.
Buy us because you care about robo-taxis, you care about robotics and robots.
Well, his robot strategy is one that I know Jensen Wong agrees with. Jensen's in town this week, ringing the opening bell on Friday, NASDAQ. And I would tell you that if he can get into Austin and Atlanta, like Waymo, he's off the races. Off the races. And I didn't even talk about Starlink, which is just so fabulous.
That's something else. We'll be watching a huge story all week regarding autos. We'll get Kramer's Mad Dash and count down to the opening bell on this Monday. Busy week headed our way. Stay with us.
Stocks at Night.
A lot of tech events this week. You've got some AMD events. We mentioned Tesla, NVIDIA's AI Summit. For the time being this morning, though, a little bit of weakness in the semis. You see ASML leading the NVX lower pre-market. We will get the opening bell in about 4 minutes. And don't forget, you can catch us anytime and anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
Huh. Oh well. All right. Good morning, retail traders. One more minute to go. One more minute to go. Oh.
All right, let's get to a quick mad dash. Opening bell a little over a minute from now. What do you got?
I feel better because this is a complicated story. Foot basket, very good on footwear. Actually starts Foot Locker with an accumulate. Now,
Okay.
I don't really care for Foot Locker. I think Mary Dillon is executing a textbook Mary Dillon turnaround like she did at Ulta. How?
So we're at resistance right now. 571.49 on the SPY. Expect a little, well, market's got some volume here this morning. Let's see if we pull back here. We nearly doubled U.S. debt burden compared to what? Trump proposes could nearly. Now here's a bunch of bullshit again. Trump proposes could nearly double U.S. debt burden compared to Harris. Now, may I say bold crap? Right off the bat. If we look at any of her of her history, that's not the case. She was the signing person on all them over $13 trillion in deficit in 3.5 years. So no, I ain't falling for that shit. not first thing this morning. Who put that out? Benzinga. Tells you how much you can trust them. Not too much. No trust. Good morning, YouTubers. We had Tiger. We got XLE is at resistance. So first thing this morning, we pulled back and hit the 200 on the SPY. That's the 8th. We'll come see if we retest the 200 here for support. We've done it once before. 573 strike. Or the 575s. I might take both of them. On the calls. It's definitely a head and shoulders. It's for the second touch. Hope everybody had a great weekend. I sure did. Kind of got some sleep, very needed sleep. So on the SPY call, I'm looking at 573. October 8th, trick or treat. Today's losers, AMC. I heard that Joker movie sucked. I think Hollywood sucks in general anyway. Home Depot's down $6, 563. I'd take a look at that one. Tesla's down 330. Apple down 237. We're at the 200 on Apple. Little boy blue. AMC stock pops after lowering debt load. Don't look like a pop to me. We definitely hit support at 427. But I ain't trading this piece of crap. I need to take it off my watch list. I just watch it because of the boy. Oh, it's about time for me to send him another dirty message. There goes the SPY. So we're retesting top again. 133 to 153. Again, I heard a strategist more or less say we don't care what the Fed says. And that's been that way for almost a year and a half. We've got Amazon pull back here. Meta hit the $600 mark. We'll see how true the SPY is right now. Mike did a lot of due diligence this weekend in the room. $140 to $152 there on this 573s. I'm going to look at the puts. The 570. Oh yeah. We had 3 white soldiers right here on the SPY this morning. We got a spammer out there again copying me. Got a couple of them. I don't know what the hell's going on here lately. Okay, puts yay, 170 to 188. Now we're at support again, so exit your trade. We could easily fall down to the 200 for the calls. We're going to find out who's in faith here. What did I call earlier? The 570? What? Oh, that's a put. If I send you a message and it doesn't sound like the normal me, I'm asking you how's your going, or especially if it's in a long sentence, you know it ain't frickin' me. Bastards, I hate people like that. I really do. How are you doing? Hope you're gradually understanding what strategy and what suits you best on a daily basis. I know it's always a difficult task to comprehend the best strategy. If there's no misspelt words in it, it's definitely not me. Okay, here we go. SPY. Calls. Double bottom. We're retesting double bottom, high or low. We got 3 white soldiers, 3 black crows. Okay, now I got a big engulfing candle here, so I'm going to be able to get out of this trade now. Take your profit. I'm out of the trade at 146. Okay. Old Black Betty, Bamber Jam. Betty had a child, Bamber Jam. Uh-oh, I'm being a misogynist again. Jim, you shouldn't stereotype Black Betty. There's white Bettys out there too. Got the first scalp out of the way. So let me tell you what I did here. These here 3 triangles. These are called 3 white soldiers. Okay? Which tells me we could have a good day today. But then we had the pullback to the 200 again. We bounced off the 200 a couple times this morning already. So that's the 3rd time. 1 bits, 2 bits, 3 bits, 4. 1 bis, 2 bis, 3 bis, and we're creating what you call a symmetrical flag. So when that big candle came in, that second one, I automatically got out of that trade because I expect a lot of volatility. Plus it let off with a pretty good little hammer right here. Kind of a spinning top. So we could do this one more time. Now this is pushing it. 129. We're getting ready to squeeze out of this flag. I'll give it about another 2 to 3 minutes. If we start building momentum above this here, build a whole body candle above this and then start going sideways, we could easily come up and start breaking out. I'm going to go in there and make me a cup of coffee. I got my first trade out of the way, so I feel good. It's always the hardest one. I got some sweet potatoes in the crock pot. $125. We could easily come down and hit the 200, but I grabbed them at 125. at 125 with a tight stop. Or I'll just add if we hit the 200. Okay, here we go. .17. $125 and $127. I got to call my accountant today. I paid taxes with my personal account. I got to figure out how to beat the bush. We're at 114. My average is 121. I got 20 contracts. I might have to get out of this here real fast if this don't work. Coffee. $118, $120. Let's get a good bill of bounce here. Break it. If you're not comfortable, get out. You just hit your resistance with a 1, 2, 3. Oh, there we go. Break it. Bitcoin ETFs are up. GME's down. NVIDIA had a beautiful breakout this morning. It's pulled back to support, 50% retracement. We're at 127 on my SPY. Anybody take the SPY with me in the room? Randy, I'm up $200. Mike's in it. Oh, Mike's in a put. Mike, what the hell? No soup for you. We're above the VWAP now. Donald Trump is running. Oh, shit. It's now or never. I'm going to get a lot of controversy here in a little bit when I start bashing my little kid friend about AMC. It'll eventually pop, but you got to be here every day when it does, and then get the hell out of it. Anybody on YouTube, if you get some kind of message from me and you don't think it, especially if it's a long paragraph like that, you know it ain't me. I can barely get 2 sentences across. Okay, Jimmy's winning, but it's not like it should be. I want 150 out of this. Tiger's doing well. Got a tiger by the tail, it's plain to see. I wish there was no killing going on in the world right now. It really sickens my heart. Especially growing up as a old liberal hippie. Pisses me off is what it does. To watch my friends just kind of tells me that they've never been true to their words. 129, blanket. So we got the double bounce here. Jimmy's going to take some profit. Snake, breakout, pull back, higher low, boom. Randy, 133. $133. Jimmy said it. Okay. Outs 1.33. There it is again. All out. All out. Nailed it. 141. I'm dreaming of a white Christmas. We'll have a blue. That's 2 successful trades out of the way today. Mike's already gone? Where did you go, Mike? Because I just started singing just a couple tunes. I'm not that bad of a singer. Riku has his mic on, but I don't hear him. Donald Trump is moving.
Can you hear me, Jim?
Oh, I can hear you now.
Good to meet you, man. My name is Jesse. I just wanted to say I appreciate what you guys are doing here, and I look forward to learning a bunch.
Well, very nice of you to come on here and say that.
No, I appreciate you, man. Just want to stay respectful and not spam chatter. I know you do your live thing every morning, so it's just very appreciative to listen and stuff like that. So thank you, man.
Well, thank you. You live here in the States?
Yeah, I'm from Salem, Massachusetts, but I grew up in Colorado, brother.
All right.
So,
I went to Denver back in college for a state competition, or national competition thing in entrepreneurship.
Nice. Yeah, I graduated from UCD, so that was quite the experience.
Yeah, I bet it was.
It still goes on, brother. Oh my gosh.
Yep. Well, thanks.
Yeah, man. I'm heading out. I'm heading out, and just good to meet you, man. And I'm sure I'll talk to you at some point. Just wanted to ask real quick. It's okay to ask about technical analysis questions and stuff like that. I just didn't want to spam during market and stuff like that when everybody's focused. So.
Oh yeah, you're 100% right on. That first hour and a half is the most important part of the day.
Cool.
So anytime after that, feel free to get on here and ask anything you like.
Awesome. I appreciate you, Jim. I look forward to that. Thank you guys so much. Have a great day. I'll see you later.
Very good. What's your name again?
Jesse.
Jesse. Okay. 10-4.
You got it. All right. Take care, brother.
Yep. I'm going to turn on the air because I got a little hot off that last cup of coffee and those two trades. It's only 76 in here. So when you start seeing the pattern, you want to go ahead and start charting it out. And that gives you some kind of idea. And then we had that double bottom here with the higher low off the 200 with 3 black crows. And she came back and double topped. So that's why I got out of that trade. I got out of it. And I'm going to just kick back for right now and turn on the air, and I'll be right back and get my water all situated. Make sure you drink enough water today. I'm learning a lot about water. There's still so many different mixed messages about it. Oh, I still have a piece of burger here. I made some real good protein biscuits this weekend. I put a little extra garlic in it with beef liver, and hamburger, and egg. No cheese this time. Boeing breaking out a little bit. I had me an edible this weekend. It was, and I ain't done that in a while, and I was pretty buzzed. She says, "You know that's hard candy?" And I said, "No, I do." Ostara watermelon, 220. I ate half of them, so I'll do the other half tonight when I get done. I want to have another good night's sleep. I asked all my clients for a raise, and all of them accepted but one. They accepted, but they said they wanted to put it up on a review, and I go, "Oh shit, what did I get myself into? Am I going to lose one of my clients now?" And I've been with these people for 20 years, so. And they're doing their sales and marketing things, so they're, they got a lot going on right now. And the kid's taking over his dad's position, which the kid's already a millionaire. Family man, got kids. So I've been worried if I'm going to lose the account or not. So I restructured a few things in my business so I can eat up the cost, which you always have to do when things get tough in your business. We're always readjusting everything. It seems like it's a continuous battle. SPY has a new high here. So I messaged him this weekend. I said, "Don't worry about the pay hike," because I was asking for like 15 to 20%. I said I had to do this back during the Clinton years, and I'll do it again now. And he messaged me back. He says, "Your job ain't in jeopardy, Jim." So I left a note with him in his office. I said, "Appreciate your 20 years of business, and here's a couple of fishing lures that I use when I go fishing. Go out and catch me a big one. Don't worry about that pay increase." And I kept thinking, going back over there and picking up them lures and taking that note and getting it out of there. And I went back a couple times, and then I finally emailed him and said I didn't want the raise. He messaged me back and says, "Don't worry about it, Jim. Your job's not in jeopardy." Like he knew what I was thinking. But it's always hard to ask people for a raise unless you're an accountant or something like that. But I mean, I was buying bags for 30 a case. Now they're 50. Just the supplies have gone up so much. We're back to 144 on these. And insurance and everything that goes along with it. Gas and car insurance and I didn't want to ask. I've never asked for a raise since I've been in business. I always usually ate them up because I got paid pretty good, but SPX has a nice little bounce here. So now I'm kind of at ease. Thought about that all weekend. The calls ain't very expensive. Oh, that's a SPY. Never mind. I was looking at the SPX. The 5750s. They're up almost $2 now from the bottom. Got a huge gap up. See, I always like gap downs. They're more fun to trade than gap ups. Come on, man. Cut the ship. We could see another double bottom today with a higher low and be right here at 57.2740 on the SPX. I'm watching it right now. I'm going to trade this sucker. The 57.50s for today, October 7th. We'll just wait here. Patience really was a good virtue for me last week. I've got 2 good trades out of the way already, so I'll be off to the beach. La la ti da. I think we're going to pull back and hit the 63 on a 1, 2, 3 bits. One bits, 2 bits, and a freebie. Set my alert. 571.27. But Jim, I don't want to go down there yet. Oh, Diane. I'm gonna have to follow this chick. She got a Boston Terrier. Or a... Oh. Hello, Diane. $9.25. Now, was that the SPY I just charted? Oh, you dummy! My ding-a-ling just went off. Ready, set, go. On the SPY says we're going up. I don't think so. 1, 2, 3 on the SPY right here. Patience. Patience. Full Mac minutes on Wednesday at 2 p.m. All right. Oh, NVIDIA AI Summit today? Didn't know that. Didn't know that. NVIDIA AI Summit today. SPY at the VWAP. They don't want us. Yeah, I don't think they want to spike it. We're going to know. I think now's the test if they're going to spike it or not if we hold the VWAP. Where's Mike today? Mike? Mike? I'll promise I won't sing. Too many trees die in a way. You got upset that I stopped singing? I've never met anybody in my life that could stand my singing. Besides my high school choir teacher. She pointed me out real fast. Who is that? They said the same thing about Willie Nelson too, but look at him. Hey kid, are you still pumping AMC? That's all he does, videos on AMC, and he's got 6,000 followers now. I guess I need to pump shit stocks. The Donald's up nicely today. SMCI is in second place with, oh my gosh. Jeez. They're liking SMCI today. SPX has a head and shoulders squeeze happening right now, a head and shoulders squeeze. I'm still waiting for it to pull back strongly here. SMC, I've got a hard resistance at 47.15. SMCI. Okay, here we go. Jimmy's getting ready. Randy. Munich, Paris, everybody talk about, and pop music talk about. Okay, we're at the 200 on the SPY. SPX. $57.50s. At 285. They got 57.50s at 285. I'm going to sell one right here. The SPY at 573s are at 115. $320. $40 contract. I sold them. Out at 340 and at 285. I got sold one. I'm gonna sell them all right here. $55, 285 to 340. Okay. keeps dropping. Which one did I take? The 5750s and the SPX. Now, what was that? That's a spy, you dick. Up. These are at 112, the 573s. And we're under the VWAP, so we're still bearish. Hey kid, are you still pumping AMC? I wish that guy would leave me alone. AMC at 112 is now at 122. Take your profit. 112 to 122. Take your profit. That's how you do it. Damn it, Jimmy, get it right. So what's some SPX is at? 57. What I have again? 57.50s. Oh, they're down at 3. Getting a little bit farther out of the money. Hey. $3.20 now. It says it's ready, but I don't know about that. I'm going to go check on my sweet potato. I made a calcium powder this weekend out of chicken egg shells. So I got to see if I can consume this stuff. How to consume it. Pretty couple tables, 3 tablespoons. They say the shell's the most important part of it. So what do you think about them cookies? Uh-oh. Middle East, real time. Here's another good link to cams. Are they on fire? This could get bad if they go after their oil. I mean, that's what I'd go after. I'm not sure about the nuclear sites. I'd hate. I'd give them the alternative. I'd say you either put you on your arms or we're going to come after your sites, your nukes. You can't trust them. Not now. So I've always had a real good, anybody that I ever, well, that's personal, but if I knew anything that I didn't like about you, I wouldn't put up with you. and I'd take you off my list of people that I hang with, like if you cheated on your wife or if you shorted me a bud out of a bag. But I was real strict about the cheating on the wife part. AC 130 just left Israel, headed north. Thinking about hitting my air conditioner real fast and preparing lunch. I think I'm going to cook me a burrito. I do have some steak. Let me see. I'll be right back. SMCI had a good day today. I mean, it's still... SPCI broke my resistance. SMCI. We got the 5750s at 220. Go away, little girl. Oh, I need to call my accountant today. Try to figure out how I can incorporate this tax payment on out of my personal into my LLC. Like, coin failed to new highs. Donald going to 23. SPX could come down here and do this lower low here. Hit that trend line off that shoulder. So I might get in it right there. Grab one here at $2, 195. Might see 175, 160. La 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 doo da. Okay, get ready. SPX calls, scalping, OCT, OCT the 8th, oh, the 7th. Strike 5750s at 195. Camptown races, 5 miles long. Doo-doo. Da-da. We're at 235 right now. Go ahead and take some profit. You might want to get out of the trade. $1.45. Doo-dah. 245. $255. 260. La da 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 da. Da 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 dee doo doo. How I love you so much. 250. 310, baby. 57.3709. Okay, well, that's it. Jimmy's done for lunch. He's going to go make his lunch. Coin failed. Joe Hawthorne is on.
The highs are 57.67. And I would say over the past 2 weeks or so, the bottom has been right around 56.74-ish. So very attractive trading range for the overall market. I mean, we're talking roughly about 100-point wide or so. I believe this is a stock pickers market. I think that right now we're seeing names that are getting some volatility, some directional movement, because we also know that a lot of these names are having events, or just whether it's dividend payouts, whether there's things like Tesla with the full self-driving event coming up soon, obviously Netflix, and so many other great names that are just stocks are moving around. So this is a trader's market. I like it.
Yeah, I saw Citigroup had a buy and Barclays had an equal weight, and the price targets were $70 for Barclays. Citigroup had a buy and a 103 target on Shopify. It's trading at $81 today, roughly. Where do you think this one is headed and why?
You know, I definitely like this stock right here. I like this $80 level. I do believe that right now it possibly is going to run into a bit of short-term ceiling near this 80, 85-ish or so level. But over a short period of time, maybe 30 days out or so, I do think that there could be some more bullish momentum. So right now, again, we're having these days where overall market momentum is dictating a lot of the momentum in the stocks that we've seen so many times, and we know that to be true. I think we're going to continue to see that in a name like Shopify, and because of that, I'm bullish.
I see. Okay. You know, and it really has, first it had a gap down on earnings and then a gap up on the following earnings. Rick Duquette's going to take us through the chart, but over the last 3 months, looking pretty good, up over 20%.
Turnaround that we had off of this low point, very close to our previous 52-week lows. Didn't quite get there, but very low nonetheless relative to our previous price action during the past year here. Since then, trending upward, kind of a rising wedge type shape here with our steeper trend line going across the lows, a more shallow line acting as the boundary across the highs, both converging toward each other, kind of out of room in this pattern here. So some kind of movement beyond either of these two boundaries is impossible to avoid at this point. That doesn't necessarily mean it'll be a big breakout. We could just kind of drift sideways here, but a push beyond either of these two lines could be worth watching here. And Joel had mentioned that we could see some resistance in the near term around 85 or so, 80, 85. That makes sense to me because when we look back here a little bit, we've got our red line. That was a notable high point that we had after our gap down, back around that period in January near the beginning of the 2024 year. So that's a line in the sand that we haven't quite crossed yet. We're getting close there. Today's price action, not exactly what the bulls would want to see there because we are on pace to form what's called a Harami candle, where our smaller red candle, the real body, the distance between the open and the close, completely encompassed by the previous day's green candle. So a bullish engulfing candle or a bearish engulfing candle is the Harami here. So perhaps a sign of potential trend interruption. RSI is still looking pretty good though, trending upward above the 50 midline. A little bit of bearish divergence here, but we could turn that around if we get a push above that resistance level. So 84, 85 resistance. Then ultimately, if we filled the gap, our pink line here about 89 to the downside, we've got our 21 EMA.
Randy, we just hit resistance on the SPX.
Right around 76, 77. So that could be a supportive point to watch, Nicole.
Okay. Thank you for that, Rick. Are you worried about the bearish divergence right there overall? Nope. But it sounds like you're more bullish today here, Joel.
Yeah, not so worried, but that changes as a trader. I have to be nimble, so I can very well be pulling hairs out of my beard if this thing pulls back too hard. I'm going to be selling a 70 put, simultaneously buying 65, the 65 put, both expire November 15th, picking up a credit of about 83 cents, break even 69.07 roughly. So that gives me plenty of room to the downside if we do see that weakness that Rick discussed. If we do get that, I have till about $69 for break-even point. So we'll see what happens there.
Yeah. Last year, we saw Microsoft gaining nearly 57%. I mean, they were a real leader in generative AI. Now what? Where do we stand as we have so many companies formulating so much competition against Microsoft? It's been choppy and off the highs of 468. Where do you think this is headed and why?
And I agree with you. I do think it has been choppy. But, I think this is one of those names where Microsoft doesn't really try to really put out a bunch of bells and whistles. They just get the job done. And I think that's one thing we can't ignore about a company like them. We know that the AI talk has been the talk of not only just for a lot of stocks and a lot of big name stocks, especially with the Max 7, et cetera, but just the overall market. We know that the AI talk has dominated overall market direction. So much optimism, so much concern and fear about, what's to come and things of that nature. I just think Microsoft is going to continue to plug away. And because of that, I'm bullish here, and I'm really aggressively bullish overall. But just for this particular trade, I want to stay moderately bullish by selling some options.
Okay, let's see what Rick Ducat has to say about the technicals, please.
There's a lot to unpack in this chart here. So the first observation I would have is we haven't really made a lot of net progress in 2024. You know, kind of just moving sideways for the most part, despite some volatility and some swings to the upside and the downside. We're about only up 10% or so on the year here. So the recent price action, to me, looks a little more discouraging for the bullish outlook here, but we're not really at the point of collapsing or shifting to a downtrend quite yet here. We've got two competing patterns here. First, we're starting from this low point here in late July, trending upward here, giving us this nice channel that we could be looking at here, kind of this M shape, slanted M shape of price action bouncing around between these two boundaries here. But we've also got the blue trend line that begins off of our 52-week highs and subsequently moving there. So we are in a shorter term uptrend, but at odds with a longer term downtrend. Now, when we look at the more recent technical indicator action here, we can see that price has crossed below our two moving averages that we follow, yellow 21-day, orange 63-day exponential moving averages, which are basically right on top of each other, which speaks to lack of a clear trend direction. It also gives us a convenient confluence to look for further resistance to the upside, but we are also near the lower end of our channel here, and RSI, our measure of momentum, was trending upward here, but we have recently, in quick succession, given up the 50 midline that separates bullish and bearish momentum, so momentum more bearish now, and we've invalidated the trend line. If we were to move lower based on our indicators and our RSI kind of deteriorating here, green line, a low point here, another low point, lines up pretty close with our volume profile point of control. Purple 252-day EMA just below, so between 400 to 405 support area. Resistance at our confluence that I mentioned near about 423 based on our moving averages, and then kind of the next point would be this high point that we had here around 440, and then these lows and subsequent highs after a gap down near about 445 or so.
Right, understood. I mean, look, and I sort of wonder too about some of these tech names as we're now in a higher rate environment. That didn't necessarily mean a good thing for some of the tech names too. Not Microsoft, but just in a big picture. Final thoughts, Joel?
Sure. Rick mentioned that 400 level-ish or so. That is my support level for this trade. I'm going to sell the 395 put, simultaneously buying the 390 put. Using that November 15th expiration date again, credit is $1.20. Break even is 393.80. This trade is built exactly the way Rick identified those support and resistance levels. We may not get that explosion to the upside, but I do think that there's so much good news coming out of Microsoft. The chart is strong, that any pullback will be dip-wise, and those support levels will hold. That works in my favor, so we should be able to collect a premium on this trade.
All right. Well, UPS likely to deliver in-line quarterly report according to UBS. There was a lot of talk about names like UPS and FedEx when the port strike was underway, though that's taken a pause at least until January 15th. So now what? Where do you think UPS could be headed?
I'm very optimistic in UPS. I think, and this is not necessarily for these looking out for the next couple of weeks, but more so thinking about how it's going to rebound and respond for first quarter earnings in 2025 and going forward. Obviously, we can see that the chart doesn't look great for bulls going back, late July and August, etc., hitting a low of about 123 and change. But currently trading 130, and I think that for me, I like the stock. I want to pick up shares here, and I want to see a little bit more of a pullback. Maybe retest some of those lower price levels so that I can hold this stock going into next year. I think there's going to be some optimism around it. I think this stock is possibly going to rebound. And as you know, the FedExes and UPSs of the world really dictate and give us a real inside view of kind of where we see the economy, where we see the market moving sometimes. And we've seen that many times before. I think that won't change in the near future. So I'm optimistic here.
I've seen a few already, some guesses about how the holiday season, what kind of growth we will see. I mean, Deloitte was a little more timid, tepid, whatever you want to call it. They had it roughly around 2.3 to 3.3% growth, but Adobe, for example, had it over 8% growth. I think Joe Brusuelas was saying 7%. So people are expecting some growth for the holidays, and that ultimately would be an economic indicator and good for UPS probably. Let's see what Rick has to say.
Definitely the weakest of the three charts today, but I'm kind of curious if we're seeing some green shoots forming in this name here. So to begin, high point right here on the year, 163 or so, was the start of yet another channel. Lots of channels in our charts today, but connecting across these highs. Once again, you just take the channel or the trend line, you just duplicate it, put it across
129, 573s.
You'd be surprised how often it works and can help you project potential support or resistance here. But this low point that we hit recently that I just circled, Joel mentioned around 123 or so, this is an interesting level to me because shortly after that, look at this very tight range that we formed. We did not make any new lows beyond that point. We did not kind of collapse. And also this range is the site of our volume profile point of control here. So the area of heaviest trading means there was a lot of action at this low point during this range. Makes me kind of wonder if traders were looking for a bottom at these depressed levels here.
Depressed.
Since then, a bit of a push to the upside, but kind of fell short. We did manage to take out these old highs that we formed near the level of around 132 or so after we had our gap down. So we topped out here around 137, but since then faltered once again, falling below our moving averages, which are all now trending downward once again here. RSI also exhibiting disappointing behavior for the bulls, breaking below our 50 midline and also falling below that green line there. So if we were to keep moving to the upside, this boundary, this old high, 137 would be the point to watch to the upside, ultimately looking to fill this gap near 143 at our pink line. To the downside, our range, our volume profile point of control, 126 to 128 is key to hold. If we do break lower, 123 is kind of the final line in the sand there for the bulls before things could start to fall apart more seriously.
All right, thank you for that, Rick. You get a quick thought here, Joel?
Yeah, definitely want to be a bull here. I think there's some optimism at these levels. And I want to look at this for a long-term projection. I would probably revisit the stock maybe first half of 2025. And if things are going well, I'll continue to hold it out. But I do think that we're going to see some optimism in a name like UPS. As you said, Nicole, this is one of those names that projections are high coming into the holiday season. And so there's some anticipation of growth. I think UPS will directly benefit.
Joel Hawthorne, Rick Ducat, thank you so much. Great to see you both with the big three today. Coming up next, we're going to spotlight all those stock buybacks we talk about. Howard Silverblatt from S&P Dow Jones is here and will give us the very latest data for 2024 and what we could expect for the final quarter of this year. We'll be right back.
I like how they come in here and they second guess everything. They bring a different opinion on. If you're on CNBC, that would be racist. Do 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 do. And that baked potato was good. That's the best one I cooked yet.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms.
I've ate more sweet potatoes in the last month than I have my whole life.
Traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab Investing Themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange. So glad you're with us on this Monday. We want to spotlight the latest data we're seeing on stock buybacks. For that, I'm joined by Howard Silverblatt, Senior Index Analyst, S&P Dow Jones Indices. Thank you so much for being with us. So as these companies are buying back their shares, markets at all-time highs, could you please give us some perspective up to this point?
Well, the companies spent a little bit more in the second quarter than they did in the first, just about even. And they expected, looks like the third quarter will come in at about 3%, but the fourth quarter will be a lot higher. The problem here is that we're not getting as much bang for the dollar. Similar to the grocery, you're going and you're spending, but instead of having 2 bags of groceries, you only have 1. In this case, companies year over year increased 8% for their buybacks, but the market was up 22, 23%. So they did not get as many shares. What that is doing is reducing the impact to the earnings per share. When you buy shares back, you reduce your share count and therefore increase your EPS. Well, we're not increasing it as much. We're also not getting that much of a support. Instead of support from buying 1 million shares, they're buying 950,000 shares or so because the expenditures aren't keeping up. So the good news is that this.
That don't make sense, sir.
We're expecting a fourth quarter increase to be nice, but they're not keeping up with the stock prices. So they're really reducing the real buyback impact on the stock market.
I see what you're saying when you say, oh, you know, the bang for your buck, and so they're having to buy fewer shares, the value.
900, that's a lot of shares.
I'm just going to make an analogy here. If you put in your gas tank, maybe, you know, $50 didn't go the same, but you still got some gas. So the buybacks still provide some support. Or, right, or some value, don't they?
Yeah.
Definitely,
Yeah, it does.
And it's measurable, especially now we will have a blackout period, but it is definitely supporting stock. Even if your stock is going down, the buying helps support it, even if it's going down. And if you buy enough back, which companies are doing, they are reducing their share count, which increases their EPS. We calculated about 1 in 8 companies within the S&P 500 are significantly increasing their earnings per share by buybacks. Significantly means that at least 4%. So 4% of your growth is coming from buybacks. And investors really need to know that because you do not want to pay the same multiple, especially today when the numbers are in the 20s, for buyback adjustments as you do for actual growth of a company. But there's definitely seeing support there. But again, it's not as much as it was before because the stock price is so high.
Certain companies in certain sectors are doing more buybacks than others. Can you take a look and break down some of the sector trends you're seeing for this buyback trends?
Sure. Basically, IT is about 29% of all buybacks. They do use buybacks a lot more for employee compensation as well. And second is finance. Between the two of them, they did about 49%. Estimates going forward look like they may hit 50% for the fourth quarter of all buybacks. Partially, there's 2 reasons there. One, their cash flow is good, especially the high cap issues. The Apples, Alphabets, they have enough cash and cash flow that they can do that. Additionally, within technology, as we've said, they do use it a lot more for hospitals. Within finance, they've gotten to go ahead.
Spy closing in on BWAP.
So they're able to increase their amounts and dividends on them. Big difference, obviously, between the finance and the technology. That finance typically pays a higher dividend, even though the the technology is giving you much more in the buyback accounts.
When it comes to the regulatory environment, sometimes regulators don't necessarily love buybacks. They want to see companies spending their cash in different ways. So sometimes those buybacks are scrutinized, but it often can mean that a company is in a good cash position when they're doing that, right?
Yep.
Yes, buybacks typically are excess cash. There's two types of buybacks that we have here. One is uses employee stock options, which are cheaper. So I have a $50 option, a company goes in, a $30 option, a company goes in, buys a stock for $50, the employee gives them $30, it only costs them $20. That they usually do even in bad times. However, the other one is the discretionary, where they go in, costing the full $50, and they reduce their share count, increasing their EPS. Congress does not like this, and the buyback package up to now has not been significant. That 1% took the earnings down, the new tax that started in 2023, about half a point for the second quarter. That's expected to go up because both sides, Democrats and Republicans, like the idea of it. They're passing it through, so we're expecting buyback tax to go up, and we think a tax anywhere in about the 2.25% to 2.5% mark will have a material impact on the companies that are doing buybacks and therefore on the stock support. So that's something to watch in Congress. Of course, the election will make part of the difference, but again, both parties are looking to make it higher.
Yeah, and as you do expect to pick up in
Until they flip on you, boy.
You mentioned IT technology and finance as two of
I
the
was
sectors that
against
are
fracking, now I'm for it.
at this point. What have been some of the largest that stood out to you, or do you have any expectations of any particular names?
Well, obviously, Alphabet, Apple, those are major ones that we would expect to continue. Their cash flow is good on there. The banks, Warren Buffett's been busy on buybacks. Years ago, he never said he did it. Maybe one day we'll do a dividend. Goldman Sachs also, JP Morgan, these are high buyback.
Okay, I've had lunch.
Also pushing companies to buy back more in the fourth quarter is concern that there could be a higher tax next year on the buybacks, and employees maybe
If Kamala's elected,
more options in. In other words, it's not due this year, but I'm worried about taxes for next year on a personal level, capital gains or actual tax rates, and therefore they may put in a few more options to exercise this year. So companies may be loading up on some of the Q1 numbers in Q4.
Yeah, I mean, there was the woman who donated $1 billion to, I think it was the Einstein School of Medicine, and then you had
$1 billion?
buy back those shares,
God.
right? And so, we'll see what kind of charities and those charitable donations and how Buffett and his team could buy back those shares. That's another story that is ongoing and one of our guests brought to our attention. Howard Silverblack, great to see you, Senior Index Analyst at S&P Dow Jones Indices.
SPX 250 to 330 right now.
Standing by, I'll take a look at Alibaba, rallied with some of these other Chinese stocks after the stimulus measures that were announced from
The
China,
5750s.
and monetary policy. We'll be right back.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalini, live at the New York Stock Exchange. Time for developing stories. I want to bring in Alex Coffey, senior equities contributor here on Schwab Network, taking a look at NVIDIA, top pick over at Morgan Stanley. Some thoughts there?
Yeah, reiteration from the analyst over at Morgan Stanley, Nicole, that covers NVIDIA, and you're seeing a pretty nice move perhaps in reaction to it in NVIDIA shares as the stock closes in back on 130 once again, currently trading around, looks like 128.82. It's up about $4 a share today, which is a huge move when you think about the market capitalization associated with every penny in a name like NVIDIA that has some 25 billion outstanding shares. Reiteration from Morgan Stanley, overweight rating, top pick as you said. Price target remains steady at 144. They cite this sustained momentum despite various challenges. Some of the challenges they highlight include China export controls. They talk about difficulties in launching powered data centers, potential hesitations ahead of the upcoming capital-efficient Blackwell architecture, and recent technical delays in new product releases. But they express confidence in NVIDIA. They note that the obstacles are not necessarily things that have hindered them in terms of its strong performance over the last few years, and they anticipate that the visibility will continue to enhance the company's new products and things will begin to ramp up here soon, and their outlook is based on the company's really, really strong market position, Nicole, within this chip space, particularly with the AI build-outs that continue to happen across the world.
All right, thank you for that, Alex Coffey. It was last week that Jensen Huang talked about the demand for the Blackwell chips being insane. So that probably brought some more optimism surrounding the stock too. Good to see you, Alex Coffey. Thank you.
Oh.
Now let's turn our attention over to
Damn, back here at the 200 again.
Senior markets correspondent taking a look at Alibaba, which has had a
230
beautiful run up and is hitting new highs. Some of your thoughts there?
Well, obviously, Nicole, the stimulus package that's been put together by the Chinese government, both monetary and fiscal, has been very supportive to Chinese equities, including Alibaba. The stock is higher by about 40% just in the last 30 days or so. But this company is still an international logistics and, of course, e-commerce giant that has been expanding its presence in the cloud and digital media and entertainment, but also in financial services. So this is becoming sort of a large mega cap Chinese conglomerate. But with that said, I think, considering what's happening in China, it's actually very stimulating to equities in China. And I think the other thing is, it's not necessarily just growth of assets, but also sales. The stimulus package, I think, has also put pressure on the U.S. dollar, which is actually great for Alibaba because about 70% of its sales are e-commerce. And if the weaker dollar presents opportunities for additional sales overseas, that also can be reevaluated into earnings and sales for the company. Now, with that said, some of the analysts are still very constructive, irrespective of the fact that the stock has made such a significant move in the past couple of weeks or so. Macquarie actually ranks the stock to an outperform and increased their price target to $145. And I think they're onto something here because if you look at the forward earnings per share relative to price, it's trading around 13 times forward earnings, where historically it's around 17 times. So I think what's happening here also, not necessarily just the growth of the underlying sales of the business, which are expected to improve, it's multiple expansion. In other words, we're seeing price move quite a bit faster than earnings because essentially these stocks, most Chinese stocks, not all of them, have been trading at such significant discounts because the Chinese economy has been relatively sluggish, and of course the government there hadn't really done much to alleviate some of those issues.
Yeah. All right. Well, with that and the outperform rating, how would you go about an example trade?
So, I'm reluctant to chase these stocks right now, Nicole. I think in the context of volatility in the markets, we may see some short-term pullback, and that includes some of these Chinese equities as well. But in the long term, these stocks are probably going to go higher. I'm mentioning these large mega caps in China because once China starts a stimulus package, they're not going to stop. I think they're going to continue. But with that said, if you look at the stock and where it stopped after it moved higher significantly over the past week and a half or so, it didn't actually breach the 200-week moving average, which is around $120. So what I'm going to do is instead of chasing it by buying call options, the volatility is high in the put premiums. I'm going to continue to sell puts because that's our strategy when volatility is high. And I'm actually going to sell the November $110 cash secured puts. You could actually sell that for about $6 a share or $600 a contract. So essentially, what we'd like to see is, of course, the stock hold the 110 or higher by expiration, because in 39 days, that $6 premium will erode to zero. If you do place this trade, you have to be willing and able to take ownership of the stock, $110, but your cost basis is $104. And so if you take that premium also of $6 relative to the underlying strike, it's about a 5.5% yield to strike in about 39 days. So I think that's a pretty generous return, assuming the stock holds 110 or higher.
All right, thank you for that, because I was just looking at some of the performance. Bob up 50%, Pinduoduo up 60%.
Okay, I don't know if we're going to drop. I think we're going to drop.
These stocks really have run up on that China stimulus. Thank
57,
you so much. Good to see you.
570, 70.
Coming up next, our 360 round, we're taking a look at the health of the U.S. consumer and how some of the companies have dealt with inflation.
Taking a look at the health?
Is upon us. We will be getting
Well, it kind of sucks.
this week, right? CPI and PPI. How could the shopper behave this year? We'll have a conversation.
I'll tell you exactly how they're going to behave. The rich, they're not going to, they're going to keep shopping. The middle class will tighten their budget up a little bit. Things are up like 20% right now. And there's less middle class than there was. We have a couple states that are underwater right now. But the illegal immigrants, they got plenty of money to spend because we're giving them plenty to spend. Then some of that money is going to go back to their own countries. I'm giving them an ungodly amount of money just so they can get a vote. Do, 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 do. We're waiting for the knife. We're waiting for the knife. I am waiting for the knife.
Across every category.
And Alexis, you do have some names that you think may do better than others. I do want to get to those. How healthy do you presume the U.S. consumer could be? Are you leaning more towards more confidence or less so?
Well, hey, Nicole, thanks so much for having me on again. Really, the consumer has been resilient this past year, even in the face of a lot of very legitimate concerns here. Really, though, the interesting thing is going to be as the Fed is going towards
Knife,
normal
knife,
posture,
knife.
that should be good for consumers. And really, we're heading towards kind of a two-way win-win scenario almost, where either the consumer is going to be weaker, economic data is going to be weaker, but that'll spur the Fed to move a little faster, make a little bigger move towards neutral come the next Fed meeting in November. Or we'll see the consumer holding up well heading into this holiday season. We'll see good economic data, and because of that, the Fed won't have to make as big of a move. Both of those scenarios may result in folks feeling a little bit more worried, maybe even some more volatility short term, but long term, be more productive, be a little bit better.
Yeah. Yeah, and I know you're looking names like Home Depot, TJX. Hold the thought for a moment. Greg, look, food prices are still high. You've noted that, but you're looking at the retailers and how much they may have to discount or provide value to grab a consumer.
Well, every company's cost management program should be producing results at this point. What's in question is how those benefits ultimately get split. Is it going to be the consumer brands taking the money to the bottom line? Is it going to be retailers taking margin? Or is some of it going to be given back to the consumer? And what we're expecting to see is this tug of war over promotional discounts.
What?
So retailers will use promotions to bring consumers back into the market and maintain that momentum through the holiday season.
Yeah, I do want to get to some of those names that you were looking at. You also like gold, Alexis, which has been a stellar performer. We've seen gold here year to date up almost 30%, 1 year 45%, you know, as it was topping 2,700. Is that something you're still holding on to, Alexis? Quickly on that.
Yes, I do still own gold. In fact, gold is our largest position, just over 6%.
God.
And it tells the story of diversification within our portfolios at Alexis Investment Partners. We've been emphasizing diversification and liquidity, and we've
How old
been
are you,
able
Gunny?
to, because of that, buy into these pullbacks each month. In these past few months, we've been seeing it starting out with a
Don't listen to her.
and then rally up and hit new highs again. And then be able to go back towards neutral from there.
Don't listen to her.
Just a few seconds left. I know you had Home Depot, TJX, which is the parent of TJ Maxx and Marshalls, and Tesla. Let's focus on Tesla because we have the robo-taxi event, and Tesla today is at 244. Where do you think Tesla could be headed, or are you just holding on to it for the long haul?
So we do own Home Depot, Tesla, TJ Maxx, and we like those names, but we're not necessarily looking to add there. Tesla in particular, we tend to trade around a bit more and not hold it quite as long term. But really what we've been doing in these pullbacks, rather than adding to those individual
Get ready,
retail
children.
names, is adding to more diversified portions of our portfolio, such as IOO, VUG, some of the
I'm waiting for the knife. I'm waiting for the knife.
Like I said, diversification.
Hi-ho, Dario, I'm waiting for the knife. Will we see 570-70? Will we see 570-70? Hi-ho, Dario, I'm waiting for the knife. I'm 16 years old and I'm trading stocks.
Trading 360. I'm Nicole Petalides. Download our.
Nicole, I love you. But I found out you were married a couple weeks ago and you broke my heart. You think it's funny? Well, it's not. I had a personal love for you. Jimmy's watching the 5750s. He could move them up to 5745, but I like the 5750s. Hello, my name's Nicole Tetalini. I'm married. We got Pow Pow speaking at 2 o'clock Eastern Time on Wednesday. Brought to you from someone on YouTubers. SMCI is having a great day. It's still making new highs. Are you serious? Like, may a circle. One, two, three bits. I kind of want to buy one here, but I'd rather see a good knife. Get this at a cheaper price. It's $185. I could probably get these 5750s at $1.25. So I'm just going to be patiently waiting. Jay Leno's Garage. Wish I had his money. SPX calls. Scalping. We're waiting. We're waiting. There, I got the right date. October 7th, yes. $57.50. Sounds like it's such a pretty number. And we're waiting for the knife. We are waiting for the knife. I could grab one at 175. Where's my water? $165. Here we go. Get ready. 1, 2, 3. One more knife. Come on, baby. One more Kindle. Could buy one now, but I want a knife. One more. Here we come. La 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 la. Randy, prepare ye in the name of the Lord. Up. God darn it. What the fuck? I don't know if it's going to give it to me or not. Should have grabbed him 150. Come on, drop. Don't give it to us yet. Unless... what we do... Drop. I dare you. Drop. Do-do-do, do-do-do. Oh, excuse me. That was a belch. We're waiting for the 3-touch here. I'm patiently waiting. We still got an hour and 20 minutes for the fat cats come back, so that I'll grab it here on the third. Oh. Okay, I'm getting ready. 1-4 now. 145, give it to me. Okay, there's 150. Okay, now we need to reverse to the upside. I got 145. Oh, another drop. Damn it. The expansion pattern. Got down to 110. I just couldn't have enough time to grab them. I got one. So I got 132 average. You could get out now if you wanted. Break it. $160. $165. This could be an exit idea here. Oh, I can't read that. That's frozen still there. Shit. Jim? Break it. Could sell them here. $170. I'm gonna take profit. Sell them. Get out of it. Come on, you bitch. Didn't want to sell it, huh? 165. Come on, try it again. Get out. I'm out. Out 165. Dabba dabba doo. Okay. See, I come close to hitting a 63, so I decided to get out of the trade. Bingo, baby. What do you think about that, roaring shitty? Best thing about it is I called it. I said, wait for it to pull back and catch the knife. We hit the bottom of the expansion pattern. Boom. Now I'm going to go get me some water. I even said wait for 125 and we got down to 110. Don't be saying that. You'll jinx yourself, Randy. You'll get shocked tomorrow. Don't be hanging around no electricity. I don't want you to get shocked. Randy. La, 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 la. Didn't want to give me what I had to do, so I had to go down in price. I wanted 175 and it gave me 165, so I sat there for a few minutes. I said, I'm getting out of this trade. So I lowered my price and boom. I always try to get out at the limit. I hardly ever use market unless we're having a real nice run and I want to get out of the trade. And the spread and the bid and the and the ask ain't at a very big wide difference. I'm gonna go clean my glasses and be back. Take another one. See people out there on YouTube. I got in 145 and 120 and sold at 165. The SPX. Trying to squeeze.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Mike's back. I missed you, Mike. I let everybody in the room know it. Didn't I, room? I really needed you earlier, Mike. You weren't around. I had to make a business decision on my own. But it was successful. I've made 4 trades today. Yep. So I think I'm going to go into the refrigerator, or at least go get my water. And it's just so hard, man. I open up my refrigerator, I have a lot less food in there now. A lot.
Nothing for you.
I gotta find one more carb that I can eat that's healthy. I've got sweet potatoes and asparagus. I need one more. Cabbage, but God. Got sauerkraut. Okay, 5750s are back down again. This could be it. Right here. At 105. I'm gonna grab one. Shit, it ain't gonna let me have it. Maybe. Now I'm in it. Back in calls at 105. Break it. Randy, I'm back in the SPXs. $57.50s. We got 10 of them. Actually 11. I'm the market maker. I control the moves. Blanket. 125. I could take profit here. Oh, 135. Can you take me back to the 63, please? Or should I sell here? 105 to 130. I got 11. Come on, don't. Damn it. How dare you? Should have sold him 135. I want 57.37. Yeah, it needs to break. I was up $300 there for a second.
$173.60 to the upside. So as Kevin mentioned, a little bit more room to the upside, but still well within that 1 standard deviation as far as the break evens. As Kevin mentioned, the optimal spot for you is this thing to kind of creep up towards 170, where time decay or theta is going to take a hold. But Kevin, I mean, you're only risking $140, so you've got a decent risk reward scenario. But the key thing is going into earnings or into the end of the week, you want the stock to be at or near 170, right?
Right. If it goes to 169, if it goes to 171, you're still okay. You don't have a lot of risk on this trade, but you do need that drift up towards $170.
Yeah, it kind of fits in that narrative that
Pepsi
Andy mentioned as far as, they wouldn't be bearish on this name going into earnings, but good look at a neutral type strategy with a little bit of kicker to the upside here as far as directional bias, but taking advantage of the higher implied volatility, you collect more option premium on a strategy like this going into earnings. All right, let's take a quick break. When we come back, we're going to take a look at Apple. The iPhone maker stock is under pressure today after it got downgraded this morning. Stick around, Fast Market's coming right
Think
back.
about adding 95 right here.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
90 cents.
Ethan,
How's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
Double bottom.
With Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab
85 and 95 and 105.
Education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome back to Fast Money here on the Schwab Network. Before we bring in our next guest, let's take a quick market update here because stocks have fallen a little bit more since the start of the show. We get the S&P 500, the index down nearly 0.5%. The NASDAQ also down 0.5%. Dow Jones Industrial Average off 0.6%. The Russell 2000 down 0.8%. Crude oil still up over 3.5% as we speak. And the VIX back above the 21 level at this point with the dollar and yields rising also. So we'll keep an eye on the equity market because we're softening up here as the show moves on. But now let's bring in our next guest, and that's going to be George Tillis,
Blake.
Contributor here on the network. George, we're talking Apple. One of those rare downgrades. I think it was more of assuming a coverage from a different analyst, maybe from Jefferies. But this kind of fits into that narrative we've been talking about over the last several weeks since they released their new iPhone 16 is that, hey, that super cycle of sales hasn't taken place yet, right?
It hasn't, and there's some concerns that analysts have, and I can see their concerns, Tom. If you consider the artificial intelligence integrated as part of their iOS software, off the bat they haven't integrated it to the largest degree as they anticipate, and so some of the analysts say, what's the point of adapting or purchasing a new iPhone 16 if you have to actually wait for them to download an iOS update for artificial intelligence. And this is essentially what Jefferies is looking at in part, but mostly I think what they're looking at is the expectations for sales of the new iPhone 16. The estimates that the consensus analysts have are between 5 and 10% increase or take up in sales. Jefferies actually is quite low. They only anticipate about 2.5% growth on a year-over-year basis, which is quite low, and therefore it actually moves their price target on Apple down to 205, which isn't the low on the street. The low on the street is 185. But nonetheless, I can see their point to some degree because if you look at the estimates for a fully AI compatible or integrated phone, they don't actually see that coming out until 2026 or 2027. But at the same time,
Can I have brown rice?
The analysts also did mention is
It's better than white.
Google and Android. Now, it's important to, of course, consider competition. If you look at iPhones in the United States, they have about, Apple does.
I could have some black rice. That was fit for kings. But I need a healthy carb. I don't want to overdo it with the carbs. I ate rice almost every meal. I ate a lot more rice than I have mashed potatoes, that's for sure. I need this thing to break. I got 85 and 105. Come on, man. You suckers. George.
Tell us senior markets contributor. Kev, it's still trading about $224. It's down
Kevin
just over
Hickey.
1% today on this downgrade, but valuation still what, 34 PE?
34 PE is not cheap.
Not for Apple, right? With historicals built in.
Some of the justification for that, or the probability to go higher, is based on what they're doing now with AI is going to change everything. Boy, that's a tough one. They may be setting themselves up for disappointment, but it just depends how. The fact that so few people have a 15 or 16. Right. So many people could potentially upgrade that it could be a big one. I mean, and it doesn't have to be all of them, right?
Yeah.
It could still be a big number that could be upgrading, and maybe they're just waiting for this October iOS upgrade to come out, where that Apple Intelligence comes on. Because my son has it, and he's like, I don't have it yet. It's not coming out yet.
October 28th is when it's supposed to come out. iOS 18.1, and that's on the 28th. And then they got earnings on the 31st. So the strategy I looked at avoids both of those. But if maybe you want to speculate to the downside, or maybe you have a long Apple position, maybe you want to hedge maybe a little bit of downside, this might be a strategy that works out in both of those environments. If you think the stock's going to pull back. So it went up to the October 25th weekly cycle. So before that iOS update, before the earnings, you avoid both of those. And I looked at buying an unbalanced or broken wing put butterfly here to the downside, where I'm going to buy one of the 227.5 strike put, sell two of the 220 strike puts, and then buy one of the 217.5 strike puts, paying roughly about a 235 debit on that. It's a little bit higher because the stock has pulled back closer to $2.50 at this point. But if you pay 235, your break even's 225.15 to the downside. You're already below that break even if you pay 2.5, 260 on this, you're already going to be behind the break even, Kev. So this is actually a neutral strategy.
Kev.
Or you want it to grind down
Kevin
towards
Hickey.
220, but anything below that break even 225.15 is going to be profitability.
Long a $7.50 vertical, short a $2.50 vertical. That gives you that flat line way above the break even. You need the move though.
Right.
Remember, you can see the upside. This is a short delta trade, so the risk is to the upside. The risk is, as always on what we do here, it's what you spend, right? The risk is the debit paid, and you're looking to go to that short strike right around 220.
Yep, and as I mentioned, because you're buying that deeper in the money put, the stock's already below the break even if you paid 260 where it's trading right now, or the 235 that we've got here on the
trade-off there, debit probably a little bigger since you're buying it in the money.
Right. Yep. That's why the stock has pulled back here a little bit. But as Kevin mentioned, the debit you pay is going to be your risk on that example, $235 per spread. But because it's broken wing, anything below the break-even is going to be profitability. And you've got just under 3 weeks in that trade. All right, that's going to do it for us today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader
is
to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky at trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns.
No, you don't have to have a lot of data, my friend.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Break it. We have an ascending triangle.
Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are
Break
doing
it.
well are almost too big to fail.
Have you set yourself up correctly?
It's No.
Controversial. The old guard is saying,
No, I have not.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Kevin Lurie.
There's a market for every single one of these people. There's a market for you. Market Overtime on the Schwab Network. Thanks for tuning in.
Okay, you're taking your sweet time. Ding, 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 ding.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. As
Hi, Jenny.
always, and to kick off this week, we are unfortunately looking at a more grim note here in the 4 major averages, which are all lower on the session. Very few points of strength. I guess we're focused on one later on in the show, and that's the semiconductor trade. But as far as the overall market's concerned today, Alex, I know we have a lot of Fed speak. We have a lot of earnings coming up actually on the near horizon end of this week, but relatively quiet start to this week.
Yeah, one thing I think that's important to note, if we were to go back to 1 o'clock Central on Friday, so that would have been when we left our show, we're actually 4 points, 5 points higher in the S&Ps from that point.
Oh.
So really was a late day rally that's been given back by the market. So it looks a little bit more red than maybe it really is for investors who've been following along here. But earnings later on the week, as you said, inflation data, FOMC minutes, there's just no chance to catch a breath. So take it while you can. It's been a quieter day today so far. I know we've been down, but we really haven't moved once we opened down and stayed down in about a 10-point range. So this is about as low volatility as we've seen this market be. Take advantage of it. Grab some water, maybe turn on join that meeting and actually pay attention on it. Do some things while you can, because it's going to be an action-packed week again.
I was going to say, run some errands, maybe get some chores done. Yeah, maybe step aside from the market, at least as far as overall price is concerned. Although there is still a really interesting dichotomy between the performance of Nvidia, which we've said is our basically barometer of the overall market, and of course then the overall market today, because that disconnect seems like it's widening at least over the last several sessions. But
real quick on that point, that's a really good one. Perhaps Nvidia is keeping the market relatively contained, because you only have about 28 of the 100 names in the NASDAQ higher and only 123 of the 500 S&P names higher. So perhaps the strength that is Nvidia is actually taking a little bit of the steam out of the sun that you do see.
Okay, that's also a really good point, because we'd probably be seeing a far worse day if it wasn't for Nvidia and the semiconductor names, which we'll be actually kicking our show off with our upvote downvote segment. FOMO, we're revisiting the semiconductor trade as we're looking at Super Micro, which is taking off today, up 15%. Remember, that was the best performer in the S&P 500 this year. It no longer holds that title, but still making a really nice move to the upside.
This thing
today.
ain't moving price-wise.
We will also be focused on the strength that continues to surprise to the upside coming out of Chinese e-commerce names led by Alibaba. We'll talk about some of the price activity in that space as well. We'll close things out with under 30 today, looking at Mobileye, which was downgraded by JP Morgan, but one that George Shills, I feel like, has frequently discussed on this show, so we'll revisit his thoughts later on.
Yeah, SMCI, a little sticker shock for me today when I pulled that up and saw the 40 handle, not realizing. I guess I knew the split was coming, but I had forgotten about it. And so for some reason, I just didn't notice that last week. And a little bit of sticker shock. So 10 for 1 in SMCI. That's why you're seeing some different prices. But let's do upvote, downvote, not endorsements, not recommendations. Semiconductor theme here, as you mentioned. On the heels of this huge move in NVIDIA, I think it was Morgan Stanley, Jenny, that reiterated their outperform for NVIDIA, but excitement nonetheless.
Yes, Morgan Stanley reiterating their bullish view on NVIDIA in the context of minor roadmap changes, they said. So they continue to see some upside, $144 price target. Just said that they can expect the sustained momentum despite some of the overall challenges that NVIDIA has faced as of late. So they said unlikely that we'll see actually a pretty major impact by some of these Chinese headwinds. I think that that's an interesting point. But Melius Research was also another note today I saw that noted AI chip stocks have had a rough third quarter, but the rest of this year, they do still believe looks brighter. They highlighted that the semiconductor index dropped about 6% in the third quarter, but chip stocks tend to trade better in the fourth quarter
come on.
basis. And so over the last
You're wasting my time.
highlighted that we have seen now the semiconductor index actually increased by about 9% in the fourth quarter compared to around a 2.5% average gain comparatively. So in the most recent third quarter, we saw semiconductor stocks deal with concerns over gross margins, the sustainability of this AI demand, and rising costs, as well as visibility into what this looks like now into 2025. But they did say that they expect things to perk up into year end, given these strong indications for AI spending. And overall, OpenAI, Microsoft, Google, and Meta are accelerating the release of some of their more useful AI products. They said NVIDIA, AMD, and Broadcom still look like winners in at least the near term. So just one of the bullish notes today I saw on NVIDIA. There's several out there, but no surprise, NVIDIA shares, like we said, up 3.5% today.
Yeah, 90% of the analysts roughly in the buy camp. There are about 10% now in the hold or kind of market perform rating. I'd argue if you're in that camp right now, that's effectively a bearish call on NVIDIA, just how strong it's been and how contrary that is to the public opinion around this stock. So a few willing to dip their toes in, a little bit of a contrarian take now in NVIDIA. What I would say, though, that I find quite fascinating, it's well reported on how strong this stock was last year, but it's almost forgotten that basically the exact time frame of the year that we're just getting through was also pretty sideways last year. Basically from that June quarter, so reported end of May, through basically the end of October last year, the stock was pretty range-bound and sideways. Well, we're kind of watching that take place again in 2024. A lot of legwork in the first half of the year, and then a little bit of a rally into the end of the year really sent NVIDIA to the moon. So I think investors who are bullish NVIDIA are hoping for more of the same.
I would entirely agree, and especially starting off today with a nice, obviously, move to the upside, bucking the overall trend. Next name today here is another of these semiconductor stocks, and actually mentioned in the previous note, that is AMD, which is staring down a possible catalyst later this week as they will hold their Advancing AI event on Thursday. And investors are expecting a host of product news, including a lot around their M1X AI accelerator and the various rendition of that. They also did say that there could be, I mean, this is based on like the street's estimates, that there could be various announcements on AMD central processing units and GPUs, and talk about the company's broader software ecosystem. Can an event like this propel shares higher? Well, last year certainly did. We did see that stock rose about 10% following the event last year. They actually went on to outperform not only the semiconductor index, but also NVIDIA throughout the remainder of this year. However, this does come a bit sooner than it did last year. This event occurred in December of last year, so mind you, timeframes are a bit different when comparing to last year, but there is still the thinking that this could be a pretty major event. So we'll be watching that October, I believe it is October 10th of this week, but this event does come again earlier than last year. I don't know if you can necessarily say that it's outperformed NVIDIA and the semiconductor index for the same time frame, because they're different time frames, Alex. But we do know that AMD needs that leg up right now, as this company has been able to hold on to a gain this year, but it's underperformed, like NVIDIA, for example, by a sizable margin.
Yeah, I don't think the two companies are really fair to compare. I know they're competitors in some ways, but NVIDIA was just so much more prepared for this boom than the other names in this space. AMD, maybe the best of the rest, but still has had its notable struggles. All-time high at 227.30 was back in March, so quite a fall from grace as it did bottom out around, let's call it 120 or so. But nice little run underway over the last few months. Looking to build on some of those successes. You asked the question, can an event like this be a catalyst? Surely, but it can be a catalyst in both directions. So just know that risks are elevated maybe in a name like in AMD at the moment, with that kind of binary event on the calendar. Next one though is TSM. No surprise to me that it's doing quite nicely today. This name is so correlated to NVIDIA as its sort of key manufacturing business partner, I would argue, for actually getting those products made. NVIDIA more of the designer, TSM actually in the factory, actually getting these things made.
Yeah, and I will say that this name has also been a really strong player on the year. I mean, we're up over 75% year to date. We've risen substantially over 100% off its 52-week lows, and continuing to gain some wins here as its semiconductor fab construction in Germany has received now several accolades. So it's a 12-inch plant worth roughly $11 billion. It broke ground back in August. Taiwan has said that the complete support to Europe in developing its domestic semiconductor base has been one that's been very closely watched, but because of the focus on this company and its supply chain and the onset right now of demand for its various, foundry business, it's definitely one that's been more closely watched, I believe, because again, timelines for this company matter to so many other companies. But they did say that they expect the total trade between now Taiwan and Germany, which has been more and more lucrative as of late, to top around $22 billion. And a lot have said this is an interesting way to push out their AI ambitions, because as we know, with the various expenses of operating in different countries, like here in the US is relatively expensive for Taiwan Semi, that finding these new partnerships like between them and Germany has become more and more interesting. So I do think that Taiwan is perhaps one of the more overlooked. I know not to say it's overlooked, but I always think this is one of the most interesting parts of the AI trade because it's the base of so much of everything else we talk about.
Yeah, they have maybe more steady, transparent revenue streams, and if there's still demand, they're still going to be working on things, but maybe not the asymmetric upside of the designer themselves who can kind of mark these prices up. But analysts like this stock even more than NVIDIA in terms of percentages breakdown. Almost 96% of analysts are in the buy camp, with one sole non-buy analyst who is in the hold camp, at least in the ones that are compiled by Bloomberg. That's TD Cowen's Chris Sankar, who has a 170 price target, so a little bit more neutral to bearish relative to his peers. The peers, though, 215 is the consensus price target for 12 months, and that applies about 17% upside. So still a little bit of optimism brewing for TSM, the stock ticker, of course. Last one, NXPI. This is one I gotta admit is a little bit overlooked for me at times. But it's largely hung in there. It looks a lot like the AMB chart, the Dell chart, a lot of these names, Micron, where it's a little bit more volatile, but maybe a little bit more disappointing on a shorter term basis.
Okay, to be completely honest with you, this is our worst performer, I believe, of the group, and also, to me, definitely the most overlooked. I was saying Taiwan was overlooked, but that was absolutely not true compared to NXPI, which just tends to, trade with a bit more volatility. Now, UBS did upgrade shares to buy from neutral, saying the company is best in class, which is a huge reason, actually. It was even on my radar, because to say this name, which is relatively overlooked, is best in class, then I think warrants some attention here. They said that NXP has outperformed the
NXP, huh?
year to date, up about 6% versus its peers, which are down about 7% on average, driven by this, again, best-in-class inventory management and relative resilience through the recent downward cycle. So, amazingly so, this name
What's
is
the name of the
pretty
ticker?
mixed among those analysts that cover it. There are 18 buys, 10 holds. There's not a single underperform, but one lone sell. So it's definitely skewing to the more optimistic camp, but there is still a sell analyst. And we do have earnings November 4th. So that does give us about a month out until their earnings. A lot of these names that report sooner than that, like Taiwan Semi is October 17th and AMD is October 29th. So we get earnings in the coming weeks for all these names, Alex.
Yeah, the sell is Chris Danley over at Citi, but that hasn't been updated since mid-July, so perhaps there'll be something that changes. I did see the analyst at Goldman that covers this stock issued a reiteration of their neutral rating with the 277 price target today as well. So a name that still has some optimism, but it is a little bit more mixed in terms of that breakdown. But the consensus price target, which again is a little bit less agreed upon, it's close to 300 a share. So definitely some upside if that were to happen over the next 12 months.
Yeah, and hopefully, I guess maybe to see some outsized performance because that name has not been able to do so as of late. But we'll be diving more into our two upvoted names today. We'll be looking at those that actually have earnings on the more near-term horizon, that being AMD as well as Taiwan Semi. Down Action Investing. We'll be right back.
God. Blanket. Stop teasing me. We had an ascending triangle, and then we have this another one right here. That's two ascending triangles. So screw it and get out of these so I don't have to watch it. We've got 10 more minutes, 11 minutes for the fat cats to come back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade. giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Choices? What the fuck are you talking
Schwab,
about?
I can get full service wealth management, advice,
Choices?
and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
What are you doing to me, Schwab?
Welcome back to Next Gen Investing. It's now time for our Chartmaster segment. So joining me is the Chartmaster himself, Rick Ducat, to help us break down the technicals in two of our semiconductor names. We'll start off with AMD, which has a lot to look forward to this week. Not an earnings event, but we do get some degree of update on their various products and hopefully some software, hardware design. So Rick, walk us through what we can watch on the near-term horizon as far as the chart is telling you.
Yeah, always an interesting sector to be focusing on here, a frequent source of interesting news and what have you. But when we look at this chart, we can see that the prevailing trend for much of this year has been downward. We can see we were traveling downward through from those 52-week highs, connecting across the subsequent highs here, and we can see that that was a situation that has been broken recently here. We can see that we traveled upward through that area. We took out our moving averages in rapid succession here, moving above all of them quickly. We can see also a shallow down or uptrend here, starting with these lows and giving us that triangular shape that we have pushed out of up to the upside here. We went back, retested our old trend line. Now we have our sights set on this small gap right here. That would be the next stopping point near about 174.50. So we can see that this has certainly been on the move. It's looking like we could be in for a potential trend change from downward to upward here. And it wasn't even the most severe downward trend, kind of a, really more sideways with a slight downward bias almost, but perhaps a turnaround in the works for this name.
Yeah, so now when we see some of the momentum behind this recent turnaround, Rick, what is RSI? What are you watching as far as like the momentum indicators here?
Yeah, RSI is a useful way to help assess the strength of the direction of travel for price action here. When we look at RSI, we can see that it's kind of matching up with our channel type shape here, our white trend line, starting with that low point and just duplicated and put across the highs here. We've got a similar picture taking place in this momentum indicator. We are above the 50 midline here. We are still keeping true to our upward sloping green trend line there. However, a bit of a problem here is developing today because we are making a relative high close above our previous close. So you can see right here we're above where we were at our past peak. However, RSI is actually lower. So that's not exactly what you'd want to see. It's a bit of a mismatch between the momentum and the price action called bearish divergence here. So not exactly what the bulls would want to see, but there's still hope. We've still got some time here. A bit more price lift to our shares here would give us the needed peak on the RSI that would surpass the previous peak here. So wait till the close. Don't jump the gun. Don't make trading decisions based on intraday fluctuations.
Yeah, and that's also a good takeaway here, I'd say, for most of these names, especially the semiconductor stocks, which do tend to have obviously very volatile trading sessions. But to close things out here, what are we watching in the near term as far as some support, resistance, and key price levels?
Sure. The area that I mentioned earlier, our red line, 174.53, was the low point before we had a gap down back in June around that time period here. We're getting quite close to that point now. So if we were to break above that area, the next spot many traders likely would have their eyes on are the series of highs here. So we topped out around 188 3 times before being rejected and faltering notably there.
That cat's back in 5 minutes.
Potential hurdle on the path to further upside here. To the downside, volume profile point of control 165, area of heaviest trading on our chart.
It's been a tough trade to follow right here.
Support or resistance. In this case, it will be support because we
Just
are above
not
it.
there.
Then we've got our yellow 21-day EMA matching up rather closely with the recent lows near about 158. Beyond that, you know, we've got our moving average. We've got some more lows. There's quite a bit to choose
Very
from
tempting
to the
to sell it.
downside. Those are the nearest term points of interest.
Yeah, so lots to look at when you come across AMD here, and obviously making a slight move to the upside today. So with all this in mind, and say you're a believer in some of its recent underperformance, you think we could recapture some of that strength, but hopefully following the event we have later this week on Thursday, but say looking to lean into a more neutral or bullish example trade.
Yeah, we're looking at with selling a put vertical below the market here, Jenny, in this particular name. Reason being, there is that excitement around this event. There is earnings starting to kick off. AMD is on the earlier side for semiconductors, but not one of the first names that we see. But I did elect to go out and capture all those events within it by going to the November 15th expiration cycle. Selling the 160, 155 put vertical for $1.70 credit would generate about a 2-to-1 risk reward, where you'll be risking $330 with a chance to make $170 over the life cycle of this particular trade in these options. Neutral to bullish, as I said, stay above 160. That's what you're hoping for with this. Break even, you find that by taking that credit received, subtract it from the short strike and the short put vertical, which is 160 in this case. $1.70 credit taken away gives you 158.30. Risk on the trade, $5 wide spread, none of that credit leaves 330. So again, about a 2-to-1 risk reward, Jenny. Neutral to bullish, looking for the stock to hold on to that 160 mark over the next month or so.
Okay, yeah, now in shifting gears to Taiwan Semiconductor, which has been a bit of an outperformer relative to AMD, but has also not been quite the behemoth that has been all things NVIDIA. So still a very important name. This name has actually earnings a little bit sooner on October 17th, I believe. So Rick, walk us through what you're seeing in this chart.
A rather different chart than our last entry here. And when we look at this one, we can see that this recent low point, we touched on our purple 252-day EMA, an important source of technical support here that did hold true in this case after a lengthy slide to the downside after hitting those 52-week highs near 193. From there, we have seem to have righted the ship and made some nice progress to the upside here. 175 was a repeated ceiling here that price did manage to power its way through to the upside here. We went back, we retested it, we stabilized around the yellow 21-day EMA. These next series of lows here fall in line with our trend line here. So we connected these ones here, and this was a pretty good indication of where we would have found some support there. We had a nice confluence between the trend line and the 21-day EMA and the old highs there. So a supportive point that did hold on. However, we still haven't managed to take out our previous highs, and we also haven't invalidated our downward sloping blue trend line that began with those 52-week highs. So even though we've had our breakout above a resistance point, to be sure, that is notable, but we still haven't really crossed any significant thresholds in terms of our actual high points that we've seen this year.
Okay, Ryan, we have pulled back from highs, I mean, of this year by about 4.6% here in real time. So with all this in mind now, what is momentum? What does the recent RSI tell you about the strength of what is considerably still an uptrend? I mean, 200-day moving average definitely is still trending in the right direction.
For the most part, when we look at RSI, we're seeing a match between the price action and this indicator that shows us the strength of the price movement here. So we can see once again our trend line that we have carved out here pretty much matches up with these low points that we saw on the RSI. We are above the 50 midline. We are holding true to the trend line. So things are pretty much just behaving as expected, not really seeing any notable divergences or anything like we saw on our last chart here. What the bulls would want to see, once again, just kind of to reiterate the behavior that you'd want to see if you were looking for further upside in this stock, you'd want to take out these old highs on the RSI in tandem with price, and you would also eventually want to see a push into that overbought area, typically regarded as a sign of strength in a trending market. That would be a further bullish cue for traders. And from that point, the likely target would be those old highs then. That would be the next stepping stone here.
Okay, yeah, so now when we look at some more near-term price levels, and we don't really have anything going on this week that I could see, so we just have, you know, these sort of ancillary catalysts as far as the overall market's concerned, but up 1.8% today, and obviously up, I mean, a winner on the year, no doubt. So what are we watching as far as some near-term price?
Sure. So, like I said, blue trend line here in these old highs, right around like 190 or so. That's the first step that we'd want to take out to the upside here. And, you know, perhaps even then take out the upper boundary of our wedge type shape and those previous highs near 193.47. We've got a bit of work to do to get to that point, though. Still a bit away from it. But that's where some traders probably would be starting to look for potential resistance. Those seem like some, you know, just conventional points that many people would have their eyes on here. To the downside, our green line, 175, as I mentioned before, a repeated stopping point for price that we did eventually get an energetic breakout through to the upside here. So that also, as I said, lines up with our 21-day EMA and our trend line there. So around 175 is another holdout point for potential support here. Beyond that, 63-day EMA lines up with our volume profile point of control at 170 to provide us with another area of interest.
Yeah, and I would say that this has been a really fun one to watch all this year. So we will be keeping that one on our radar. Appreciate the technical insight. As always, Rick Ducat, our chart master. And now we think about trading this name, Alex. And so say, looking to lean into some bullish example strategies here, just based on the recent bullish activity. I know we've pulled back, but we're still up 77% this year.
Yeah, no doubt. This one a little bit more exciting amongst the analyst world. Certainly doing a little bit better recently as well. But looking at buying a call vertical in this particular asset as opposed to selling the put vertical like we did in AMD. Going out to just next week's expiration though, the 182.5, 187 call vertical. Looking to spend around a 250 debit. That'd be 1/2 the width of the $5 wide spread. So you're risking 250. With a chance to make 250. Break even at 185. You find that by simply adding that debit to the long call. So in this case, that's the 182.5 call. Added 250 to that, about 185. And then, of course, equal risk to reward. One of our loose guidelines for this style of trade, 1 strike in the money, 1 strike out, and break even near the current share price. Well, the current share price is at 184.55. So, you know, within a stone's throw, one could say, of 185. So kind of loosely checking those guidelines that we use when structuring this strategy. But like all strategies, you need a particular outcome to get that desired profit. In this particular case, you need to move above 187.5 to get max profit, and that needs to happen by the end of next week.
Yeah, and I will say this one will be interesting to watch because we do have earnings coming in just the coming weeks, which I cannot believe we're already talking about like middle of October, end of November earnings. It feels like this year has flown by, but we'll leave it there for our Chart Master segment. Coming up next though, we're not changing our conversation up too much as we're continuing the semiconductor talk focused on super microcomputer, which is up 14% on the session, getting a much needed lift today. After the company announced some positive shipment data. We'll dive more into that with Caroline Woods coming up next.
Positive shipment data.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
At each and every angle, the whole picture, everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial...
Big knife there on my stocky.
Crazy political week. Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time for FOMO. Today we're looking at the leader of the semiconductor space, that is Supermicro Computer, up over 14% on the session. And I mean, a much needed move to the upside in this name that has been, coming off of highs pretty substantially. So here to tell us more what's driving this optimism today, I'd like to welcome in Caroline Wood, Senior Markets Correspondent for the network. So Caroline, granted, this name's still up 65% this year, but anyone that's followed this name, as we've talked about it probably 100 times this year, knows that a 62% pullback from highs it's pretty brutal.
Yeah, it certainly is, but we're seeing that much needed boost, as you said, with shares up about 14% today. It's the best performing stock on the S&P 500. Not every day that we can say that for Supermicro, especially since earlier this year, but this comes after Supermicro said it deployed more than 100,000 GPUs with liquid cooling solution to some of the largest AI factories ever built. AI requires a lot of power. In turn, server makers they're promoting these liquid cooling solutions that keep hardware from overheating so that they can run more effectively. So Supermicro said its direct liquid cooling delivers several advantages over air cooling, including up to 40% energy savings for infrastructure and then 80% space savings. So Supermicro said these more than 100,000 per quarter.
Liquid cooling.
Its position as a leader in complete rack-scale liquid cooling solutions, revolutionizing data center infrastructure toward green computing. So there is some speculation that some of those GPUs could be headed to Elon Musk's AI company, xAI, because earlier this summer on July 1st, CEO Charles Liang posted on X saying, "Thanks Elon Musk for leading the liquid cooling technology to large AI data centers. This may lead to preserving 20 billion trees for our planet." So investors are clearly happy about this announcement because it shows that demand for Supermicro servers is strong right now, and it's of course a welcome boost to shares because they've been certainly under pressure for several reasons, including the scathing short seller report, which alleges glaring accounting red flags, evidence of undisclosed related party transactions, sanctions, and export control failures, and customer issues. There's also Supermicro had to delay its annual 10K filing, said that they don't expect much material change to the numbers, but that of course added pressure to shares as well. And then of course there was the report that the DOJ is currently investigating Supermicro as well, which added to weakness in shares as well. So shares are up about 14% right now up about 65% year to date, as you said, Jenny. But I think the perspective is really looking at the chart here. And, if you just saw 65% year to date, you'd say that's pretty impressive. But if you take a look, keep in mind this had the stock split last week, a 10-for-1 stock split. So the stock price a little bit different in terms of the numbers that we're talking about now. But they're below $50 a share right now. And earlier this year, they were above $120 a share, as you can see at the peak, or right around $120 a share at the peak. So it's had a 60% fall from grace. So a rebound today, but a long way off of those earlier highs.
Yeah, that's why entry price is really what matters, right? If you got in during those highs, you have a much different experience than someone who got in last year or even yesterday. So very, very interesting stock. You mentioned the stock split, something to remind at 10-for-1. So you do have some sticker shock, but Caroline, when you're looking at this name, I see a lot of analysts seem to move to neutral or hold in the last month as some of those headlines broke. KeyBank just outright suspended coverage. a lot of these allegations just kind of call into question the reliability of some of the numbers. If you're an analyst, you're looking at those numbers, you're using that to generate your opinion. Like, I could see how this would be difficult when a lot of that uncertainty kind of makes things unquantifiable.
Yeah, and you're seeing a lot of that play out on X right now in response to the move higher in Supermicro. There's a lot of kind of jokes about investors forgetting about everything else that Supermicro is facing and just focusing on the positive today. But we do see the majority of analysts in the hold camp, despite the fact that previously Supermicro was such a huge AI beneficiary. More than 50% of analysts have a hold rating on shares. Only 6% have a sell, so it's not that there's a lot of all-out bears. But if you take a look at the median price target, it's come down substantially over the past several months. The median price target now is $65 a share. So as I said, it's currently trading, you can see here, right below $47 a share. But if you take a look, just even earlier in July, it was the median price target was 103. So it's definitely, I'm sure, been difficult for analysts to navigate, especially since, the short seller report, is designed to also make money to get people to short shares, or they're shorting shares. So they're profiting when the shares actually fall. So, there are allegations at this point, same with the DOJ investigations report, and then the delayed 10K filing. We don't know how much is actually going to change in terms of the numbers. They made it seem like it's not necessarily going to create any change, or they didn't anticipate it would lead to any material change, but there are a lot of question marks around this name, and I think that just based on the analyst recommendations, it shows that the majority just want to sit out on the sidelines for this one and probably wait till some of these question marks become a little bit more confirmed.
Yeah, no, I can totally understand that way of thinking, Caroline, because I have dug into everything you were saying, basically, like the bullish case, the bearish case, and I feel like it's not great anytime a company basically acknowledges the accusations of a short report, but it's also at the same time maybe what they were somewhat forced to do at this point, a bit cornered into that 10K delayed, of course. So I think will be interesting to see any update we get. I believe it's the end of October we hear of their quarterly earnings. So we'll leave it there. Great insight as always, Caroline Wood, Senior Markets Correspondent for the network. And so we trade this name now, Alex. And I think that today, definitely having a FOMO type feeling, but you wouldn't have the same FOMO, I think, if you got in around $120 a share. Obviously, it's been a bit of a fall from grace here, from 62% off of those all-time highs of shares, and this was at one point like the AI winner. Obviously, that day has, not been in its favor as in several straight months, but doesn't mean we can't see some optimism now, and we can't recover here.
You mentioned
Too
earnings
close
at
to
the
the
end of month. I
highway.
think that's something to have on the radar if you're involved in this stock, just because there is those questions that are overhanging the stock at the moment, clouding kind of maybe where this thing goes. And so if there are answers, there could be volatility in both directions. So something to note for sure, maybe more so than normal around earnings for this particular name. So I like to keep the example trade very, very short term, and also very, very risk defined. So if it does have some sort of, binary type of news item that really sends this stock moving one way or another, you're only exposed to the risk theoretically tied to the max loss of this particular trade. So now that it's post-split, it's a much cheaper per share stock. Of course, that doesn't change the value of the company, just change the value of each individual stock share. But allows us to trade this a little bit smaller for an example purpose. So what I looked at was selling this Friday's 50 call, buying next Friday's 50 call, creating a call calendar. Debit of 75 cents would be $75 in risk. So for context, the first trade we looked at was $330 theoretical risk. The second trade we looked at today was a $250 theoretical risk. This one's a $75 risk, so smaller than all of them by a pretty wide margin. Now, I'd also say it might have the lowest probability of success, as we call this sort of the one where you're almost throwing a dart at a particular price level. Now, I selected 50. That was the lower end of sort of where this stock had been earlier on this year, and perhaps it's where it could run into some resistance if it does continue higher. Very customizable strategy, but most importantly, risk-defined, because there is a lot of uncertainty at the moment with this name, which can lead to a lot of opportunity, but of course it leads to a lot of risk as well.
Yeah, and I will say that there's definitely that risky type feeling, and Caroline mentioned a more sideline approach from the analyst community. I think that sideline approach is even being echoed right now in the recent share price, as it's been stuck somewhat in this new recent range. 200-day moving average still trending to the upside, but the 50 is plummeting here in real time, even with this nice 14% move to the upside today. We'll leave it there, though, for FOMO. Now, coming up next, time to talk another area of the market that has generated a very FOMO-type feeling, at least as of the last several weeks. That is Alibaba and the rest of the Chinese e-commerce players continuing to surge on this week, really fueling a phenomenal recovery in a lot of these names.
Do 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 do.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. I'd now like to welcome in Kevin Green, Senior Markets Correspondent for the network, to help us break down some of the recent analyst praise on Alibaba. And I mean, all of the Chinese e-commerce names, it feels like, Kevin, have been caught up in this recent momentum shift. And I mean, it's a recovery story because, frankly, anyone knows from watching Alibaba calling for the bottom in China, it's been impossible. But we have seen some momentum that's held. So walk us through this recent story.
Yeah.
This one's actually a very interesting one because it's been a tone shift since their last earnings announcement here. We do have Macquarie actually upgrading the stock to outperform from neutral with a price target of $145, and that's up from $79.70. Now, they do believe that there's going to be more upside when it comes to the China internet sector, and they do believe that Alibaba is going to benefit. They believe that the current multiples are only half of what they've seen in Q1 2023 levels, and they have significantly better fundamentals since that time period here. So they do believe that aligning those valuations going into 2025, they do believe that the stock actually can appreciate into their multiple because of some of this optimism. The reason why I find that this is actually kind of funny is because Alibaba's earnings last quarter were not great by any stretch of the imagination, and they continue to see weakness when it came to retail sales and then trying to right-size their internet business, especially when they're looking at the expansion of their AI product offering. But apparently, we had this analyst that now thinks that earnings announcement and future earnings announcements are going to actually be better for this landscape, and because of the China stimulus measures that are out there, they believe that the stock can actually appreciate in value. I found this one to be very interesting because no one was singing this tune when we saw their earnings come out a couple of weeks ago.
Kevin, do you think that some of this move could be one of these three factors or a combination of the three, perhaps some sort of short or gamma squeeze? I know they're different but have similar outcomes in terms of price, or some sort of momentum chasing strategies, because look, I know that the stimulus could help, but we just repriced some of these stocks. I mean, as if, they just reinvented the wheel. 30, 40% in a couple weeks, it's not like Alibaba is just some unknown commodity.
Yeah, so is this, I'll answer both of those questions. Is it a gamma squeeze? No, not by any stretch of the imagination. Not a lot of options interest actually before we actually saw this spike to the upside here. And usually when you have to have a gamma squeeze, you have to have a significant amount of call buying taking place, a lot of open interest at a particular strike price, and you have this massive and rapid spike to the upside that catches market makers off guard. That was not the case here for Alibaba. And then from a short standpoint, a lot of investors, especially bigger, not ETFs, but bigger money managers that look to try to short stocks, really don't target the Chinese stocks that much. And so Alibaba, even though we kind of look at it as a very big name and it's one of the main ones that we have exposure to here in the United States, if you're kind of looking at the float, there's not that much that's out there, and the short interest wasn't that severe. This is actually new buyers really stepping in. This is truly FOMO that is taking place, where people are just continuing to buy and buy and buy. But when you're looking at the 3-year weekly chart, you can actually see we are coming up to an area of resistance around $120 here. So this is going to be the next area for us to try to break through on large volume and try to move higher. I would just be very, very cautious, because as soon as we see a fade in this move, or people stop talking about it, the reversal of this type of price action can actually be very aggressive. I think I'm kind of equating this to the uranium trade, the first uranium trade that we saw about 6 months ago, or even the first silver trade that we saw about 6 months ago, where everybody wanted to get into silver until it was not the cool thing to do anymore, and we saw it kind of leveling off, consolidate, and then trying to push higher.
Yeah, and Kevin, that's exactly what I was actually going to ask you about. It's like, is there any risk now to the downside? Because I just know from following this name, reporting on Alibaba for the better part of the last 5 years, that I mean, I have seen these moments of strength that are followed by severe moments of downturn, and obviously that's not always the case, but I do think that's the risk of a stimulus-led rally, because, I mean, it wasn't like this company, fundamentally speaking, was exactly sound prior to the stimulus. This is just like the near-term boost.
Yeah, I agree with you. I mean, obviously we have a lot of optimism, and everything that China is doing, hopefully it's going to be able to spark consumer demand there, and Alibaba can be a beneficiary of that. But I think you want to really kind of see it in the macro data, or even in the company's specific data first before going all in. And we also have to just keep in mind too, the geopolitical risk that is still out there between the US and China can impact a lot of these shares that are being traded here, or these ADRs being traded here, and vice versa. We've seen in the past, 3 years, 4 years ago, where a significant amount of Chinese stocks or Chinese related stocks were actually taken off exchange, and there was a whole debacle and fiasco that took place there. So I would be very, very cautious. Not saying that there's anything wrong with Alibaba, but the move has moved up a little bit more aggressively than the fundamentals should suggest at this point. And any type of unwinding of that can be severe and aggressive. I would tread lightly, wait for the macro data from China to really support the narrative that stimulus is actually taking hold, and then also taking into account the fundamental data from the company that actually shows that consumer demand is actually sparking back to the upside, as well as when you're looking at some of the other technological exposure that they have when considering AI.
Yeah, I think a good way to close things out, and a good way to look at Alibaba and the rest of this space, as I'm sure we'll be revisiting the entire e-commerce trade for the Chinese stocks, Kevin, at some point this week, but good way to start off this week. Kevin Green, senior markets correspondent for the network. Now, coming up next, it's time for Under 30. Today we are talking Mobileye, a name moving to the downside, actually. I believe one of the first throughout our coverage today. Mobileye down 3% after a more pessimistic tone out of JP Morgan, downgrading shares. We'll dive more into that with George coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
We just lost support. This could get ugly now. Time to make a cup of coffee.
Welcome back to Next Gen Investing. It's time for Under 30. Today we discuss Mobileye, the autonomous driving technology company. Joining us now, George Tillis, Senior Markets Correspondent for the Schwab Network. George, more bad news for the company. JP Morgan downgrading stock shares to underweight. Some of these names just can't catch a break.
No, and this one is one of them. You know, ideally speaking, I think we've talked about this one, or at least I've talked about this on another program, the stock, Mobileye, which is essentially one of these driver-assisted technology companies with about 5% market share in particular technologies that help drive
569.80
assist, emergency braking, intelligent speed assistance, in other words, like distance pacing, cruise control. They've actually, focused a lot of their business on LiDAR technologies, light-driven radar technologies. They're actually divesting of that, and they're focusing on their IQ or supervision technology.
You got 569.80 as the first support.
Technology driven in the future, and there's a few things really going on with the company. One is, they have about 5% market share of the traditional lane keep assist and driver technologies out there. But when it comes down to the next gen technologies like fully autonomous driving, they are facing lots of competition.
Yeah, that's what we got.
Think about NXPI and Qualcomm, Google's Waymo. You've got GM and their cruise division, and Tesla is another potential competitor of Mobileye. The other thing about Mobileye is it was spun off from Intel going back to 2022 in Q4 of that year, and since then the stock has been trading down, and in fact the stock is down about 68% this year. I think a part of this movement in Mobileye is Intel's stake in the company, which is still close to 90%. It's about 88% total outstanding shares. With Intel actually moving down, there's always going to be some fear that they need to raise cash and potentially will divest or spin off or even sell some shares of Mobileye, and that's further depressing the Mobileye shares. So I think the outcomes for Mobileye in the long run are what's going on with profitability and growth. And unfortunately for the company, the growth rates are expected to be in mid-single digits. But after JP Morgan's call today, which is actually the most bearish out there with a $10 price target coming off the back of BNP Paribas, which downgraded the stock last week with a $12 price target, they're actually seeing challenges in sales going all the way into the end of the decade, all the way to 2030. And I think competition is a challenge. And the other thing is partnerships like Geely in China, Stellantis and Volkswagen in Europe. European auto sales and even Chinese auto sales have been facing competition as well as decreased margins.
So George, as far as then future growth prospects, what can really get that maybe the more bullish camp excited about this thing? Because I mean, you painted a relatively grim picture. JP Morgan painted a pretty grim picture today. I mean, what's then the next catalyst for this company to actually start turning some more consistent revenue and profitability, frankly?
Well, I mean, that's a good question. I can't say exactly. Ideally speaking, maybe a turnaround in auto sales would certainly help. Adoption from maybe another major auto manufacturer, let's say Toyota or Honda, outside of the core European markets and the Chinese markets that Mobileye has, that could certainly help. More traditional automaker partnerships, because Toyota and Honda seem to be more focused on hybrid technologies versus EV technologies. But nonetheless, the other thing I think that could turn around the stock.
Tampa Bay's about to get another spanking.
Intel catches a bid. There's talk about Qualcomm buying Intel. I'm just speculating here. That's all still speculation. I think that ownership stake will be worth more, and that could certainly be a catalyst for Mobileye shares because Intel owns the majority.
NVIDIA new highs.
To think about, but unfortunately for Mobileye, they took down in Q1 a massive inventory write-down. prices have been falling, inventories are being, withered away. But slowly but surely, if you look at next year's earnings compared to this year's, they're expected to earn 23 cents this year, 51 cents next year. So it's a double in terms of earnings, but unfortunately that forward multiple is still quite high at around 27 times, with EBITDA growth still contraction or negative.
George, does a name like this also highlight the risks that are present in names that kind of only do one thing? I know it was spun off as sort of a value unlock situation, but I mean, you can get similar exposures in Tesla to this technology, but you also have a manufacturing company that makes cars.
Correct. I mean, so, you have to think about Mobileye. They basically hold patents and technologies that go into cars. They're not relying on any specific automaker or any specific type of vehicle because their technologies are used across the board. I just think competition has really been, breathing down the neck of Mobileye. That's been the challenge. And this is what JP Morgan also talks about, but also is, it's advanced vision technology or IQ technologies maybe facing stiff competition for the next secular technologies, which are fully autonomous driving.
Yeah, and I think that's a good way to close things out here, George. And of course, Mobileye lower today, but a name that we'll hope for some recovery in Intel, and maybe that will be obviously a benefit to Mobileye. It's a great point. It's George Schell's senior markets correspondent for the network, and that'll do it for Alex and myself. For Next Gen Investing for this Monday, stick around. We have the watch list with Nicole Petalides coming up next.
This election season, stay out of the muck and the mudsling with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week it's going to be a crazy political week. Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job.
My job is just to make money. Microsoft ain't had a good outing last 3 weeks. Right now it's almost 2 o'clock Eastern time. I think that girl was a little hard on that guy. But she is cute. This PX trying, but I'm not too happy with it right now. I need 61 pennies. My job is to make sure that I make a money. Trump 50%. Oh. Democrat institution, huh? I don't see how anybody could be undecided. I really don't.
China.
Ah, what a poop. These suckers ain't gonna let me win today.
Danger! Danger, Will Robinson!
Yep. It's clear.
Lot to discuss. Not only do we have bank earnings at the end of the week, but also we have inflation prints, CPI and PPI, and a market that's coming off some records. So we do have down arrows today, and you did have on the other side Goldman Sachs raising their price target to 6,000. That's the third time Goldman's raising their target. So some of your thoughts about where we could be headed.
I mean, with the Federal Reserve, as you know, lowered interest rates by 0.5 point. That's an emergency move. Well, maybe they're seeing something that we're not seeing out there, and maybe that does allow for a soft landing for Wall Street, but not for Main Street. And here's what I mean: our clients, they're looking at the market. The market's up big since January 2021. But you know what's up bigger than the market? The price of energy. the price of food and rent. And so what's happening for our clients, and our clients are, within about 5 or 10 years of retirement or in retirement, they look at this market and they're concerned because they're having trouble making ends meet because the earnings from their portfolios aren't covering their cost of living anymore. So it puts them in a super tight situation, and they're concerned about the market right here.
Yeah, understood. I mean, are you
And Wall
thinking
Street
more
wants
rate
Kamala to
cuts
win.
in November and December?
We are expecting more rate cuts. And when we have the Fed looking at the unemployment numbers and the other indicators out there, we are expecting more rate cuts. But really, it drives me crazy, Nicole, when we hear those people from Washington stand at the podium and say inflation is down. No, it's not. Inflation's up. It's up big over the last 3 or 4 years.
Exactly.
And the rate of inflation has slowed, but the cost of energy hasn't really gone down. The cost of food hasn't gone down, so it's eating into the nest egg. So we are expecting rates to go down further.
It just ain't gonna go down.
About the risks in the market, the geopolitical.
It just ain't gonna happen, buddy.
With Iran and Israel,
It's the way it is.
Ukraine and Russia, and our biggest adversary is China. We act like they're friends, but in fact, they treat us like adversaries. So those are all big concerns in the market right now. So we work with people. We say to them, listen, and they're dependent upon us to make sure their nest egg is intact. So we make sure their money's protected against losses, and they're still earning a reasonable rate of return.
How do you do that?
We put together, I think I've shown this to you before, but we put together this investor's guide where investors can look and learn how to have their money protected against
Oh my God.
losses and growing at the same time. So
That looked like a killer thing, whatever it was.
but insulate themselves against the market correction or crash that historically speaking, because history repeats itself, we know it's going to come. We've got to be protected against losses and growing at the same time.
Right. I mean, I understand what you're saying. It's still an inflationary environment. I mean, shelter is still hot. Some food is still hot. Certainly well off.
Rent's still high.
To your point, I know what you're saying, because we came from 9% down to 3%, but there are still some things that are still very elevated. That being said,
Everything
what do you
is.
tell clients to do? Because you do have something that's happened with the 10-year bond, and that's back above 4%. We've had a reinversion of the yield curve. Maybe this is not exactly what the Fed was going for.
Maybe not. The Fed they're very, very limited in the levers that they have at this point. And so effectively, we talk to clients, we say you should have the percentage equal to your age protected against losses. So I'm 58 years old. I should have at least 58% of my money completely protected against market losses. It's still growing, but protected against market losses. I personally have even more than that, and the money is growing, but if the market goes down, I'm not going to lose 1 red cent, and that's what we do for our clients. Our clients depend upon us.
Dang, guy.
They don't go backwards when the market goes backwards and still earn a reasonable rate of return and keep up with inflation.
How do you
That's
do
the name
that?
of the game, safety and growth at the same time. That's our niche, and that's where our clients come to us.
Yeah, are you looking for value stocks, dividend-paying stocks? What kind of safety do you look for the clients?
When I say safety, I mean completely protected against market losses. FDIC insurance, treasury bonds, guaranteed insurance contracts. So in FDIC insurance, and I know it's boring, Nicole, but a money market account pays 4.5 right now. You go to a treasury, you can get in the 4 range. A guaranteed insurance contract like we do for our clients, where your money's protected against losses. You go up with the market, your gains lock in on an annual basis, and when the market goes down, you don't lose anything. Those average historically about 6 to 8% right now. You can still lock in the high rates before interest rates go down any further. That's the place that we're moving a great deal of money into that area because it's safe and it grows. Safety and growth. That's a story that we talk to our clients about, and that's what we do for them, and that's what they want when they come to us.
All right. When you think about equities at all, is there any sort of sector that you like more than others at this point, even for short-term or long-term?
Well, as long as you have the money completely, you have the bulk of your money completely protected against losses, there is some room for some speculation. I mean, maybe AI stocks, maybe some of the tech stocks that are down a little bit today. That makes sense, but our niche is the protected money, protected against market losses. So we're not trying to double your money overnight. We're trying to make sure our clients earn a reasonable rate of return. Not sexy, but we're there day in and day out. Compound interest, year in, year out. That's what we do for our clients.
Yeah, understood. When you think about things like oil sneaking higher here, are people talking about that?
Without a doubt. It's a question that people have, you know, does the price of oil mean the price of gas is going up? And obviously the price of oil has a direct relationship to the cost of gas. I mean, it's got to be refined and so forth. But yeah, people are concerned about that. But they're concerned about it from the standpoint of they have to buy energy, they have to heat their homes, they have to put gas in their cars. But certainly that's something that they're talking.
How would you describe how you feel about the market? Because I know that you sort of have a protective stance, a defensive stance. You have a lot of wealth clients who just want to make sure they keep the principal. I mean, are you generally bullish on the market or no?
Love the market. Very, very, very bullish. Here's the thing, though. The market has, over the last 10, 20 years, has been trading on what the Federal Reserve does, right? The Federal Reserve just lowered interest rates. I expect the market to do very well. I also have played musical chairs in my life. You want to make sure you have a chair when the music stops. We want to make sure we have a chair for our clients. So I love the market. I'm bullish on the market. But when it goes down, and if history repeats itself, and it tends to do that, we don't want to go backwards. So love the market, but in a smart way for our clients. We are willing to give up some of the upside of the market to make sure we don't get hurt on the downside. We don't have to make as much on the upside if we never lose anything on the downside and earn a reasonable rate of return. But to your question, I love the market. This is the greatest market in the world. This is the engine that's driven wealth for 100 years now, more. So yeah, love it, but I want to be in there in a smart way on behalf of my clients. We don't want to get hurt because they're in retirement and they depend on us to make sure that they have, bless you, that they have their money growing and in a place where they can take income to live on when they need it.
Thank you, and thank you. Ty J. Young, CEO of Ty J. Young Wealth Management. Much appreciated.
Thanks, Nicole. Thank you.
Coming up next, Options Corner. Rick Ducat joins us to highlight unusual options activity from the day, how investors are looking to trade on the recent news of Pfizer, United Airlines, JP Morgan. We'll have that for you here on 360. We'll be right back.
Dow Jones down 329.
With the Schwab Network. Available anytime, anywhere, on any device, for free. Schwab Network.
NVIDIA has a 1, 2, 3 pullback.
Fascinating.
Trading the trending names every day.
Move it.
I'm Tom White, host of Fast Market. Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Back to the watch list. Time for Options Corner, where we analyze unusual options trades we're seeing throughout the day. We welcome in Rick Ducat to take a look and find some options that these are real trades, folks, that he's found. I mean, of course, Pfizer makes big news today with Starboard investing, right, putting a $1 billion stake in Pfizer. That was some big news this morning. You're looking for some real trades here. What are you finding?
Absolutely, Nicole. It is a big piece of news, and it makes sense that we would see some heavy trading activity in this name after something like that here. So when we look at this one, you know, the kind of story is it's been struggling a little bit post-COVID, when everything was flying high due to their vaccine. Now the demand has dried up. They're trying to recapture some of that growth now. And one trader seems pretty optimistic about this news. What we've got here is a trade plus 3,000, February 21st, 30 strike call at a 151 debit. So 137 days to expiration here, a bullish trade, looking for about 7.6% of upside to get to that break even from current prices. If we could pull up the chart again real quick, there's a point I want to make about the chart and about the structure of this trade here. You can kind of see on our line chart there that almost about a year ago, we fell below our high point on the year, and since then we've really struggled to make our way back above that $31 level. Those are roughly the two peaks, the two highest points you see on that chart after we had the drop off about a year ago here. So basically what we're looking for, according to this trade, would be for price to push above this repeated ceiling of resistance and then continue onward in that bullish direction, long calls, unlimited max profit potential here. So it is a pretty big trade here, $453,000 of risk. That's the debit paid for this one here. But the good thing, I guess, would be that the risk is capped. You can't lose more than the debit paid on a long option here. The expected move plus minus $3.60 for this option expiration series. So the break even is well within the range there. This is not a low probability trade according to our current information here. And just looking at the broader market, 191,000 contracts traded today. The sizzle is 4.1, so that's compared to the 5-day simple moving average of options volume here. So a rather heavy day for this stock on the back of this news.
Okay, thank you for that trade. Next up, we're talking about United Airlines. Why did this one jump out at you?
Well, once again, United Airlines has earnings coming up relatively soon, October 15th in the post-market there. The major airlines are all going to report it at a similar time here. So that was kind of my general hook why I started looking into the airlines here. But this trade really stood out. It's a very large trade, both in the number
tell me you're interested in that
and the dollar amount here. And also as well, too, other news for the industry, it was recently reported that Spirit Airlines was considering bankruptcy, which gave these other airlines a lift and kind of fleshes out some of the thinking perhaps behind this trade once again here. So buying calls similar to our last trade, but structured in a different way. In this case, we are buying deep in the money calls. Our last trade, it was buying out of the money calls. So in this case, we are buying calls where the strike price is below the current market price. They're already in the money. And there's an old adage with options trading. You want to buy expensive options and sell cheap options. It kind of gives a one-sentence breakdown of kind of the probabilities here. The more expensive a long option is, the reason is that it's more likely to finish in the money, vice versa.
CDC issued a level 3 travel health notice for Rwanda.
There's probably a pretty slim chance it's going to actually reach the point where
the Marburg virus.
So, that's kind of the general thought there. And this trader has decided to buy these deep in the money long options here.
Marburg
is that the break even is 61.25 despite the strike price being 52.50 plus 10,000 November 15th 52.5 strike calls at an 875 debit. 39 days to expiration, only need 3.7% to the upside to break even on this one, $8.75 million of risk. And consider this, the expected move is 810, so once again, the break even is well within the boundaries of that expected move. For every dollar of movement beyond our break even to the upside, it would equate to about $2 million of profit. So the numbers will start to get very large very quickly here. 27,000 options traded in this name total today. So this single trade, about 37% of this market.
Yeah, and look, I mean, it's certainly notable too, because as this stock is hitting new highs, right, of over $60, that's a big deal. As it's hitting a 52-week high, and people are still making these big trades. It's had already some great moves. 6 months, it's up 36%, and the FAA did look in and end that probe of United Airlines. They were looking for any safety flaws. I know you've been mentioning this, but I mean, that's good news too. A month-long probe, and found it to be safe. So that's great news ultimately for that name. Last but not least, we're waiting for JPMorgan Chase on Friday, and that's going to be a big deal for folks. Some of your thoughts on what you're seeing there.
I gotta be honest, I'm getting kind of bored. Earnings, it's been kind of dry this week here, so I'm looking forward to getting earnings season kicked off again with our big financial institutions in Friday's pre-market to get the ball rolling here. So this trade, at least one trader here doesn't seem to really love the prospects for this financial giant this time around. Plus 2,000, October 18th, 210, 195 strike put vertical, so a long put vertical at a 295 debit here. So that gives us only 11 days to expiration. We capture the earnings event and the subsequent week before this one expires. So a relatively shorter term trade. So bearish, a long put spread is bearish here. The expiration 207.05, about not a huge amount to the downside here. And we can see that the range bound trading that we've seen recently in this stock between like 204 to 213, they're looking for a break to the downside and giving themselves a little bit of extra time after the earnings event for the dust to settle. You can see the part I'm referring to is all the way on the right side of the chart, the recent kind of sideways movement after we had that peak in the 52-week highs. So max profit, $2.4 million if we do reach our short strike there and kind of cruise all the way downward through that supportive area and everything. The total risk, $590,000 here. So a substantial trade to be sure. For average retail folks like us, that's a quite hefty amount of money. And the advantage of making this into a spread is you defray some of the cost of that long option there, and you kind of give yourself a natural boundary where you might expect to find some support in this downward focused trade here, because nothing's going to go down forever. With a spread, you can kind of give yourself a point where you think it's perhaps going to slow down. Now, the counterpoint is that if you do a spread, you cap your profits here. A long option would have not the same kind of cap there. You could potentially make more money, but everything in life is a trade-off, much like this. The expected move, about $10 here, completing our trifecta of trades that are more higher probability this time around, well within the range of that expected move is our break even here. Total traded contracts for this stock today, 45,000, almost an even split between calls and puts. The sizzle shows we're actually a little below average though, so perhaps a more quiet day despite this rather large trade.
All right, Rick, thank you for that, because we're going to be talking more about the bank stocks in a moment, starting to preview what's coming up in earnings season. Rick Ducat, thank you so much. Options Corner today. Appreciate it. Coming up next, we'll look at these names of JP Morgan, Wells Fargo, as they kick off earnings season. Whether or not the group could be a buy, are there specific names to watch that may be better buys than others? We'll be right back.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead, tune in to our election coverage on Schwab Network.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Glad you're with us. We have a few market movers for you. Super Micro, top gaining stock in the S&P 500, rallying on the back of some positive shipment data. The company said it recently shipped more than 100,000 GPUs with the liquid cooling system for some of the largest AI factories. Netflix upgraded over at Piper Sandler this morning to overweight, and the price target was raised to $800 from $650. Firm said that its subscription-based model becomes even more attractive in a potentially weaker macro environment. Barclays took the other side of this and downgrading the stock to underweight with a 550 price target. Thinks the company's growth algorithm will come with trade-offs. All right, now we're talking about earnings because it's getting kicked off this week, indeed, on those banks on Friday. And so the question is this group a buy? Some of them have done very well. We want to hear from Shiraz Mian, Director of Research at Zacks Investment Research. Thank you so much for being with us. We do want to go through this. The big picture on banks, of course, we have a rate environment supposedly that should be getting lower rates, though the 10 years over 4% today. And I do want to go over JP Morgan and Wells Fargo, which are the first to kick off. What's the big picture on banks?
So it's a mixed bag, Nicole. Thanks for having me, by the way. The rate cutting backdrop near term is problematic for banks because it weighs on their net interest earnings. But long term is positive, both on the credit side because it's expected to improve demand for loans. Which has been extremely anemic now for a very long time, and it's also supposed to be beneficial for credit quality front. Lower interest rates mean
Dow Jones down 349, 353.
The books will potentially go bad, so they don't have to reserve as much. So on the whole, in the long run, it's a positive. The question is, are we heading into a period where the economy will get into some sort of a recession, or we will be able to avoid it if you come on the side that the economy is in good shape, it's slowing down, but the recession will be avoided, then I personally feel my analysis shows that banks are a great opportunity for investment.
Interesting.
Dow Jones is
I
at
did see Morgan
450.
Stanley just on September 30th downgraded J.P. Morgan Chase and had some concerns about net interest, margin overall, positive net interest margin surprises. They actually expected to see
There's a
more
knife on the spy.
surprises elsewhere in their coverage, and so downgraded J.P. Morgan while they still liked some of the other names like Citi
Should add on.
and
Missed
Goldman
that
and
trade.
Bank of America. What are your thoughts on J.P. Morgan? Would you say this name over its accuracy?
Randy?
You look at the numbers and the balance sheet. You talked about loan
Big
demand
knife right
overall
there.
being anemic. Maybe credit demand could pick up a little bit. What would you rate J.P. Morgan?
So JP Morgan has been a far better performer in the group. Some of these others that you mentioned, Citi, has far more of company-specific issues. So perhaps it's reasonable to be more optimistic, assuming you have a positive view on the repositioning front of the business as a whole. But JP Morgan gives you leverage to each part of the finance complex. So if it's core banking, if it's capital market, if it's asset management, I believe that if the outlook is for the economy,
The 570s or the 571s.
then JP Morgan is as well placed as any of those others to be a big beneficiary. I'm not saying Citi and Goldman and Wells Fargo are not good instruments. They absolutely are. But there's nothing wrong with considering JP Morgan either.
Yeah. And what about Wells Fargo? I mean, I know a lot of folks are watching the economy overall and how it could be an overhang onto the banks as a group. Tell me about Wells Fargo. Is that a winner in your mind?
So Wells Fargo is more of a core consumer banking franchise relative to the likes of a JP Morgan or Citi or Bank of America. It has a whole lot of housing industry exposure. So again, the same theme. If the Fed easing and the economy avoiding a recession is a theme that one can buy into, then definitely the core banking business will benefit, not near term. Near term, the earnings outlook for these companies is problematic, as you mentioned in the context of JP Morgan and the brokerage firm commenting on it. But long term, an easing cycle is very positive for these large banks as well as for the regionals, because these are economically sensitive businesses, primarily domestic centric, and if the economy is at some stage expected to come back, perhaps in the first half or second half of the coming year, then these businesses will be at the front end to benefit from.
Yeah, it's interesting because Morgan Stanley also increased its numbers on BlackRock, which is also reporting on Friday. And for BlackRock, which obviously a big name that we all know here, they're expecting it to compound earnings at a double-digit rate over the next 3 years, and that will be supported by high-margin private market strategies, M&A activities. They have a lot of assets under management, but that overall the consensus seems a little better for this name. Are there any of the other ones that you want to highlight as we sort of kick it off here? Because next week we'll have Citi, Bank of America, Morgan Stanley, UBS, Goldman Sachs. Anything else jumping out at you as far as the ratings or the balance sheets?
I would say on the brokerage side, I follow Goldman a little more than some of the others, and I'm a lot more positive on their business and the outlook. Goldman, as you know, for a long time had been a leader on the brokerage and the capital market side, but over the last few years hasn't done as much because they've tried to do a whole bunch of different things. But now that they have concentrated on the core capital markets and the advisory businesses, it appears that the market is gaining more confidence in their ability to pull that off. There's not a whole lot happening on the business side in those core
Hmm.
franchises. But we've been hearing
Wonder why he likes that one.
for a while now about the optimistic and the favorable outlook and the talk of the improving pipeline of deals. So once the election is behind us, as we move further into the easing cycle, I believe there will be a lot more capital markets activity, and Goldman is a pure play, both on the markets as well as on the advisory side of the business.
Okay. Good to see you, Shiraz. Shiraz Mian, Zacks Investment Research. Thank you for joining us and really giving us a good preview of those bank names to watch as we go later into the week and into next week when those earnings certainly will be front and center. Coming up, Joe Mazzola, Charles Schwab will join us, have all the details on the Stacks report, all about this trading activity index for the month of September. It's a proprietary index. Find out what people are buying and selling, some of the sentiment that they're feeling. We'll check it out. We'll be right back.
Market's not too happy.
Every morning, every trade, always live.
UVXY's having a good day.
In-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free.
That slash
Welcome to
ES not
Morning
looking
Trade
good.
Live on the Schwab Network.
What's the VIX
I'm
up
Oliver
to?
Rowe.
VIX is at 2236.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
What to do?
Trade brilliantly with Schwab.
"22 minutes before power hour."
Welcome back to the watch list. I'm Nicole Petalides, live at the New York Stock
I love you,
Exchange.
Nicole.
It's time to focus on trader sentiment from September. And that means it's our monthly Stacks report breakdown. We see what people are buying, selling, and how they're feeling. Joe Mazzola is with us, head trading derivatives strategist, Charles Schwab and Company. Thanks for being here, Joe. We took a look at the numbers, and once again, people are moving a little bit out of those equities into fixed income. What's the big picture telling you?
Nicole, when I first saw the data, I said run it again because I just wanted to make sure that it seemed right. I mean, going back to August, look, I'll go back 18 months. When we had seen pullbacks at the beginning of the
18
month,
months?
we had traditionally seen our clients step in and buy the dip. This was a bit of a divergence from that, more than a bit. I mean, it was one of the biggest divergences we've seen in a long time, where S&P 500, within the Stacks period, which is about, it's close to about 4-week period. So I think it ended on September 27th. The S&P 500 was up a couple percentage points, and the Stacks was actually down 11%. So really a large divergence between the two. And it just says to me that, there's de-risking going on, as you mentioned, and that, maybe clients are pulling back a little bit in terms of maybe some of the beta and risk that they're willing to add to their portfolios.
Yeah, so this divergence that you're talking about was one of the largest in Stacks history when we saw that and the big inflows into fixed income. And it seems, obvious why they may be doing that. One could just be the concerns about the geopolitical risk of impending Fed moves, anything like that. You also have here seasonality risk. So those were some of the most obvious reasons. I wanted to go over what people bought and sold and get some of your thoughts. I saw that they were buying NVIDIA, Palantir, Alphabet, Intel, and Microsoft. Some of your thoughts as to those moves.
Yeah, so I mean, when I look at those names, I say, well, okay, those are mega cap names, maybe outside of Intel and Palantir at this point, but these are AI plays or AI ancillary plays. You would think that they're higher beta names, and that's true. I think what the biggest difference is, though, is that with this month, it was really concentrated in a couple of those names, and the other traditional kind of AI plays or mega cap plays that we had seen buyers step in on dips, that just didn't occur. And what we saw was that the clients diversified quite a bit more through ETFs, mutual funds, and as you mentioned, kind of some of the fixed income plays as well. On the sell side, Tesla, AMD, and Alibaba were the three largest client trims. And I say trims because it doesn't necessarily mean that these positions were short. It just means that there was some reduction in those positions. And specifically when I look at Alibaba, that was an interesting one, right? Because right in the middle of towards the end of the market week is when you got some of the hints that Chinese stimulus was coming in, and then they talked about kind of their progression and how they're going to do that. And you saw some just massive moves in some of those names, whether it was at the ETF level or specifically at the single stock level in BABA. And I think, my prediction is that it looked like, there was some trimming into some of that strength. And I think that probably makes sense given what's about a 30% move, 35% move in a couple of weeks.
Yeah, look, there definitely could be some profit taking, right? To your point. And we saw, I had it written here from the last show, BABA 50%, JD.com 70%, and Pinduoduo 60%. I mean, oh my goodness, those are huge, huge moves. So people probably want to clock in some gains. I think within the report, I always love to hear what people are buying and selling, but also some of the moves that they're making and the mental moves behind it, because the sentiment and the attitude there was higher, but the behavioral sentiment.
I don't know if we're going to have any.
So explain that to us. I want to get in the minds of these traders.
No. That's a perfect question.
No.
What I say this to my kids, right? What do you say versus what do you do, right? And it's one of those really interesting dynamics where in this report, you're saying that, hey, we 85% of the people that responded to our poll said that they either believe that there's a soft landing or no landing. They feel really good about where the economy's headed. And that's a really high number, right? And so you hear that, but at the same time, you see them trimming. Can you still be bullish on the economy and maybe trim into some strength and maybe trim some of the beta within their portfolio? I think that's I think that's a valid point. I also think that, as you mentioned, there's geopolitical risks that are starting to kind of percolate now. Not to mention it's 29 days away from the election, and when you have all of that kind of layering on top, and even in this attitudinal survey, we ask them kind of where do you see that there's some risks around the corner. Of course, they bring in the election, but then they talk about interest rates, right? I mean, this was done right around the same time as the Fed move. So, it was kind of interesting to kind of see that dynamic play out.
Yeah, and I was also thinking that, as you talked about how people are buying and selling and how more inflows were going into fixed income.
It's one heck of a sell-off there.
And I was thinking that with all the education, maybe people are just ultimately becoming more sophisticated too, and maybe want to diversify more. And that brought me to one of the points here, and that's the VIX options trading that we saw, and that was a big deal, right?
Yeah.
Call them dumps, big massive dumps.
Yes, big dumps.
In the VIX, right? Tell me a little bit about that, and what's the interpretation of that?
Yeah, so Nicole, when I was driving into work today, I'm thinking to myself that 21, right? That's the number. So 21 times forward earnings is what the market's trading at right now. It's up 21% on the year. And as of this morning, I haven't seen where the VIX is right now, but last time I checked, it was around 21. So you got all those
22.31, buddy.
Kind of lining up, and what that tells you is the market's kind of fully priced, right? The market's fully priced. You've had really nice gains up to this point, and now volatility starts.
SPY got a double bottom right here.
Starting to buy some of those upside calls. Why? Because when I say upside call, I mean VIX calls, as you mentioned. I think that there's a belief that, hey, look, there's some seasonality effect here. October, tends to be, between September and October, those tend to be two of the worst months for the markets. But there's a lot going on in the world right now in between what's happening in the Middle East, and there's still conflict in Eastern Europe, and then we have the elections coming up. And oh, by the way, crude oil was up 9% in 1 week. So yeah, there's a lot of things that maybe have investors feeling a little bit cautious.
Right. And cautious doesn't mean scared or jump out of the market. It just means sort of watching everything, right? Because I noticed in your note, Joe, you have here, the whole Charles Schwab stocks report note. It said shows cyclical trade is still underway. Markets are not moving towards defensive trades at the equity level. So they're just, using all the different tools of the market, it seems, and sometimes being a little more cautious or maybe just taking some profits, which a smart trader does. Joe Mazzola, great to see you every month. Did you have a final thought?
I was just gonna elaborate on that for 1 second, Nicole, if you don't mind. I was just gonna say one of the things, everybody, that I like to look
New low on the
at
SPX
sector level, and that's where Nicole, that's where I was kind of looking to see where do we have some breadth that's kind of moving into those cyclical names, and you're still seeing it. It's not necessarily on the defensive side. You're seeing it in those cyclical names. So maybe there's a little bit more room to go.
Yep.
All right, and we have a lot of action between now and the end of the year.
Another 22 bucks on the SPX if it wants to drop more.
See you. Thanks for all the details on the stocks report and more. Still ahead, we'll bring in our panel to discuss the rally in China. We just talked about a few of those names. We want to get some more details. Are there names we should be watching more closely? Is there more stimulus coming? What do you need to know about these names? We'll be right back.
Drop the pouch. Nike went below my support. Just got alerted.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices?
We
at
can drop
Schwab?
more.
Choices?
Yeah. At Schwab, I can get full service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right?
You see
Neil,
here.
tell me you know this.
Gotta run, Carl.
5720s are at 75 cents.
Have a choice in
I
how
mean,
you invest
70.
with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platform.
What should I do?
Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And
Be
sharpen
careful.
your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Welcome back to the watch list. We've seen the China stocks rallying over the last couple of weeks, of course, boosted by some big stimulus from China, monetary stimulus, fiscal stimulus. And is there more coming? And what can we expect for some of these stocks that are up 30, 40, 50, 60, 70%?
300%, baby.
With us, CFA, Senior Investment Strategist.
TIGR.
Shares, and Philip Wool, Managing Director at Rayland Global Advisors. Thank you both for being with us. Anthony, what did you make of this rally? I mean, there were some folks who came on the air and actually picked some of the Chinese stocks, anticipating that China might provide some stimulus, which it did. I'm not sure they could have anticipated these moves. What did you think of the moves, and what kind of moves are you expecting going forward, either from China PBOC or the stocks?
You know, it's been long awaited, right? We've been waiting for a policy move since the beginning of the year, and we got something in February, which we and investors saw it as very constructive, especially with the real estate, and we saw the market, especially KWeb, run up 30%. But you know, it's here, and this is great to see the commitment of the government to focusing on growth, to bringing momentum back to growth, to earnings, and that's going to be very helpful.
Be extra careful.
A-share markets, because you know a lot of the bulk of the swaps that are set up through the PBOC for mutual funds, brokers, and insurance company are going to be used to buy equities in the A-share markets, and also some of these facilities will extend to companies that are listed so they can buy back shares.
Philip, what stood out to you thus far, and where do you think some of these stocks could be headed, or what kind of moves we might see from China?
I think what stands out to me is that this is not the same messaging that we've seen from Beijing in the past. The tone has really changed. You know, before, when we had these false starts, it was really monetary stimulus. It was rate cuts and reserve requirement ratio cuts. But what we've seen now is what we've been really waiting for a long time, and that is
there's huge uncertainty about the neutral Fed funds rate from cash carry.
For real estate, that's a big one, because that's been hanging over domestic investor and consumer sentiment. We've seen announcements of a desire to get growth back on track, and that's timely because the window was closing for Beijing to hit its 5% GDP growth target for 2024. So I think if we see follow through on the fiscal side, on the demand-oriented stimulus, that's going to be huge for getting growth back on track. And I think
8 minutes to power hour 7.
I know you had some thoughts on emerging markets as well, Philip. I do want to ask you about that group overall. So for investors here, Anthony, what are you telling them? Because you said you got in early on this group. Are you taking profits? Are you buying more?
Yeah, look, China has been cheap for a little while, right? For almost a year now. Actually, if you look at our model, especially emerging markets model, the standard deviation between emerging markets and ex-China and China valuation was beyond 2 standard deviation, extended to almost 4 standard deviation, and now after this rally, it's still back to 2 standard deviations. So China still looks very cheap. We like the A-shares market because it hasn't participated as much as the offshore market. I think KWeb is up close to 50% or something along these lines, but KBA has not participated on the A-share market fully. Plus, some of these stimulus packages that we're seeing are more geared towards the A-share, as we talked about. Also, what's really interesting is the K-Star, which is the star board market that is in Beijing, which is the new exchange that was initiated a few years ago to focus on technology companies that should be able to list onshore. These group of stocks as well are having a good momentum now. So basically, we're sticking with China. China still remains cheap. Maybe we favor a little more the A-shares market and the starboard market.
Right. All right. So still allocation there in a big way, still believing it. Let's hear more about emerging markets. You have a couple of things on your mind, Philip, where you're saying maybe you could do ex-China, or maybe if China does well, it really spills over to the group. Do you do China along with emerging markets, or emerging markets ex-China?
Yeah, so first of all, I really agree with Anthony in terms of the A-shares. Our active fund, RAYC, is really focused on A-shares. We hold only those mainland listed stocks, and I do think that the mainland market has a lot of room to catch up with offshore China. And then we also have an EM ex-China fund, RAYE. And I think emerging markets, the timing of the China stimulus announcement is not a coincidence. It happened after the Fed cut. Some emerging markets have already been easing ahead of the Fed, knowing that a pivot was coming. But I think emerging market central banks, now that the Fed went big in September, they've got room to ease further, and that's going to be really growth-oriented for EM. If China's economy recovers, Chinese demand comes back online, that's great for exporters across EM ex-China. So I don't think it's one or the other. I actually think China's valuations are still attractive, and EM ex-China should rally if China recovers, and if we see a soft landing from the U.S., that's just more fuel for the fire. So I like EM across the board, and we've got different ways to build those sorts of exposures.
Yeah, look, a lot of investors are still anticipating.
We haven't seen a day like this in a while.
We've seen some of these names up 3 weeks in a row. We will continue to follow them, and we appreciate your perspective, Anthony and Philip. Thank you. Anthony Sassine of Crane Shares. Philip.
Israel military issues new evacuation warning on Pacific buildings in Beirut and the southern suburbs.
It's available in the Apple App Store. Tune in 24/7, schwabnetwork.com. Keep it right here. Market on Close on Schwab Network is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week, it's going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast.
If I see any kind of reversal here, we got a 1, 2, 3.
My job as a trader.
My job.
Just to make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are.
So we'd have to break that before I'd get in the trade.
How are you exploiting human weaknesses?
Being lucky in trading.
I don't even know why she asked that question. How do you exploit human decency?
Able to find opportunities in the market.
I mean, I can't even.
Enormous, staggering amounts of.
What is she asking?
Certainly see pattern. Context is so important. I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
How do you exploit human decency? I mean,
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are
more drama to come.
are almost too big to fail.
Have you set yourself up correctly?
No.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking
We're about to get a new low on the SPY here. We just did on the SPX.
Nowhere else I would want my money.
No more than 5% in any one stock, no more
What
than
to do?
1% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Good afternoon. It's 3 p.m. here in New York, and this is Market on Close. I'm Caroline Woods, live from the floor of the New York Stock Exchange. I'm filling in for Oliver Rennick. We have an hour left in the trading day. Let's kick things off by taking a look at where markets currently stand. Stocks are holding on to those losses, and the losses are picking up some steam. If you take a look,
Bigly.
Small-cap still the weakest link, with the Russell down 1.4%, but the NASDAQ not too far behind it, down about 1.3%. NVIDIA, the only Mag 7 name higher, although off earlier highs. Meanwhile, the S&P 500 also posting losses, down more than 1%. Every sector lower aside from energy, utilities faring the worst. And the Dow Jones near session lows, down about 515 points right now.
Woo!
Travelers, the worst performer there. The losses come as yields and oil prices tick higher. Oil, taking a look, is currently up 4%, trading at 77.35. We'll break down that move a little bit later in the show. Meanwhile, no flight to safety in gold. Gold is lower today. Bitcoin seeing some money.
It's a huge drop.
Take a look. Bitcoin slightly higher today, trading around 63,150. The dollar, meanwhile, is flat. Let's kick things off with a look at the broader market with Kevin Haynes, senior equities contributor.
The 5710s are at $1.
Network. Kevin, great to see you. So we talked this morning, of course, and losses were pretty modest, but they've been really picking up some steam. So what has investors on edge? What's behind this weakness today?
Well, I think there was some general uncertainty, but the markets were pretty much hanging in there until about 1:30, when you see a big second leg down where all the indices went from, they basically doubled their percentages down.
Yeah, they did.
From 1:30 until now. So I think there's been a sell-off here. It looks like the S&P went from down about 0.5% to down a little over 1% where it is now. So I think this market was hanging in there all day at or near where the futures were before the market opened, and then 1:30 came. I was looking to see if maybe Neil Kashkari was speaking at 1 o'clock, trying to see if he's making any comments, because
he already has.
Chicago time, it looks like they took the market another wave lower in at least the S&P, NASDAQ, and the Dow head lower. So there's really 10 of 11 sectors are lower, Caroline. It's only energy that you mentioned is up 4%. That's the only sector of the S&P 500 up. And take NVIDIA out, and boy, this is a day that really never got anything going. Has been on the downside all day. Now picking up a little steam here since 1:30 Chicago time.
All right, and I would think to attribute it to the tick higher in yields, but we've talked earlier today that the market, you say, can move higher despite a tick higher in yields. But how much do you think that tick higher in the 10-year could be weighing on shares today?
Well, certainly the yields over 4% make the overall market a little uncomfortable, and that's okay as long as they stay in this area. Now, if they repeat this tomorrow and go up another 50 basis points, the market's going to get nervous again, and the market's going to stay nervous. Remember, there's a lot of events coming up in the next week.
VIX made it to 2303.
Tesla event. You've got the start of earnings season with banks that are already admittedly going to have less net interest income. They're going to have lower trading revenues, like a lot of them have already pre-announced. So there are some reasons to be hesitant here, and let's face it, we're still at some pretty lofty valuations. So if there's some hesitancy going into third quarter earnings season, which starts, well, you can make a case it starts Thursday with Delta Airlines, but usually we talk about it when the banks come out. Friday, we'll get JP Morgan, Wells Fargo. We don't get Bank of America, Goldman, and Citigroup until next Tuesday, the 15th. So, banks are going to start us off, Caroline. We've got some weakness. We've basically given back the entire rally at the end of the day on Friday, and there's no real news out there to change the tone here today. So it started out as kind of a drift lower overnight, despite the foreign markets being down. Took another leg lower about 1:30 Chicago time, 2:30 Eastern. And that's where we sit, Caroline.
And we're keeping a close eye on oil prices as well. They're up about 4% today, trading above $77 a barrel. How concerning are those oil prices. Obviously pushing the energy sector higher, so there are some
Not
winners
too concerning
because of it.
yet.
But, you know, we have CPI and PPI on tap.
If they blow down Iran's oil fields, there might be.
Week, those higher oil prices won't necessarily be in that data, but how concerned should we be about that tick higher?
Well, what it's going to make you do, you're going to get, it looks like the number right now for headline year-over-year CPI is going to go from 2.5 to 2.3%. Much of that will be energy going lower. You'll see that show up in the tables that energy is lower. But the trading community is going to look at this and say, wait a minute, energy's lower. That's stale data because energy's rallied pretty significantly since then. So they're gonna find themselves discounting any lower numbers in inflation because they know that number is not up to date and changing. So yeah, you could have headline year-over-year inflation come down and the market completely discount it because of the move in crude oil. And you're right, crude oil is great for the energy stocks, but not great for anything that moves something from point A to point B. That affects it and makes it higher, and you know it shows up. It's a major part of the headline inflation data.
All right, we have to leave it there, but appreciate you breaking it all down for us. Kevin Hanks, thanks so much. All right, now for a look at a few stocks on the move. I'm joined by Jenny Horn, co-host of Next Gen Investing. Jenny, you have a winner and a loser to talk about, but let's talk about the winner first because it's not easy to find today outside of energy. And Supermicro is the best performer in the S&P 500. And while some of the other winners, like NVIDIA, have come off those highs, Supermicro is holding on to them. Talk to us about this move that we're seeing. Shares up almost 15%.
I know, it's frankly amazing because I was watching, as you mentioned, like NVIDIA has come off quite considerably from its session highs here. I mean, now giving up almost 1% from where I just looked at it last about an hour ago. Supermicro is hanging in there, and I think that this was a well-needed way to start off the week. As we know, we've fallen substantially from this year's peak, although then the argument could also be made that we ran up very far very quickly. So perhaps settling at this new range in which it's established itself. But they did say they recently deployed over 100,000 GPUs with liquid cooling solutions for some of the largest AI factories that have ever been built, as well as other cloud service providers. Their ultra-dense server with dual top bin CPUs and 8 NVIDIA overall GPUs with liquid cooling does quadruple their computing density, allowing organizations to then run these larger training models with a smaller data center footprint. And this does complete the overall power costs, as that has been one area of concern. Data center cooling infrastructure costs has also been a key way in which this company has been able to serve the overall AI market. But of course, we mentioned the pressure this name has faced, and that's really due to not only the U.S. Department of Justice stating that they were probing the company following that short report from Hindenburg Research back in August, highlighting some of the ways in which their overall inappropriate revenue recognition policies and rehiring of employees had violated then basically various company policies. So they did say that they have inked a settlement now with the SEC back in 2020 that included paying about $17 million without admitting or denying any of these accusations, of course, then delaying their 10K filing. I think we'll get more clarity on this hopefully at the end of the month when we get their quarterly earnings, but also now trading on a split adjusted basis following that 10-for-1 stock split. So it's, to me, still like sticker shock to see this name trading at 47 roughly dollars a share. But also, again, we were at 120, nearly 123 this year, so we've pulled back 61.5% from yearly highs and also remain up 109% off lows. Rarely do you find that.
It's now 9 minutes after power hour.
Somewhat of the draw of Supermicro, Caroline.
Yeah, so the headwinds still exist, but investors looking at this as a good sign in terms of server demand. So certainly rewarding shares of Supermicro today. Okay, let's talk about the loser. That's Amazon. Not the worst performer on the S&P 500, but one of the worst performers on the Dow, I will note. Shares are off more than 3% following a downgrade. Fill us in on why this analyst is turning cautious.
Yeah, so another name that is actually, I mean, considering it's been a relatively insulated player this year in the tech trade, we're still up about 20% on the year, I believe, is this name has not been able to hang on to its strength earlier. I believe we started the session only down about 1%, but that selling has picked up as we've carried on throughout today. Wells did downgrade shares to equal weight from overweight with a price target of $183 a share from $225, saying that Amazon's now positive estimate revision story faces multiple headwinds. They believe that web services strength alone is not enough, and there is limited visibility into a resumption of positive estimate revisions until at least late of July of 2025. So they also do believe that while Amazon has been a consistent positive revision story, there are factors pressuring the near term for their various investments, including one in Project Cooper, as well as the moderating advertisement conditions. So for that reason, they are more sidelined on Amazon. I believe we talked about this name earlier, Caroline. Street loves Amazon. There's 66 analysts on this name.
Here's my support that I had, 566.17 for the third.
Or a buy equal rating. So it's difficult to find those rare, the more neutral type analysts because there aren't any outright bears in this name, which is frankly amazing.
Down here at the bottom.
We also do get Prime Day that kicks off tomorrow, runs through then Wednesday. Prime Day is to me the most ill-named event now. It's Prime Days basically, but that kicks off tomorrow. So that's also something I will be watching as a consumer as well as a reporter, just because I do love to get a good deal, even though admittedly the Prime Day deals are not as strong as I think they used to be. I will still be checking for some good deals, however.
Yeah, I've made all of my Amazon purchases ahead of that, but I did leave a few things in my cart in hopes that the prices will come down, but based on my experience, they probably won't. Jenny Horn, thanks so much.
Thanks, Caroline.
All right, let's take a look at the big picture and some fixed income strategies to consider. Joining me for that is Christy Akulian, head of iShares Investment Strategy Americas at BlackRock. Christy, thank you so much for being here. Appreciate you joining us.
Thanks so much for having me.
So we have stocks lower as yields are higher. We'll talk about both in just a second, but I want to get your view on the big picture in terms of the economy right now. Of course, inflation back in focus this week after that much better than expected jobs report last week. Did that jobs report change your view on the economy at all, and what is that view?
Yeah, so we just published our fall investment directions, which is our Q4 outlook, as you mentioned. So really thinking about the big picture here. I think we came into last week and we were of the opinion that we were not going to be getting a recession in the U.S. And if anything, that jobs number really only confirmed it. So we still see the U.S. economy as being very strong, although we do think that that's going to cool gradually over the next several quarters. So where that leaves us is we still like being invested is the really big picture here. We are leaning into risk. We're just doing so in more of a quality tilt. So we still like equities. I think you mentioned at the top too. We still see a ton of opportunities in fixed income. But yeah, the U.S. economy is really humming along.
Okay, so if the U.S. economy is humming along and it's very strong yet cooling, does that warrant the 50 basis point cut that we've already seen? And does the latest data change the Fed's next moves? Because there's a lot of talk right now, and Kevin Hanks earlier today said second guessers don't really matter, but there is a lot of talk about a 50 basis point cut again being completely off the table now because the economy is too strong.
Yeah, and I think that the market has been very hyper-focused, if you will, on the Fed and will they go 25 or will they go 50? We never thought that that was sort of the most important question. What we wanted to see was sort of the path of interest rates going forward. So, we have always been in the camp that we would get about 75 basis points or so worth of cuts this year since kind of the mid-year outlook. And we still think that that's a relatively reasonable expectation. When we look at the market expectations for cuts, we do think that they're a bit overdone. We think the market got ahead of itself in terms of expecting more of those jumbo cuts. And so we've been a little bit more cautious in that front in general. So again, we see the market as strong, but cooling, but not moving all the way into a recession. And so I think if you look at market expectations for pricing, it was probably too few if we were going to get a recession and too many if we weren't. So we sort of fall in that too many cuts expected, but still see a lot of opportunity to extend duration now, to invest in fixed income early in the cutting cycle. Because what we see time and time again, looking back at previous cutting cycles, is that the timing and the curve positioning are what matters most. So we like getting out in front of it, acting early, and then in terms of curve positioning, we really see a lot of opportunity in kind of the 3 to 7 year or the belly of the curve. So a fund like IEI is something that we're talking a lot with investors about right now to take advantage of those higher yields before they fall.
Okay, so opportunities in fixed income there. I do want to come back to your 75 basis point cut expectation, though, because that implies one more 25 basis point cut and then a pause, or do you think there will be a pause and then the 25 basis point cut?
Yeah, again, I think that focusing exactly which month and how much is probably missing a little bit of the bigger picture. But yeah, we do think that, the market, as the Fed, is going to take things data point by data point. So we're just as curious as everybody else to see where CPI numbers come in and how growth continues. But again, just think that market expectations for cuts are a little bit too high.
So if they're too high, though, what does repricing those expectations actually look like? Does that mean that we could see more pressure on equities as they kind of come to terms with maybe fewer than expected rate cuts?
Yeah, I think that would be the case if we saw, the equities were responding only to rate cuts. But what we're seeing is that a lot of that recession risk is being priced out of the market. For example, like the jobs print that we got on Friday. So I think we're in a market environment where good news can be good news. And so I think less cuts for the right reason can still actually be pretty constructive for equities.
Good news can be good news.
Some fixed income investment opportunities.
I'm not sure about that, honey.
I was taking a look at your notes, and you remain cautious on mid and small cap names, despite the fact that recession has become, or I guess it's always a possibility, right? But it's no longer necessarily on the table as much right now. Why the caution then around small and mid cap names?
Yeah, and you're exactly right. We think of right now as a moment to move from mega cap to large cap, more so than we think of it as a moment to move from large to mid or to small. Part of that expectation is just because even if interest rates come down as much as the markets expect, they're still going to be in restrictive territory. So we actually think interest rates need to come down a lot more to see the smaller and the mid-cap companies actually benefit. And yes, we don't think that we're in a recession, but even if we do have a slowing economy that doesn't tip negative, that's not necessarily the best environment for some of those highly geared, highly cyclical stocks that you get in the small cap index. So we're still pretty cautious there. We prefer large cap. And instead, what we like doing to balance out a little bit of the investor portfolios of what we see now is adding a little bit more value. So being more mindful of sort of your growth value mix. We see opportunity in something like the BlackRock Large Cap Value Fund right now as just a way to get investors almost back to benchmark because they have been so exposed to growth, and in particular, some of those mega cap names over the last year.
Okay, so you mentioned your fund, but just in terms of where you're actually finding some of that value, can you be any more specific? Because these names we've seen have really good run-ups up until now.
Yeah, and in terms of specific we like value.
Because they're a pump, baby.
A lot of the ways that we think about things are finding value within each sector as opposed to necessarily saying which sectors we like and don't like. But if we are talking kind of more granularly about sectors and exposures there, we do see some opportunities in financials. I know we're going to get earnings out starting here next week. But we see some opportunities in financials from the yield curve steepening, which we still do expect. And yeah, just adding and being cautious, about where we're adding, but still staying higher in quality with a little bit more of a valuation focus as well.
How are you looking at the valuation of the overall market right now?
Yeah.
Yeah, I know a lot of people like to, look at some standard benchmarks and things in terms of earnings per share. I think that we're in a different world than we were in the past. The S&P 500, for example, is so much more skewed to growth that it makes sense that valuations are higher than they have been previously. So I don't think we're taking just a perfect metric of what we used to look at versus now. I don't think that history is exactly correct just because of the composition of the index. So just being a little bit more thoughtful. I think this is an area where we see opportunity for active management to really shine, for some of those high conviction active managers to find those pockets of value and allocate to them within a fund structure.
Interesting point there. So just quickly, between now and year end, do you think this market is higher or lower than where it is now?
I think they're going to be higher, but we do certainly expect some volatility in the interim.
All right. Christy Akulian, head of iShares Investment Strategy Americas at BlackRock. Really interesting insights. Thanks so much.
Thanks for having me.
Have a good one. Coming up, it's time to take to the air, or at least invest in it, sort of. Our next guest has an out-of-the-box way to invest in emerging markets.
Today I haven't done much trading.
Come back.
It's all right. I've done 5 trades. 1 was red and 4 were green.
Accelerate your market knowledge.
And shift your perspective. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. For more on the equity market, let's welcome in Lucas Tamicki, founder and managing partner at LRT Capital Management. Lucas, thanks so much for being here.
Thanks for having me. Good afternoon.
Good afternoon. So I know you have some out-of-the-box kind of investment ideas, but before we get to those, I want to talk about some more obvious, I guess, investment ideas or lack thereof, because I was taking a look at your notes, and you're actually bearish on NVIDIA, one of the top performing stocks today, and of course, all year. Is this a valuation call? What's behind your bearishness on
Yeah.
So we've written a piece several months ago when we talked about AI being full of false promises and frauds and hype in general. So the issue that we see with NVIDIA is that people are latching on to anything AI and extrapolating that into the future without really having much technical knowledge about how large language models work and how AI tends to work. I co-founded and sold 2 software businesses. I actually write code and I know how these models work. So I feel I have some credibility to speak about how these models are improving or not improving. And while NVIDIA has run up a lot and is selling a lot of chips, people are extrapolating their sales into the future in a big way that I think is not going to be realized, because I think the promise of AI is not going to deliver the productivity gains that people are expecting. And as a result, the CapEx is going to come down and NVIDIA sales with it.
Okay, so this isn't a case of there's going to be more competition in the market. It's just that you think that the whole NVIDIA craze will kind of fizzle out.
I think the demand is going to slow. Now, it's still going to grow. Every year we have more computers, more data, but NVIDIA is already pricing in a growth in demand into the indefinite future. And historically, it's been a fairly cyclical business. So if you value it where it is, if you want to buy it today, you have to believe that it's become a secular grower like, say, health insurance, as opposed to a more cyclical company, which it has been traditionally.
Okay, so are there any AI plays that you would favor instead? Or, because I mean, NVIDIA certainly isn't the only name that's had a lot of hype because of AI.
Yeah, we're not directly investing in AI in any big way. We do own TSMC, Taiwan Semiconductor, and we do like that as a manufacturing pick and shovels type play, because ultimately their manufacturing capacity can be shifted away from making NVIDIA GPUs to making other types of semiconductors. and they remain on the cutting edge within the manufacturing space. So we like TSMC as probably the most direct exposure we have to semiconductors, but we also own a company called Comfort Systems, which does commercial HVAC contracting. So they're a subcontractor, and they're not directly related to AI, but they have been benefiting in recent quarters from a growth in the investments that we have in the United States for manufacturing capabilities. And part of that, of course, is more data centers. So they're an adjacent beneficiary, and that's how we like to play it.
Okay, and then outside of the AI space, I know you're looking for foreign economic growth, and ways to play that, you're investing in foreign airport operators. Explain this thesis to us.
Certainly. So airlines traditionally have been a terrible place to invest, and Warren Buffett famously says that every time he thinks about investing in an airline, he has a 1-800 number he calls, and they talk him out of it. And I totally agree with the Oracle of Omaha on this. Airlines are a terrible place to invest, but actually the airports are by contrast a great place to invest, because while you can change which airline you're going to fly any day based on whoever gives you the best price, if you're trying to fly into Cancun, you're only going to fly into Cancun airport. You're not going to fly into somewhere else. And there are several airport traded operators of airports that are publicly traded. They're all outside the US, and they own these key assets which are essentially irreplaceable. And every year a little bit more people travel, and the thing about travel is that it tends to be a luxury good, meaning people spend more of it as a percentage of income as their income grows. So every year travel grows about 1.5 times the rate of GDP growth. And the names we have in our portfolio specifically have exposure to Mexico, to Cancun, to Monterrey, which is clearly emerging as a manufacturing hub of Mexico, as well as the airport operations in Argentina.
So if you're looking abroad for economic growth, what does that say about your outlook for the U.S.?
So we like the U.S. as a place to do business, and I've been living in the United States for over 20 years. I'm originally from Poland, but I love the U.S. and we're very happy here. I think the U.S. is a very resilient economy that has deep economic and political reservoirs of stability. So despite whatever you might think about U.S. politics, whoever wins the election, there'll be some hand-wringing and it will just move on. Those are incredible.
Well, you think so?
US, and I think there's tremendous long-term growth opportunities in the United States. Having said that, the one thing that worries me with respect to the United States is the budget deficit that we have.
Duh.
And we have an incredibly large budget deficit, and neither political party is talking about as any commitment.
Trump did yesterday, you dick.
And right now we have a very strong economy, and I think largely one of the reasons we have a very strong economy because we're pushing basically $2 trillion of deficit spending into the economy. We've never had this level of deficit spending during peacetime. And so one of the problems is that as the Fed is going to be cutting rates into the next foreseeable few quarters, the pace of those cuts really matters with respect to the impact they're going to have on the US budget. Because several quarters ago, our Treasury Secretary Janet Yellen changed the composition of the debt issuance in such a way that they're traditionally used to issue an equal split, more or less, between long-term, short-term, and medium-term securities. They changed that to be about 80% in short-term Treasury bills. And that lowered the interest rate for a while, but that means that there's a huge amount of debt that's coming due that's going to have to be rolled over. And interest payments on U.S. debt are already exceeding $1.2 trillion this year. And they're on track to hit $2 trillion within the next 2 years. Now, so what matters, of course, is if interest rates come down dramatically, like some people believe they will, then that interest bill will be much lower. But if they don't come down that quickly because the economy stays strong, then we might be heading to a world of $2 trillion plus in interest payments and a budget deficit that's completely out of control.
It already is.
At some point, it will have to be corrected, and that will be a big shock to the economy. either through lower spending or higher taxes, and probably a combination of both.
Well, the latest economic data certainly doesn't point to rate cuts coming more quickly than expected. So that being said, are you putting money to work here in the U.S., or are you just waiting and seeing until you start to get some answers on that front?
It's now 2:30, 3:30.
In the U.S., as I said, I think the U.S., despite its problems, is what I like to call the cleanest dirty shirt. So while the U.S. has problems, other places also have problems. And I think what's also important to distinguish is that the U.S. corporate sector is probably in the best shape it's ever been in its history in terms of relatively low debt levels, global dominance of several U.S. companies in a way that was not that dominant in the past, like 20 years ago, and profit margins that are essentially at all-time highs. So corporate America is in a very good place, and it's quite well managed. And again, we may complain about corporate governance here and there, but compared to many other places in the world, the governance, the performance of our companies is fantastic. So we continue to invest in the US, but selectively, we are looking to invest abroad where we think the valuations make sense and the business models are very resilient.
All right, well, we appreciate your picks. Lucas Tomicki, founder and managing partner of LRT Capital Management. Thank you so much.
Thank you.
I don't think we're going to see anything, Randy.
Time for Options Corner. Kevin Green will join us to dissect the options flow and to take a closer look at the levels he's watching this week on the S&P 500. Market on close. We'll be right back.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help
Yeah, I'd probably mow too.
complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trade.
Sure is.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full view. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab.
To align with your goals, all at your fingertips. Investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome back to Market on Close. It's time for Options Corner. Kevin Green, senior markets correspondent here on the network, is here. So Kevin, first of all, welcome. Second of all, I know you're watching some levels. We just broke through 5,700 on the S&P 500. I know that was one of the levels that you were watching. So tell us about this, how notable this is, and what comes next.
Yeah, it's pretty notable. We actually are seeing a pretty sizable amount of volume to the downside here today over the last, let's say, hour and a half here. And you really want to try to recapture the 5,700 level, but it does appear from a technical standpoint we might have came back, retested, and then reject and go lower here. But there's another area that we are focusing on here. It's going to be 56.9 or 56.80 is going to be another area of support here for the market, especially if you're looking at that volume chart. Today it has just been consistent selling, though. We haven't seen any type of bounce back reactions within the equity markets for now. And the reason why I said that 5680 level is going to be key is because once again, last week, where we broke out on Friday, we had this triangle formation, descending triangle formation taking place here, and that neckline is basically right there at that level. So you want to be able to bounce off of that, try to reclaim 5700 and move higher. I'm just not seeing any type of volume bullish flows for that matter. That really signifies that we can kind of meaningfully turn this around and try to end up at around 5720 or 5730. This seems like a slow grind here today, Caroline, which is unfortunate after the week that we had last week and the close that we had last week that we ended up this way. But it's just volatility, and you're seeing just lack of strength. And in fact, NVIDIA is the only thing that's keeping us up. And it looks like that wants to give up here too some of the ground that it's made for today. And if that's going to be the case, we could probably see additional selling going into the close. If that's going to be if NVIDIA pretty much loses for the most part all of its gains right now.
Okay, so 5680 is the next level. If we break through that, then what?
Then we have a problem. Pretty much. We break through that. The next area you want to see is 5750 hold. There is some positioning there, but there's kind of like this gap between 5680 and then 5620, actually 5625. So we don't really have that much to really kind of backfill, unfortunately. So this is the area that you really want to hold for now, especially kind of going into the close. You really do not want to close at the lows of a session from a technical standpoint. That gives bears a little bit of confidence that they might be able to continue to follow through here to the downside in the overnight hours as well as for tomorrow's trading session. Now we do have some economic data that's going to be hitting the wire as well as some Fed speakers that can kind of turn this around. But the selling pressure has been too aggressive here to really kind of hold up on these levels. And right now
I agree, sir.
90, so we're only about 10 points away from that 5680 level. Below that, once again, hopefully that doesn't happen today, but if so, it could be a pretty bad close.
Okay, and you mentioned NVIDIA. NVIDIA is still higher, up more than 2%, but well off earlier highs. What specific levels are you looking for NVIDIA, especially to the downside, I guess, here?
Yeah, you just want it to be able to hold here. I mean, the fact that it actually got to $130 today, I haven't been watching it too closely, but I saw it hit 130, and that was actually pretty remarkable, but just because of the price action. So right now, I would say 127 and a quarter would be the area that you would like to have it hold, and that's barring any type of meaningful sell-off that we're seeing across the board. And this is actually not only just like tech heavy, you're starting to see other defensive sectors getting hit today too, because of the 10-year treasury yield continues to rise to the upside. We're having a normalization and kind of backing out some of these extensive rate cut expectations for the remainder of the year. So you have sectors like real estate or utilities, which might seem small when you're looking at the market cap weighted index, but does have some meaningful, but is meaningful when you're kind of looking at sentiment. So this is kind of the sell everything type of scenario here today, and hopefully semiconductors, and then for the most part, hopefully NVIDIA is going to be the one stock that's going to be able to hold us up here into the close, and so we don't have more bleeding going in to the last, let's say, 23 minutes left to go in the session.
All right, so yeah, there's a lot of pressure on NVIDIA. In terms of just volatility, you mentioned obviously this uptick that we've seen in volatility, the VIX trading above 22 right now. Of course, we don't even have any of the main events yet this week. We have the inflation data, we have earnings coming up, we have Fed speakers. Should we expect to continue to see volatility tick higher? What should, kind of help us level set our expectations for that?
Yeah, so this week is pretty much the last week that we see from a seasonality standpoint, high volatility. We start to price in the election premium a little bit more, and then we start having the polling that really kind of gives us the groundwork as to how the Senate and the House is going to shape up. And then we probably will still have a question mark when it comes to the presidency for now. But what we do see on the screen right now is actually a backwardation between the spot VIX, which is measuring 30-day out vol, and then the front month contract. Now this one's actually very notable because the backwardation for this contract actually also includes the election premium. So because we are seeing basically the spot VIX higher than the front month future, it does mean that we do have a little bit of uncertainty that's being priced into the market. And the reason why I say it's a little bit difficult to actually have this type of scenario is because the October contract for the VIX future has been pricing in a lot of that election risk. Has actually been in place, and the pricing and the backwardation of this curve has been in place for the last 2 to 3 months. So for us to actually have the ability to kind of break out of that backwardation of that curve, or break out of that curve in general, does mean that near-term volatility is something that we need to keep on our radar. And I'm not sure if it's only just the geopolitical risk that we have out there. I think it's some other things that might be priced in outside of the election as well. Maybe there is a concern that inflation might come in a little bit hotter than the street's expectations. I know you had Michael on earlier on MTL, and he kind of brought that up, and that is something that we have to be mindful of. Maybe we do see a small resurgence on year-over-year comps, and that causes a little bit of sell-off in the market. Who knows?
Yeah, and he was saying maybe that we might not even see any more rate cuts this year, which could also maybe wreak some havoc with this market. All right, Kevin Green, we'll be sure to keep checking in with you. Thanks so much. Coming up, we'll dive into the commodity markets with Scott Bauer and talk about NVIDIA again. It's moving higher. We've got a developing story on CEO latest big ticket speaking engagement on the other side of a break. Stay with us.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. Let's step outside the equity market and turn to commodities with Scott Bauer, CEO of Prosper Trading Academy. Hey there, Scott. Good to see you again.
Hi, Caroline. How are you?
All right, so we're continuing our discussion on crude oil. We started it last week. Crude oil continues to tick higher, up about 4% today, trading above $77 a barrel. Tell us about this move and where it goes from here.
This is pretty significant. We're right up at the 200-day moving average, 77.36 or so. There's also big resistance just above, right around 78 and a quarter or so. So I think we've had it. Unless things really get worse in the Middle East, I think this run is going to pause here, and I would not be surprised if we have a little bit of a pullback.
But if we see it break through 78 and a quarter, then what? Because I think the thing is there's just so much uncertainty right there, but we still don't know how Israel's going to respond to Iran. I mean, there's a lot at play here.
No question. So if it does break through from a technical standpoint, you're looking at 82, 83. I will tell you in the futures markets, if you look at, the CL futures options, there is massive upside call buying all the way out to the December futures, up at the 90 strike, up at the 100 strike. So, retail is coming in and they're really, really buying the upside here.
Okay, but if you expect maybe a little bit of downside from here, something tells me you wouldn't be investing in the energy sector right now, which is the lone, outperforming sector today.
Yeah. No, there's no doubt about it. I am not chasing this whatsoever. I have no position at all. I will be looking to, if we get up to that 78 and a quarter, 30 area that I was talking about, which is the high volume area, I will look to put on a short, but most likely using options rather than just, short futures outright.
Okay. All right. We're also taking a look at natural gas futures today. Briefly touched $3 on Friday, but have slipped down about 4% today. Another hurricane on the way in Florida. How should we expect that to impact natural gas prices? Obviously, there's uncertainty there as well, too.
Yeah, lots of uncertainty, and you are seeing inventories build a little bit here, but this is a chart where, just earlier this year, so, 6-9 months ago, this thing was trading half of where it is right now, literally half, about $1.50, $1.52 right in there. NG, natural gas, is up 12% year to date, but like I said, it has doubled over the last 6 to 9 months. It is a dangerous chart, if you will. Dangerous in the fact that, to me, without just looking at this resistance here at $3 here, this thing really could make a big move one way or the other.
So how would you approach this then? If it's dangerous and it can go either way?
Yeah, so I would be buying strangles, much like you would in a stock that you think can make a big move in either direction. I'd be buying calls up at like the 320 area and put it down around maybe the 270 or 275 area. I know volatility is expensive now. Premium levels are expensive, but I think we are in for one big move here. I think we could see a 20% move in natural gas one way or the other in a very short time frame.
A 20% move, that would be pretty notable. Speaking about volatility overall, the VIX is now trading above 22. We were just talking about it with Kevin Green. What's your thought just in terms of how we should be thinking about volatility in the current market?
So here again, if you look at some of the order flow, the option flow, there has been nothing but buyers over the last week or so in the VIX. Not just buyers outright of calls, but of call spreads. The October and the November 25-45, so $20 wide call spreads have been trading in size. So a lot of expectation, not necessarily that we might get a black swan or something really, really negative happening to the market, but that this volatility, this chop is going to continue and going to continue well into the election. So at least for the next 3-4 weeks or so. So 22, is it really representative of the market moves? No, it's really not, because 16 is equivalent to about a 1% daily move in the S&P, which that's about what we're seeing. So I can see, the value in a VIX handle of 16 or so. 22, you're looking at almost 1.5 times the amount of that. So something has got to give there, Caroline. Either we're going to see the VIX start to trend back down, or we are going to see the S&P start trading in a much bigger range than they have been.
All right, Scott Bauer, CEO of Prosper Trading Academy. Always appreciate your insights. Thanks so much.
Thank you very much.
All right, let's check in on a developing story with Jenny Horn, markets correspondent. So, Jenny, you're taking a look at NVIDIA today. Of course, is moving higher. It's off the highs, but still up about 2.4%. And CES just announced that Jensen Huang will be giving the keynote address at the event this year. Fill us in.
Yeah, and I will say CES does become, I feel like, increasingly more and more important as we get closer to the actual date. But last year, it was a pretty major catalyst. So I think another nod to NVIDIA's influence in the overall AI.
I don't even want to try it, but I'm thinking about it. They went from $1 to 120.
Of course, this upcoming year, 2025.
The 5700s.
One of the most premium names in tech really out there. Rumors have surfaced that He could be providing more details on their GeForce RTX 50 series, which are built on that Blackwell GPU architecture.
Damn.
That is, of course, one to watch because we at first heard whisperings.
Now they're at 180. Hot
Potentially
dirt.
weighing on Blackwell and reassurance on their last earnings call that delays were actually not being priced in or at least considered into their.
I really thought about it too, man. I had them all in order, ready to go.
I mean, like cutting edge technology. They did say, per the CTA president, that they could not think of a better time to dive in and bring a beacon of innovation like NVIDIA to their global keynote stage. NVIDIA's processors do power around 76% of the top 700 world's fastest
230 now.
supercomputers and are
Dead
utilizing
gummit.
more than now 5 million developers. So that is, I think, just speaks to its reach and its scale in terms of its breadth, really.
Unbelievable.
Also, we did get some analyst news today. I saw that
They're $3
Morgan Stanley reiterated
from a buck.
rating, continuing to see them as a bullish play despite some of the overall roadmap changes. Malleus Research was also another that said the AI places to be in fourth quarter do still remain in NVIDIA, AMD, and Broadcom, which they called winners in the near term. So while we have come off of session highs a bit here, still making a pretty nice move. I mean, we're up 2.6% here, still making a pretty decent move to the upside in spite of the overall market weakness. And frankly, I think the overall market would be a little bit weaker if we didn't see this momentum and strength from NVIDIA today, Caroline.
Yeah, certainly. We've heard that. But we've also heard today from Lucas Tamicki that it's all false promises for AI and that demand is going to dwindle. And he's bearish on NVIDIA. So we've heard both sides of the story here for NVIDIA, which is up almost 3% right now. Thanks so much, Jenny Horn.
Thanks, Caroline.
Oh boy, that'd have been a good trade right there.
Team at Charles Schwab. We'll be right back.
A few $1,000. The 5700s.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
Yeah, from 55 cents, but when I started watching, they were $1.
With a history and a geography degree, how did you find?
That's where I thought about taking them in a way.
A lot of the best and brightest students, because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Yes, it's a human superpower. Fuck, $5. I waited all day for that.
Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day, about 7 to be precise. It's time for the big picture. Let's welcome in the team from Charles Schwab. Cooper Howard is Director and Fixed Income Strategist at Schwab Center for Financial Research. Michelle Gibley is Director of International Research at Charles Schwab. Michelle and Cooper, great to see you both. Michelle, let's start with you because markets in mainland China open for the first time in a week tonight. After the golden holiday, there's a fiscal stimulus briefing just after the markets open. How much is riding on this announcement?
A lot. Yeah, I think it's going to be the first big test of this rally we've had. 2 weeks ago we had a flurry of monetary stimulus announced. We've been waiting for the fiscal side, and so yeah, just 30 minutes after the market opens, in Chinese markets on the mainland for the first time in a week. We're going to get this briefing, and we're going to look at the size, composition, and timing of stimulus. Now, the first 1.6 trillion yuan of spending only makes up for the existing budget shortfall because policy's actually been tightening this year. So markets probably want more than 2 trillion yuan in spending or some kind of signal of growing that stimulus in the future. And in terms of the composition, we're going to probably look more favorably on anything that boosts consumption. Again, expectations are high. We've had a 37% gain in the MSCI China index just since mid-September. That said, Chinese stocks are trading under 12 times forward earnings. So if policymakers can, keep boosting confidence, the stocks could have further to run, although, it could be a bumpy ride.
Yeah, I think that's the big question is the rally sustainable and how much more can it run higher? I know you talked about it being tradable versus investable, but if you take a look at U.S. listed shares of Chinese companies, Alibaba, Baidu, Xpeng, Li, Tencent, all seeing notable strength today. So is that a good sign for the sustainability of this rally?
I think the expectations are high. We just got a notice of this meeting, last night in terms of Asian markets. So we're hoping to see more. It seems weird just 30 minutes after the open. Hopefully they don't have bad news. Hopefully it's good news.
All right, Cooper, let's turn to you and look here in the U.S. We have inflation data. We have Fed speakers on deck. Let's talk about those Fed speakers because how much do you think they're going to have to be kind of level setting expectations about future rate cuts based on last week's jobs data?
Yeah, I do think that last week's job data really put the 50 basis points debate to bed. So our expectation and where the market is pricing in things right now, Caroline, is that there's going to be another 25 basis points worth of rate cuts this year, and then also additional rate cuts going into next year. But by my count, we have 20 different Fed speakers this week. So that's quite a lot. We also have the FOMC minutes. Now, granted, these were before last week's non-farm payroll. So I don't really think that that's going to kind of change the direction of Fed policy or kind of change things for the market, how they're interpreting Fed policy, because they are a little bit outdated at this point. What I do think that could cause a little bit of surprise, though, are those 20 different Fed speakers. So we'll see how much influence they pay towards last week's non-farm payroll report, which by all accounts was a blowout in pretty much any measure that you look at that.
Cooper, do you think this is a market that would be okay with one more rate cut this year, one more 25 basis point rate cut?
Maybe 50 if this market keeps up.
Probably would be okay at this point. I think that it's priced in at this point, so I don't think
Priced in by far.
Surprised. But keep in mind, expectations for rate cuts, they're largely dated.
It is priced in.
That's
That's
the Fed
fact.
has been telling us, so we do expect that as
We
the
got 2
data
minutes
evolves,
left.
then that's going to influence what the market expects for rate cuts and kind of how we look at different things. If we harken back to the last time that we got a rate cut, remember back then that even on Tuesday, the day going into the Fed meeting, or excuse me, the day before the Fed announcement, the market was largely up in arms about, is it going to be 25 basis points or is it going to be 50 basis points? So there was still a little bit of that debate. I do think that if we look back at the non-farm payroll report, like I said, yes, it was gangbusters and it was good in a lot of measures, but it was only one report. So let's not make that the influencer. Let's see if it's a direction of a trend. And then I think that that's going to kind of influence things going forward. So you don't want to put too much weight into one report, although it was an important report.
Yeah, and some of us were surprised by that 50 basis point cut, although all the reasons that the Fed cut by 50 were the reasons I thought that they would cut by 25. Michelle, what about other central banks around the world? What are you keeping an eye on right now?
Yeah, other central banks.
So far, it don't look like too bad of a pullback.
We had policymakers both from the European Central Bank and the Bank of England last week signaling the possibility of rate cuts at their next meetings, and that's
this girl
really
gets
a
me.
shift from what markets were expecting. Markets were expecting both banks to pause. In terms of the Eurozone economy, there's been a lot of there's been weakness there, and people are a little bit concerned about
5700s are back to zero.
The PMI fell below 50 in September, but
They lost all their value.
It isn't necessarily bad news for
Was it $5?
Because in prior instances when the composite PMI fell below 50, most of the bad news was
Oh boy.
Stocks look ahead.
There we go. Well, I'm green today, but barely. I mean, I did good, but I stopped trading after that last trade. So I'm going to get out of here and rest and get a good night's sleep. Some days you just don't want to overdo it, and that was today. I had some real good trades this morning. 1, 2, 3, 4, and then number 5 didn't turn out that great. So we'll catch you all later. Thanks, Magnificent. Thanks, Mike. Thanks, Jimmy Joe, Randy. Zayed, you got your mic on.
Oh, sorry.
You're fine. And we'll catch you all later. Let's have a good day tomorrow. Right, today was definitely could be the pre-election blues, with also the uncertainty with what Israel's going to hit. If they're going to hit the oil fields or if they're going to hit the nuke sites. So we'll find out. Unless somebody gives in real fast. I don't see Israel doing it until the hostages are back. So we'll catch you all later. Thanks, YouTube.